required in addition to, I think, banks and other regulatory institutions reaching out for credit or platforms like ours. So I think that's the first aspect of it. The second, I think, is the entire credit modeling itself. I think, how do we arrive at it? Because I think, we have been talking about cash flow lending models, and we'll talk about that later. I think at a really small, micro, nano enterprise, less than 1 crore of revenue, you really have to think about what kind of models will work there. For you to kind of give credit, collect credit, and I'm sure Dhawan will talk about a lot about all the aspects of credit that one needs to take care of. So I think, really speaking, to me, the last mile is really a frontier where you have to also figure out the receptivity for credit, formal credit, in that space.
Got it. So clearly there is, underlying this entire discussion, the fact that there is a problem in getting credit to this particular segment. So Dhawan, in your opinion, what is it that's really holding back the banking system from getting to this segment, which needs a solution?
Okay, so I'll further cover it in two aspects. One is how sort of we are born and brought up, right? So the cultural aspect of how the lender works, right? Secondly, why do we lend, right? So I'll cover the second part first. That essentially it's a demand and supply, to start with in any of the business model that you get into as a lender. If I look at the space, is there a demand? I think there is a tremendous demand. So I don't think there is an issue of not having enough size or scale available for us to go out in the business. I think that issue does not exist. On the supply side, you have the components of your ability to distribute or originate a transaction or a loan, your ability to underwrite, with what you are comfortable with, your ability eventually to recover or collect the money back, right? And if economics works out fine, that's where you make money. So effectively for us, from a commercial viability, the first essence is the cost of origination, cost of managing the credit underwriting, and the cost of collection. And finally, obviously, is the credit cost, right? Finally, the losses that you have. And as long as you get the interplay right, and if you're able to minimize the cost of doing business, it also actually gives you a larger appetite to absorb the credit losses, right? Because you are still being able to be profitable then. So I would say it may not be a mindset issue, but it's just that we have seen a set model which has worked very well for us, right? And traditionally, it's still a brick and mortar. However, we talk about digital, the actual digital lending in India, whether in the household or the MSME, in fact, MSME side, it's virtually zero, right? It's still touch and feel. I want to see the customer. I want to see whether he's doing business or not. It's a relationship-driven businesses that we do, right? So I think large part of play is still about I getting a sense of what the market is, segment is. Am I able to see the business myself? Can I see the factory? Can I see the collateral? The second underlying it is obviously the availability of collateral. If you don't have a property, I think that's the first deterrent, because the segment you are talking about is sub 15 lakh, 20 lakh ticket size at best, right? So anywhere between 2 to 15, 20 lakh is the lending ticket size that we are talking about in the micro or the nano enterprises. Third is how we underwrite, which is still basis the third party or the audited data, right? So your need for GST, you need for audited balance sheet, you need for income tax returns, and a whole lot of bank statement and multiple things that you ask for. So there is a comfort zone, if I have to use that word, but the fact that you are used to doing with it and it's working fine so far, maybe you're not pushing yourself to then solve the problem for somebody else, because it's just working fine. But if somebody were to think differently, that while the market is there, you are doing business, it's getting competitive, but there is a completely new space out there which nobody has touched, I think there is a tremendous potential to up the game from there. So I think that's how I look at how the bankers think right now and what can change.
Okay.
Yeah, now we got it back.
Yeah, no, we lost you for a bit. It's fine. Yeah, so thanks. So Dhawan, I think just to paraphrase a lot of what you said, one is, of course, very clearly there is a commercial consideration that banks have, which probably doesn't make sense in the last mile, and we need to solve for that. You also mentioned about mindset, where there is this need for collateral, etc., which again is years and years of banking has led to this. And then there is the part around understanding the credit, underwriting process, which probably needs to get changed. So if we were to just go down each of these, wormholes, if I may, and figure out what is it that we can do to solve for this from a technology perspective, that'll be a great place to start. So,
Sure.
Kaushal.
So I think what I'll focus on is probably the third one, which is the method of underwriting.
Right.
You're absolutely right. We've all been brought up in the tradition of cash flow based underwriting using traditional data sources, structured data sources as we call them. So income tax returns, now GST returns, so on and so forth. But the world is rich with data. Structured and unstructured data is and unstructured data, particularly for smaller businesses, is the key to understanding them and doing business. A lot of these businesses, micro, nano, that Ram talked about, are sub 20 lakhs, so you may not even have a GST. They may be outside the ambit of GST. So how do you lend to them? You have other, I would say, very valuable data points. Can we get their utility bills? Can we, look at other unstructured data sources that exist for them? Can you look at benchmark-based lending? That's something that we do at Rubik's, which is where we look at essentially what is the size of a small business. What is the a benchmark PNL of that business in that locality? You'll have some where you can get a size and estimate, and then you apply that to others. So there is a physical size, there is utility bills, there is social media, and this we ignore at our own peril. There is so much about these small businesses that is out there. Are we actually able to get that in? There's also litigation data, and you'll be surprised, especially for small businesses. Sometimes you get your Section 138, check bounce cases, etc. All this is available on e-courts. Integrating this quickly, being able to do, bring that into this will allow you to get an idea of size, idea of the business that they do, and then go out and lend it. So I think it's as much a need for building innovative, credit scoring models using these data sources, unstructured data sources. Today, we have over 120 unstructured data sources that we use. And that data is available pretty much free of cost. It is available regularly. For all lenders, whether trade credit, whether bank credit, whether any credit, you have that available. And the last thing I'd like to say is that a lot of these guys work with, say, FMCG companies, etc. These anchors, are they able to give you their accounts receivable on the basis of which you're able to generate payment scores, which again fit into the credit model? Are they paying on time? Are they, how are they paying, etc.? What's their payment history? Are there defaults? If you can build, and lenders have the ability to do that, if you can build a model around these anchors, sharing data and build scores around that, I think it makes it very, very rich data, which allows you to lend effectively or score them effectively, which in turn gives you risk-based pricing models. To Dhawan's point about being able to, sort of manage for, profitability, you're able to build risk-based pricing models. And do it accordingly. So think about the credit bureaus some time ago,
right,
and think about now. I mean, it's changed, right? So I think the same thing is possible in this space.
Yeah, I think completely agree with you. The big change right now is also the fact that a lot of this information is available in the public domain. So there is so much more ability to go out there and crunch this data and make sense of it. But if you were to, solve for the first problem that Dhawan talked about, and Ram, if I can throw this at you, there is a commercial consideration that banks have, which actually holds them back from doing much of what we just said. How do we actually solve for that using technology?
So I think let's just first start defining the problem, right? At the lowest end, there's the micro and nano, their net margins are typically 2 to 5%, which means that they can't afford actually expensive credit, which actually makes the job of bankers to kind of figure out how to kind of price it even more difficult, because when you start pricing it at 1.5% a month or 1.2% a month, that's often a very large portion of the net interest margin, net income margins that these guys have. The second point, I think, really speaking, is that if you really want to reduce the cost, you'll have to figure out how to use the supply chain. I'm biased towards supply chains because that's all I do. But I think the real important thing that Dhawan talked about, that India is still a physical market. Okay, I mean, you can get data to underwrite, but you can't get data to collect. You still have to go and collect. You still have to have a mechanism of monitoring. I think what we have done in India is have a lot of physical supply chains where people are going and meeting their respective small businesses, micro businesses. Kaushal talked about FMCG companies. I think we have built a huge systems over a period of time of people regularly going and meeting them. That's the force that you'll have to look at from managing the physical distribution of credit, which includes the actual portion of giving credit, collecting documents, of collecting credit, and you'll have to figure out how to use that mechanism. So I think the real important thing really is to figure out from a bank or a lender's perspective is to really see that can I use the existing infrastructure on the ground, marry it of course to what Kaushal talked about, all the data, and then figure out whether I can still make that cost of credit at a point where the small micro nano business thinks that it's a priority to repay this because it's the cheapest form of credit. I think that's really the key problem statement for all of us.
Got it. No, and I think the other part about this segment is the fact that it is very large in terms of the number of counterparties, and they are very, very geographically dispersed. So, in part, one of the big problems here, as I understand it, is how do we scale a business of this kind? Yes, we can, provide a product for each of these customers, but from a lender's perspective, and this is to you, Dhawan, how does one actually build scale in this business?
So I think let me add to what both Ram and Kaushal said and sort of try to visualize the model. But let's go back to how the household credit has evolved in terms of people going door to door and trying to ask the customer whether you need a car loan, you need a home loan, you need a credit card, right? Now, obviously, there was a lot of misfire because you were not sure whether the customer needs it at that point in time or not, right? And the model then evolved to where does customer go, where I be able to talk to 100 customer rather than one customer, and the need is verified there, right? That's where your car dealer model, where the dealer is originating a car loan, is the model which came, right? Because if essentially I'm visiting a dealership, is the need for buying a car there. And if I'm buying a car there, probability of needing a credit is very high, right? You go to a builder, you're looking for a flat, obviously somebody comes next, they say, are you looking for a home loan, right? Or you go to super malls, your electronic stores and all, that's where the guys are standing and saying, do you need a credit card? Because you are making a high value purchase there. So I think essentially the scale will come where you need an intermediate entity which is going to aggregate these people. And I'll say both from a physical and the technology perspective. Now you look at most of the segment we are talking about are essentially the retailers, right, in the service or the goods space. And I know of a lot of FMCG companies who have tried to reach the last mile in terms of data of their inventory management, their ordering system, their CRM system, which means while the dealer distributors networks are still there, a lot of companies are now able to talk to the retailer as an end mile. And he actually knows the velocity of sales, which goods are picking faster, which are slow moving consumer goods. So if you are able to actually access that network, then your ability to reach out as a scale, I think is not a problem, right? So if I have to look at an equivalent, is the delivery distributor today for SME in the FMCG space, is it as good as a car dealer for me to access those network of people, right? The only challenge or differentiation here will be each of the retailer will be talking to multiple dealers of multiple companies, right? It's not one-on-one relationship. And I think that's where the platform aggregators comes into play. So if you have to really build a network map of top 100, let's say retail distribution companies on manufacturing space, their aggregate distributors, dealers, and the retailers. If you look at it, it's a mammoth task to start with, but I think it's very easy to achieve eventually where you exactly know who is talking to whom in terms of payment and the goods movement which is happening. And if you're able to access that network and aggregate data, I think the problem can be solved, right? But it does require effort on somebody's side to be able to get the anchor and the dealer and the distributor together on the platform. And then you start building the retailer network on that aggregator platform. The richness of the data, I would say as a banker, if we were to change something, it's moving from a cash flow based financing to then look at where the goods are moving or the products are moving, right? So instead of saying where the cash is moving and hence what is the working capital cycle, if I know where your goods are moving every day, which are fast moving, which are slow moving, what's the velocity, what's the kind of working capital you need basis the goods which are moving, I think it solves the problem of data, right? A lot of surrogate data that he spoke about is, are you paying your electricity bill on time? Are you paying your mobile bill on time? Because that's the last thing you want, your mobile phone getting cut, your electricity getting cut. But it actually gives you a sense of the discipline of a person, right? If he's paying it timely, however small that amount may be, whether it's 250 or 500 rupees, it gives you some sense of comfort to a banker or a lender that yes, the guy has a discipline of paying things on time. And you add the data of the product or the goods movement, I think there is a potential scale to be built on the credit scoring point of view, which means it cut down the cost of paper-based or document-based credit algorithm that you run. And you need a strong AI tool also for decisioning, because today while we extract data, to that extent digitization helped you get a GST data, ITR data, but you still interpret manually, right? You accumulate everything. So it's just that your preparation of sort of CAM or the paperwork has become easier, but you still fallen in love with reading those 20 pages and taking a decision, right? For a 5 lakh ticket, you can't afford to do that, right? So if you mix two in terms of the network available, aggregators coming into, bringing them into common platform, and you use strong AI tools to actually decision, I think the problem can be solved from a scale perspective for sure.
Yeah, makes a lot of sense. But on the point of data, and Kaushal, this to you, it's easier to get data ab initio as you're starting out the process of assessment, because that is the time at which the borrower is most, likely to give data. But subsequently, as you need to monitor that particular counterparty or this large pool of counterparties, how do you actually solve for the problem of getting data on a continuous basis to actually make sense and take care of your portfolio?
So I think it's Dhawan made a very interesting point, right? Ab initio, of course, you're going to get the data because people want credit. The idea is that if you you shift the paradigm a little bit, shift the model. Don't look at the borrower or the SME or the micro or the nano as being the source of the data. Because if you look at it, that itself is a bit of a hurdle for them, because for them to put together documents, etc., to give it to you on a continuous basis is a problem. You look at how you can source this data in a digital way, in an automated way, using unstructured or utility bills, etc. You're able to get it yourself. It becomes easier. To the point about the anchors, why do anchors sometimes hesitate to share data? Because they think it's going to leak. All CFOs of companies, all legal heads will say, "Nahi, mera data kahin jayega. I am not going to share with you because tomorrow someone else will have it." What does for example, a credit bureau do in the banking system, right? It anonymizes the data. So no one is worried about data going to anyone else. Can a platform actually do that? Can you anonymize that this is not a Unilever customer, this is not a Dabur customer? We've built out at Rubik's, we've built out a private credit bureau for the gems and jewelry industry. The top 11 gems and jewelry manufacturers in the country who are supplying to all the retailers. They all share data with us. And on the basis of that, the risk is scored, the risk is monitored on a monthly basis, and where there is a delay or a default, is X being paid on time, Y? Without knowing who X or Y is, you're able to anonymize it and get that information. I think platforms can do that. I think banks can ask anchors to help them set something like that up. And it is fairly easy to do. I mean, it's a technology intervention, and then scoring, automated scoring to the point. We don't touch, there is no analyst looking at the data. Once the models are set, you have a probability of default model set up. It's just monitoring it. And you just make sure that if there's a check bounce or anything, you're able to get that regularly. So it's digital, it's analytics based, and it is aggregated at a different level. And you're not bothering that poor guy who's got to run his store, and he doesn't want to sign 400 pages and give you 400 pages of information every month.
Yeah, I think the key is to get this information without really,
Exactly.
getting in the way of his business.
Exactly.
So, on that point again, and Ram, this is to you. So we're talking about these 20 million counterparties who need financing. We kind of solve for how do we access this pool, how do we assess them. But what about actually running this large, portfolio of borrowers? The number of transactions, the volume of activity is something else altogether. So how does one solve for that really? Because banks are not really capable of doing that at this stage.
Well, actually, despite being a platform, I have to disagree. I think banks are quite capable. And I'll say yes to Dhawan also on that. But I think the key question really is that ultimately, I think taking Kaushal's point and your point also that we summarized it, technology cannot come in the way of that business to operate. A nano or a micro business is basically doing job of 20 people at one time. You cannot ask him to, and one of the big issues that I have at least is that we have introduced a lot of these apps and URLs and everything else, and everybody looks very good, but it's all digital friction for that guy. It is not digital friction for someone who has an accountant or a CFO. So when you take the small guy, if you want to introduce the technology and the platforms, you have to embed it in such a way that he does not have to do 20 more things to kind of get it done on a daily basis. So you have to be very, very smart, I think, about using technology in a way it's invisible. And I think, at Vienna, that's been our, I guess, secret sauce, is to not actually be visible to the customer in some sense, to ensure that he's not really thinking about financing. Honestly speaking, nobody likes financing. I mean, everybody wants to get on with their business, buy, sell, and get money. So I think the trick really, if you want to scale this platform up, if you want to say 20 million businesses can run on this day in, day out, I think the technology that you have to build is not really a technology along the conventional lines, saying that I have now built a much more better user experience, convenience kind of an app. It's to say, how do I embed it into his trade so he doesn't even have to kind of think about it. But for that, I think the first thing in India, at least especially in India, you have to make sure that the commercials work out. And I think that's really the key, because today we have a lot of convenience coming up in the market, but the rates are very, very high. You have to think about, and I think our job has been very simple, how do you get it to below 1% a month in terms of interest cost for those guys, especially the micro and nano, which we have to really marry all of the stuff, the risk part, the collections part, the default part, the information part that Kaushal talked about. And then I think the key question then after that is that you bring the technology in, that somebody is really not kind of thinking about it. I think that's the key to kind of making it available to 20 million micro and nano enterprises.
No, I think well said. Technology is not necessarily the cure. I mean, there's a lot more to it than meets the eye. Is there also scope for innovation in the product construct that we can offer this particular segment for them to actually come into and really borrow from the banking system in larger numbers? We talked a bit about Dhawan, you spoke about collateralized lending. There are gold loans on the one side, and then there's supply chain finance. Is there a way to marry some of these different products, make it available to this ecosystem?
So my sense is, Partha, anything which you add in the name of collateral, whether gold or property, from a ticket size perspective, the cost of physically handling any of this is going to be a deterrent always, right? So this has to be unsecured, or at best, depending on how the regulators move on this space or the government moves. I think there are schemes of Mudra and some of the credit guarantees available, right? While there is a scope for improvement and can be embedded into it. But that's really the segment for which these schemes are actually meant. So first is very clear, it has to be similar, it has to be data driven, right? So as much is the less friction or less human intervention, I think there is a potential to do this business in a profitable way, for sure. I would say a lot more product innovation, but possibly more from the perspective, how do I collect the data, which are my touch points, what am I changing from my current metrics, how am I assessing it, right? And then how am I actually doing the actual collection of collecting my interest or the EMI, right? Is there an escrow mechanism which can work between the retailers and the dealers, right? So every money which comes in, I take my share, rest goes to dealer. Is there a better way to do it? Every digital payment which is hitting the customer, whether it's through UPI, QR, or the POS or the card businesses, either 1% of that, can I keep it aside? It's just like the way we work on piggy bank, right? So every day you have something, put the chiller back there. But that's the collection mechanism which works on actually getting the money back. So if you're able to solve that problem of delivery and the transactions and keep as less human intervention as possible, there is definitely a commercial viability possible into this business.
Great. So I think we're just almost running out of time. Maybe I'll just summarize. I think clearly this is a problem which is solvable. It's a very large problem. The problem also is in good hands. I think there are a number of fintechs out here, the banking system at large, as I see it, who's actually working towards solving this problem. And clearly there are ways, the problems are really at the top in terms of sourcing, in terms of actually providing technology, in terms of analytics and so on and so forth, all of which need some solution or the other, which needs to come together in a form that the small borrower actually feels enticed to come in and borrow at a low rate from the banking system. So with that, I'll just offer a round of thanks to this very esteemed panel of ours. And I hope you've had a good session and enjoyed this particular interaction with the team. Thanks.
Thank you. Thank you, Partha. Thank you.
Thank you very much to our speakers. May we request everyone to please keep your headphones on as we're starting with the next panel discussion immediately. And may we request you to kindly be seated. Yeah, before we introduce the next panel discussion, we'd like to thank our sponsors and our partners, our theme partner, WhatsApp, co-powered by Amazon Pay, spend management partner, Encash, in association with Perfios, payments partner, Cash Free Payments, and CEO's dinner partner, HSBC. नहीं मैंने ऑफ किया था नहीं मैंने ऑफ किया था तब क्योंकि May we request everyone to kindly remain seated. Hi. All right, everyone, we are starting with the next session. May we request everyone to please be seated. Music down, please. All right, the next panel discussion is on Neo Banking, a digital bank. Everyone on stage, you all are able to hear me? Am I audible to you all on the headset?
Hello. Can you hear me well?
Yes,
Thank
yes.
you.
Hello.
Are you able to hear me? Check, check. No? Okay.
Yes, now.
Yeah?
Now you're audible. Yeah.
Audible?
Yes.
No, waiting for it. Can you wear that just so that we'll check if you're audible. Am I audible, sir? Yeah, this is okay? All right. So our moderator for this Neo Banking Digital Bank panel discussion is Mr. Jatin Joshi, Executive Director, Head Cash Management Product India at Standard Chartered Bank. And our panelists are Mr. Anish Achutan, Co-founder and CEO of Open Financial Technologies, Bank Open, Ms. Shalini Warrior, Executive Director at Federal Bank, and Anjani Rathore, Chief Digital Officer at Hdfc Bank. Over to you, Mr. Joshi.
Thank you. Morning, everyone. My name is Jatin Joshi. Uh, Together, we are actually going to present the Neobanking Digital Bank. Let me introduce myself, seasoned banking professional, about 3 decades of experience in wholesale and retail banking. Worked with a local and global bank across geography. And we have 3 industry experts, Shalini and Anjani representing the banks, and of course Anish representing the Fintech Neobank. They're here to share with us their experience in neobanking, digital banking space. I'm sure the session will help us to understand, learn on the journey evolving and the evolving models, regulation, challenges, and the opportunity the neobanking provides us today. Let me quickly take an opportunity to introduce our esteemed panelists. So on my extreme left is Shalini Warrior. I think she's known to a lot of people around. She's currently an executive director and business head for retail banking in Federal Bank, a leading private sector bank in India. She leads, among other things, the digital banking, the fintech strategy for the bank. Shalini has been with Federal Bank for about 7 years, prior to which she worked with Standard Chartered Bank for almost 25 years across India and overseas location. Federal Bank ties up with Jupiter and EPFI as of now. EPFI. Okay.
Epi5.
EPFI. Thanks for the correction. In middle we have Anjani Rathore. Anjani is the Chief Digital Officer for Hdfc Bank. His mandate includes driving adoption across the businesses. Prior to joining Hdfc Bank, Anjani was with Airtel as the CIO of consumer business and as the product and operation head of Airtel Money. Anjani has worked in various capacity at Boeing, Accenture, and Citigroup. So that's a wide spectrum, Anjani. To my left is Anish. Anish is the co-founder and CEO of Open Financial Technologies, which is called Bank Open. Earlier, he has held a senior position in many fintechs like PayU, Citrus Payment, On Mobile. He has vast experience in the area of mobile and digital payment solutions and co-founded a number of payment fintech companies in past. So without further ado, let me jump into, I'm sure most of you are aware what neobanking is all about. Neobanking, digital banking interchangeably used. Are banking services provided completely digitally, so they do not have physical branches. All bank services are provided online, which includes even the customer services, payment, onboarding services across. Globally, there are 2 models wherein they work as per the local regulation or licenses is provided. The other one is a partnership approach. And in India, largely in absence of any regulatory framework, this works only on the partnership mode. There are various models which are evolving in the country, which is basis the market segment and target audience, which could be millennials, teenagers, SME, MME, credit-led model, savings account-led model, technology-led model. So this is an evolving space, and I think it will be interesting to find out where we are going to land. So my question is to everyone, and I can start from Shalini first. With so much happening in the country, right? Digitization drive across economic, socially, payments, 24/7. We have the best payment systems in the world. We have payment bank. We have small finance bank. How does the neobanking fit in?
Thanks, Jatin. Indeed, an honor and a pleasure to be here on behalf of Federal Bank. First of all, congratulations to NPCI and the other entities for having put together this platform. I think it's phenomenal what one has seen and heard of yesterday and what is being experienced today and tomorrow. So kudos to the organizers for that. So Jatin, coming to your question on, what kind of role does something like a neobank, digital bank play? And I think the terms are used a little interchangeably. So, the topic itself is probably a little kind of a complex one, which says neobanking, a digital bank. But let's use the terms a little interchangeably. I think, first of all, the way we see it, at least from Federal Bank perspective, is there is a certain profile of customers who have literally been born digitally native, who are literally, as I say it, born with a mobile phone in their hands probably. And that set of customers expect an experience which is sometimes different or difficult for the so-called traditional banks to provide. I think customers are expecting the ease and convenience of how we order food on a Swiggy or or take a cab on an Uber, but with the trust and security of a bank. Because at the end of the day, this is money and it's not a small ticket item. So I think there is this profile of customers who have begun to expect that. And to a large extent, where Federal Bank is approaching it from, and is that that profile of customers will be best served through a collaboration between a fintech and a so-called, and I keep saying so-called because I think a lot of us are not any longer traditional in that sense, but let's, for the purpose of today's discussion, call ourselves a so-called traditional bank. So that bringing the best of both those worlds is what I think the world is getting into. Clearly, fintechs are able to bring in an insight into customer needs and agility, to some extent a flexibility, a speed to market, user convenience, which sometimes banks may find it difficult to do. At the end of the day, however, the bank is the platform on which this has to ride, and there is a regulatory framework around it, as well as the trust and security that comes from it. So the way I see it, it's not an either or an or. It's not either a physical network-oriented bank or a digital-only bank. My sense is, and the way I see it is, it's both of them need to work together and bring the best to the consumer. And I think we need to leave the choice to the customer. The customer may sometimes choose to do only digital, may sometimes choose to do both digital and physical, but let's leave the choice to the customer. And that's how I see this world evolving, of a more collaborative slash a cooperative kind of arrangement rather than one or the other.
Okay. Anjani, you would like to add anything?
Yeah, just to take this forward from where Shalini, what Shalini mentioned. See, today in a traditional bank, there is a lot of digitization initiative that is happening. And each of these incrementally will improve and make the bank a lot more engaging and a lot more efficient over a period of time. But there is another paradigm. Instead of, incrementally improving things which are already there is an opportunity to create a completely digital bank which will establish a very new operating model. Can we set up a bank where a customer doesn't have to walk into a branch, but can get onboarded seamlessly on any of the products, savings account, current account, take a loan, without walking into a bank branch, just through digital interfaces? Is it possible to enable all transactions wherever the customer is 24/7? Is it possible to offer all the servicing to the customer without even that customer taking a step? So this is about establishing a new operating model which will not have a customer care which goes up with the number of customers that a bank has. Establishing an operating model where you don't have a large operations team just curing the failures which happen, or having a large fraud and risk control team which is trying to monitor. Can we do it digitally in a manner that it is safe, it is engaging for our customer, it's easy, just like making a UPI payment? Can we enable that kind of transactions? So these are two distinct models actually. One requires a complete reimagination of how banking has been thought through, and that is why we see that there is a place for both. Today, 99% of the customers or citizens of this country are on traditional bank, and they deserve a far higher level of service and engagement, and banks have their duty to provide this, and therefore a lot of digital initiatives are happening across the bank. But at the same time, there is a new set of citizens who are emerging, who are completely digital native, who are do-it-yourself generation, just like IKEA furniture. IKEA sells furniture. They want to create their own product, buy it themselves. So can we do it yourself banking on phone or through various digital channels and create a bank which exists in the cloud like this? So both are necessary. The other one, yet the paradigm has to emerge. A lot of us are doing reimagination. Every bank, every fintech, a lot of other stakeholders, including the regulator, is thinking how to make this happen. But this is what is needed to make every citizen in this country banked. Otherwise, the first model has got some limitations. There is a cost, efficiency which comes into play to push it to the last citizen standing. The other model should be such that everyone can get banking anytime that they want.
Thanks, Anjani. Anish, over to you. You want to add anything to this? Being in that area, why do you think, where does, neobanking?
I think neobanking also has evolved over the last 4 to 5 years. So when initially it got started because of the legacy challenges banks faces, wherein the digital first or digital native set of customers, they required a different kind of an experience. And that's where some of this fintechs or so-called neobanks started out with. But today now the same technologies are available for the banks, especially when in launching in digital banking solution. So what is more important is that, but at the same time, each segment of this customers requires a different set of experience. For example, on the SME side of the customers, what companies like us and our peers are trying to solve for is the financial automation challenges which they faces, which is probably not being solved for the banking. Or when it comes to the consumers, probably like for a set of like the millennials, they're kind of like the experience or the products they are looking forward is different. So definitely there is an opportunity for fintechs and banks to jointly create solutions for each of these segments. I mean, I just also want to make one example. For example, take an example of an ONDC. There could be commerce solutions or other non-banking related solutions which is important to cater to that segment, integrating with ONDC and things like that. So this is probably where more maybe it could be a collaboration of banks and fintechs that could actually look at this opportunity. So that's where I do see the opportunity for neobanks today in the market.
Thanks, Anish. So basically, just to summarize, I think what we are saying is that there are client expectation is a bit different from the earlier banking experience, customer experience. And if you add value added services, I think this could be very useful, and both will have to work as a partner together. Okay, that's interesting.
So can I just add one
Yeah.
thing, Jatin? And I think, as I think Anish alluded to, some of the models are also evolving as we speak in India. If you cast your net a little wider and look at it from an international perspective, again, we see different models. There is one model which is the Monzo Revolut kind of model, which are standalone digital banks been licensed by their regulators, etc. There is another set which is between Singapore and Hong Kong, etc., which are the so-called traditional banks. Your bank, Standard Chartered, for example, has Mox in Hong Kong, which is a digital bank within a bank. And in India also you see those models. You have a Kotak 811 or a Yono, which to a large extent is digital in its orientation, but embedded within a bank, whereas we've got Federal Bank in partnership with Jupiter Epify, which is a different model. So I think some of these models will also evolve over time. Ultimately, I think it will really boil down to customer expectations and customer requirements overlaid with the regulatory framework. So I think that's where we are evolving to.
Thanks, Shalini. I think that brings me to the next direct question, which we spoke about. I think the question is more in terms of the regulatory requirement, right? As a bank, we have a responsibility towards fulfilling the regulatory requirements. So basic questions like, who's responsible in a partnership approach to meet the regulatory requirements, and, likes of customer data or their security. And the most important question is, who's the owner of the client at the end of the day?
Yeah, I'll take. So, very recently, so earlier there might have been some ambiguity, but recent diktats which are coming out from the regulator as well is clearly pointing to the fact that the regulated entity needs to ensure adherence to all the regulations for any product and service which is being offered to the citizen of this country. So that is completely unambiguous. There is no two ways about it. However, the real challenge that comes in is when you create a digital enterprise, it is built on a premise that a customer can be brought in with one product or one hook, and then there is an opportunity to monetize with that same customer base with very many products, which could be banking and non-banking. And this monetization depends on data, access to data. And that's where the challenge comes in, that who has the access to data to monetize the customer. Here again, thankfully, with the progressive regulations that we have here, India is taking a big leap in terms of data privacy and data protection, where we are making it very clear as a nation that the data belongs to the citizen of the country. It doesn't belong to any enterprise. It doesn't belong to any one company or the other who's acquired. And a customer has the ability to give consent to use that data for any product or service. So that's an amazing capability that is getting created with the likes of account aggregator, which is coming in. And therefore, that allows a safe framework for sharing data across entities. This will solve that problem of data monetization. So for all banking products and services, banks will be happy to request the data from the citizen and provide them services. Likewise, non-banks can also play a role. And if that same framework can be extended, a non-bank will be able to provide value-added products and services to the same customer. So that will get resolved over a period of time. We still have to wait and see what shape and form this whole data protection bill comes out in. But this should be the way forward.
Shani, you want to add something?
So I think, Anjani has probably covered most of it. But just to kind of bring it together, at least in our mind, one, I think there is no ambiguity about the fact that it's the regulated entity that is responsible for all aspects of regulation, whether you look at KYC, AML, transaction monitoring, fraud prevention, customer confidentiality, data privacy. There is no doubt about it. The regulated entity is and will continue to be responsible, in my view. And that's really where the regulator is also coming in from. Having said that, I think there is a part of it which, the fintech entity or the entity who we partner with should take some of the responsibility also. I don't think we should be irresponsible to say, I'll leave everything to the regulated entity. I will not do anything. It's up to them to. I don't think any of them do it. None of the partners do it, to be fair. And they go through fairly rigorous reviews and audits, etc., to make sure they're on the right track and do it. So I think there is some amount of, even if it on paper, the entire accountability is with the bank, there's no doubt about it. But I think the fintech partner has to bring to the table that awareness, that appreciation, and that aptitude to make sure that the risk parameters are in place. And that's really what we look for when we look at fintech partners. Most partners who work with Federal Bank, as with other banks, will testify to the fact that they go through a lot of rigor and discipline on audits, etc., before they do it. And the other part of it is, again, Anjani referred to it, which is ownership of data from a point of view of KYC, AML, etc., is one aspect of it. But I think the rubber hits the road when it comes to who can cross-sell, what can you cross-sell, where can you cross-sell, when can you cross-sell, and that's where I think frameworks like account aggregator come in very clearly, because they're the power is in the hand of the consumer. Then you use account aggregator, get the consent from the customer, and with full transparency and with full consent, share the data and then work with the customer on that. So I think I split it in my mind into two parts, but overarching it, the regulated entity is and will be responsible for regulation.
Yeah, thanks, Shalini. Anish, you want to share your experience, because regulation when it comes to fintech could be quite an interesting area, right?
Right. So from a fintech perspective, it's very obvious, as Anjani and Shalini mentioned. Ultimately, the bank is the regulated entity, and they are responsible for this. But at the same time, I feel like Shalini, there should be regulation for the fintechs as well, because it's also our onus to actually ensure that. And that's where I feel like that will come in, like the way we have this PAPG and the account aggregator. Similarly, some kind of like a BC kind of a structure, especially for neo banking where they work with, if they can also be license, I think that is actually very good for the ecosystem. Now, the other important aspect is on the customer ownership, and this is like a very tricky this thing, because on one side, probably the banking partner would be providing a checking account, but at the same time, maybe a fintech had a different model where they want to cross-sell loans to these customers, maybe through an NBFC partnership, or at the same time, the bank may also wanted to look at like lending to these customers through a different channel. So now, in terms of the ownership over here, definitely, again, as I said, the bank owns the current account or the savings account for the customer. But let's say like using a Google social login for logging into a accounting software, the customer is either can be an owner of two platforms basically. One is with the bank, and secondly he's using the platform for various other services as well. And here again, like it's mostly a collaborative way, or the equation that you have with the banking partner or the approaches, that's what matters in terms of the cross-selling and other parts.
So thanks. I think so. This is an evolving model. In short, I think we'll have to work together as a partner, and probably address this as we go along. So I think
Yeah, but if I can just kind of add, sorry to butt in again, Jatin, but I think on the digital lending side now the clarity is pretty clear. I think RBI has come out, and I think it's really wonderful to see that. And I think to be fair to the regulators, there are certain tenets that have been put in place. KYC is sacrosanct, AML is sacrosanct, customer consent is sacrosanct, privacy is sacrosanct. So some of those tenets are there. I'm fairly certain that in the area of savings and current accounts, some of this will evolve over the next one. But if we just step back and look at it both from letter and spirit of the law, as long as we're very, very clear, we've got some of these, kind of principles in place, whether it's, how you onboard the customer, how you treat the customer, how you get consent from the customer, how you treat the data. I think we're on the right track, is my view.
Okay, thanks. Anish, this question is probably for you. From a neo-banking standpoint, I've heard, read reports that there is almost a 5x surge in the funding in recent years, and expected to reach 215 billion by 2030. That sounds very good, but what actually I'm not very clear. There are a lot many people asking me this question. Are there substantial revenue models which is sustainable in the long run? So where do you think, how you substantiate the revenue and the...
So again, like India is a different market when it compared with the Europe and the US market, especially when it comes to the revenue models and the business models. So this is where there is a lot of challenges where neobanks face when it comes to their business models versus banks where they have more control in terms of the CASA deposits and the lending leverage they can have. Now, typically when it comes to, I'll just talk about the challenges, and I'll also talk about how players like us are actually looking at this. So the challenges, for example, the MDR is capped, the interchange revenues, again, is not sustainable in the long term. And there is also regulatory challenges in terms of the other things like the deposit revenue sharing and things like that, which means most of these fintech partners had to look at non-bank related revenue streams. Obviously, there is things which now there is clear guideline from the regulator on the lending side, which is definitely one of the areas. But when it comes to the SME aspect of it, we do believe that there is a lot more business models you can actually build in around subscriptions, in around offering more value-added services to this SMEs, because traditionally there is already an ecosystem of players who are already generating revenues through offering various financial tools to the customers. So mostly on the SME side, even in globally, for example, one of the large players, Kondo, their primary revenue stream is through the subscription business model. And most of the SME players, including us, actually follow on that model as well. And then but on the consumer side is probably where I think on the India market, need to figure out the new revenue models, because apart from the interchange and the account deposits, and lending definitely is huge, but apart from lending, will the customer pay for a premium service? For example, companies like N26 has launched premium subscription services in other markets, but will they fly in a market like India? So these are at least my view on.
You want to add anything, Shalini?
So I think it's always a difficult proposition when it comes to revenue. Revenue pools are always under pressure, and when it's a collaboration, there is always some give and take. Some part you need to retain as a bank, some part the partner needs to retain. But I think if you step back and look at it, I think again the fact remains that if this has got to be sustainable, it's got to be profitable for both. The banks got to see some bucks in it, some money in it. The partners got to see some money in it. Otherwise, otherwise the customer is left high and dry. Otherwise, so yeah, I think the models will evolve. Anish is right. India's not completely ready for a subscription-driven model, and therefore the real revenue comes from lending. We've got to see what we can do from a lending perspective, and ultimately that's probably where some of the money to be made will be. But it is a challenge, no doubt about it. And I think both partners need to approach it in a collaborative fashion. Be in it for the long haul. It's not something that can happen tonight. And the analogy I draw, Jatin, is if you build a physical branch, I don't expect my physical branch to break even in the next 3 months, right? I expect the branch to take 12 to 18 months to break even. Build up a book and then break even. So that's the way we approach it, to say what's the kind of longer term view, are we adding value from a customer standpoint, and then I think the revenues will come. Difficult, but is something we just need to keep working on.
Excellent. That brings me to another question. We've been talking about having a partnership. We've heard about banks actually wanting to take this initiative internally, right? They want to come up with a strategy of building this by themselves, the digital bank. So what do you think from a bank standpoint are the sustainable model? It seems to me that partnership is the only option which is coming up. Maybe a quick just a option, whether it's a hybrid model, whether it's a partnership model, whether it's a...
I think there is room for both kinds of model right now. This is a fast changing field. And thankfully, the regulator in India is a lot more progressive. If you just compare it to China, it came to a level where there was a lot of overstepping between the two industries, the fintechs and the banks. And as a result, the regulator had to step in. Alibaba, Jack Ma became just the poster child for that. But thankfully, in India, the regulation is progressive and it is drawing a very clear guideline in place to say what's doable, what's not for both sides. And as a result of that, there are certain things, in the end, it's the same customer. We are talking about the same customer, just from two different lenses. When a bank approaches a small and medium enterprise, we say, start with a current account, then we can lend you, we offer you many more services like trade. When a fintech would approach, they would say, we will help you pay your employees on time, we will help you collect from your customer. So we will help you grow your business. Oh, by the way, to do this, you also need a current account. You also need a lending support. And here I'm going to plug in multiple banks at the back end, which will provide that. So effectively, both are trying to solve the same problem of the customer. We need to be very clear that who is responsible for what and who can provide what service. And as a result, partnerships will drive certain kind of business models, and there are certain things that banks will have to do on their own. So, if a customer opens an account with us, managing that account, ensuring that it's always available to our customer is bank's responsibility. So we'll have to do both.
So I like that answer, Anjani, and I know what Shalini is going to say. So I'm going to, because I can see that red time up. But Shalini will definitely say the partnership, and I liked Anjali the way you basically are partnership and possibly on your own. So
I think it's not an either or an or in the interest of it's neither an at least from a federal bank perspective, we're very clear. It's not either or. We are growing physical branches, for example. We are 65 new branches this year on a base of about 1,200 branches, and at the same time we are out there with partners, etc. So it's not either or. I think both the partnership model is what we're very clearly committed to.
Okay. Do we have some time for one or two questions, or it's time up? One question? Okay. So who's the lucky one? No prize for the questions. Okay. There's one question here.
I can see somebody's hand raised over there at the back.
I'm Jasmine. So just wanted to understand your opinion whether Indian consumer is matured enough to trust their money with a bank that does not have a physical branch. And if no, then I mean, what segment of customer you're looking for over here?
Sorry, can you just introduce yourself, please, name, and I can't see from here.
Yeah, my name is Jashan.
Jashan.
Jashan Tiwari.
Okay. And the question is to
Everyone.
everyone.
I mean,
Okay.
anyone who
Okay.
likes to take it.
So, if I have to rephrase, you ask your question is that is the customer mature enough to understand the digital flow and the ownership and the other aspect of neo-banking? Is that the question?
I mean, can a user actually trust a bank that does not have a physical branch over here?
Okay.
This will be a point of view actually, but we all know that the growth in banking is going to come from rural hinterlands in India, and this is true for many of the banks that are seeing big growth coming from rural. And that's one of the reasons that we are also pushing along with the branches. So we are just not making digital, because when it comes to trusting your money, you will not be able to put money into your mobile phone, which goes into a cloud and it sits somewhere. You need to know where to go, whom to catch to get your money back. And that trust comes in over a period of time. So digital brands will have to really work hard to build that trust. And therefore, you will need some kind of an on-ground presence to drive digital as well.
I think, yeah, I agree with what Anjani says. I think and I think that's probably why most of us are, at least Federal Bank is, and the other banks are committed to saying that this will be a partnership model. I think there is merit in both the physical presence, giving it a brand identity, and the digital brand building its own set of awareness, you know.
So that's where it's important for fintechs to partner with the bank, because at many times, like for example, when it's a Jupiter powered by a federal bank, it actually, the brand value of federal can be used to build that trust among the consumers rather than a bank which is like not really known to the customers.
Okay. Thank you. That
Right.
was useful.
Thank you so much. Thank you
Thank
so
you
much
very
to the
much.
panel.
Thank you.
Let's have a round of applause for them,
Thank
everyone.
you very much. Thanks, Jatin. Thanks.
Thank you, sir.
We will be starting with the next session immediately. So if you'd like to attend that, we request you to kindly remain seated with your headphones on as we set up the stage for the next panel discussion on liberalizing cross-border payments. But before we introduce the session and the speakers, we'd like to thank our partners, our platinum partners, Google Pay, Phone Pay, Visa, M2P Fintech, MasterCard, and Falcon, and our registration partner, Entity Data Payment Services. I'll do that. Thank you. और पुश करो 7 उधर वाला और पुश करो उधर या फिर हाँ ये उधर रख दो और एक Can we have the hall PA for a second, please? Check, check. Hall PA. Check. Okay. Right. Sorry. No. But you'll have to wear the headphone to be able to hear yourself. That's on. That's on. Check. Yeah, everybody on stage able to hear me? Yes?
Yes.
Okay. All right, so everyone, may we request everyone to please wear your headphones. Welcome to the next session, which is a panel discussion on liberalizing cross-border payments. Our moderator for this session is Mr. Rajesh Desai, Director at Lyra Network, and our panelists for this session, Riju Datta, Co-founder Cash Free Payments, Somnath Mukherjee, AVP Business at Zerodha, Anthony Petrelli, CEO of ViewTrade, Ronit Kar, Head of International Stocks at Grow, Vikram Shah, CEO and co-founder at Vested Finance, and Prakash Venkatramani, Senior Director, Global Payments, India, Flywire. We begin with the panel discussion, and over to you, sir.
Yeah, thank you for the introduction. Ladies and gentlemen, thank you so much for coming over here. It's very bad and hard traffic outside, but I'm happy I can see a lot of faces out here. Thank you so much for coming over here. Thank you to all the panelists, Anthony, Riju, Ronit, Prakash, Somnath, Viram. Thank you so much for being here. I'm sure this is going to be a very interesting session and intellectually stimulating session as well. I look forward for some spirited discussion and some great thoughts, views from your side. Right? Thank you so much. If I can set the context and if I can set the tone for this session, for this discussion, India has the world's largest diaspora. You know, there are about 32 million of NRIs and OCIs who reside out of India, which technically means India is the largest nation of receiving remittances globally. You know, if you look at World Bank, it states in 2021, India received US dollars 87 billion, which actually translates into a multi-billion dollar industry for India. You know? And for every developing economy like India, I think remittances inward, outward plays a very, very important critical role, right? So before we get into this intense discussion, maybe I can ask all the panelists out here, all the 6 panelists out here, to share some opening thoughts, probably some thoughts on what has transpired or what has changed in the last coming years in terms of cross-border remittances. Maybe you can start first, yeah.
Sure. Hi, this is Riju. So I think, so I'm from Cashpay and we're a payment aggregator. What has changed over the last, let's say 2 or 3 years, what we have seen, and it goes with the topic of the conversation, like liberalizing cross-border remittances, right? So what we have seen is the regulator, I think, has been more pushing for involvement of other fintech players or financial service providers in the traditionally very tightly regulated regulant space, cross-border remittance space. So earlier you had only AD1s or AD2s who were authorized to do these transactions, and that is still the case. Only AD1s and AD2s can do that, the authorized dealers. But right now I think there is paths the regulator is allowing or encouraging fintech players to partner with these regulated entities like AD1s and AD2s and provide services which make it easier for making these cross-border remittances. And the ease comes in the form of much lower costs, faster movement of money, and also the documentation that is associated with cross-border remittances, right? Since it's international transactions, there is more compliance as compared to a traditional domestic transaction. So I think the documentation is becoming digital, and that is a very key process that is change that is happening over the last 3-4 years. So yeah, based on that, and I think all of the panelists here are probably have some use cases which involves Indians sending money outside the country and vice versa, and I think we can also.
Yeah, thanks Rajesh for having me here. Privilege and an honor to be part of the session with esteemed panelists. I think purely from a cross-border remittance perspective, I generally see that as India is becoming a larger economy, the activity around cross-border remittances has increased manifold. Everybody knows that India is one of the largest market in terms of inward remittances, typically in the top 3, with China and Philippines being there in those ranks, and India receives roughly about $80 billion inward. What's interesting that has happened is the activity around outward remittances in India. So with the economy growing, over the last 4-5 years, you see activity around outward remittances, which earlier used to only happen probably around education. Now you see activity around Indians buying property abroad, Indians investing in stocks abroad. Money money moving from India to a close relative abroad. And
what happens is that this economic activity is highly underrated, because what I feel is that in a lot of ways, cross-border remittances is connected to, it's actually a forerunner to economic development, because you have Indians who are who want to immigrate abroad. There are Indians who want to go abroad for education. They go there, they become white collar workers and blue collar workers, and they are the ones who are sending money back into India. And in a lot of ways, that's super important for India, because that's the money which is being used for economic activity in India.
Great, thank you.
Nice to be here. And hi, I'm Viram. So for us, I mean, we started our journey as an investment platform, and then along the way were forced to become a cross-border payments provider as well, because there was no solution. And like it was mentioned earlier, right, we work in the outward remittance space. And so as we've solved this over time, we've developed some understanding of how cross-border works. And you can break it down pretty much into two large buckets, which is outward and inward, right? And so inward has been largely solved. Outward, though, is something that is a big opportunity. And the way we look at it is kind of three buckets, which is three axes in which there needs to be improvement. One is time for the transaction to take place. Second is cost. How much does a customer need to pay? And then the third is the effort required, right? How many steps do you need to take to be able to transact internationally and send your money outward, right? And so within outward, you have current account, the way RBI looks at it, which is education, travel. All of these are decent. So from a business standpoint or opportunity standpoint, there's like a 2x, 3x improvement opportunity along these three axes of time, cost, and effort. The bigger opportunity is on the capital account, the way RBI looks at it, which is your investments, which is moving money into bank accounts internationally, all of those things, right? And so that's where we've been operating. When we started the Vested journey, I remember the first brokerage account, my own brokerage account that I opened, I had to go to a Axis Bank branch in like the rainy weather in Mumbai, fill up 5 forms, which are 10 pages long, pay 3,000 rupees. It took 3 days for the money to come in. From there to now, in terms of international investing, money comes in instantly with no fixed fee, and the effort taken is just 3 steps, right? So all online. So that's been a massive improvement, and I think there is another 5-10x improvement that will come in over the next few years as sort of multiple players look to improve the ecosystem, right, and look to provide more investment opportunities internationally.
Thank you,
Viram. Hi everyone, my name is Ronit, and thank you Rajesh for hosting us today. My fellow panelists has already summarized, some of the directions at which the fintech industry on the LRS side, and also the LRS system improvisation that has been happening over the past couple of years has been happening. So one thing that from my perception or from the learnings that we have seen so far is with the enhanced processing of remittances, be it inward, be it outward, process, cost, we see, or we expect, and rather expectation, we see a lot of retailers' participation coming into picture. So far, it's been like, deep ticket size, bigger institutes, doing their remittances via banks or say via any other channel partners, interfaces, etc. Now, with investments and broader use case of remittances, we see retail participation supporting that ecosystem all in all. And this is where a business growth lies. And this is where a business growth in terms of overall remittances as a business and overall, a Forex business lies for fintech players like anybody out here in the country today. And in order to make this, or in order to take this in the next phase, obviously there are participants like the bank, the payment aggregator, payment gateways, the platforms who are providing the end user support, and obviously the customers. So we got to build a bridge which is very seamless, be it for any reasons, right? It is just not just for an investment space or for education, but yes, all in all, it's like, whenever there's an investment happening outside and inside of the retail or the institutional working space, it has to be very seamless and very cost effective. And that's the direction that I think most of us are working towards.
Thank you, Ronnie. Somnath, your thoughts?
Hey, happy to be here today. I'm Somnath from Zerodha. And this last 6 years that I've been tracking this space, I've seen a lot of changes that have come in. especially in the the remittance, the outward remittance side of things. Like 6 years back, if I had to see the RBI regulations on what would guide us for LRS guidelines, it was just that one line that was there, the limit, and there was I think one FAQ with a few do's and don'ts. But now through the years, I think about a month back, RBI revamped the ODI regulations after about 20-30 years. Also, RBI is kind of encouraging startups to kind of provide solutions in this space. They had this regulatory sandbox where there were multiple cohorts providing solutions in the space. There's also the gift city, which has come up, like a separate jurisdiction, which is encouraging only, kind of encouraging this, whether it's inbound and outward. So yeah, a lot of things happening. Plus Indians, they're probably spending the highest amounts of money when it comes to travel, education, investing. So yeah, a lot of changes that I've seen personally in this space.
Great. Tony, your thoughts?
Yes, I'm Tony from ViewTrade, and I represent the receiver side of the cross-border remittance. And one of the things to always bear in mind, and sometimes it's forgotten when you're looking in-country only for solutions, is cross-border by definitions means your partner on the other side. And we have the same issues, many of the same issues and concerns that we have to address. We're regulated in terms of receiving money from an investment or a brokerage perspective. We have to have many of the same issues that are trying to be addressed here. We have to address and coordinating that and having partners that we can work with to coordinate those efforts and making sure all our needs are being addressed. And doing it, as was said very well, cost effectively, instant, and seamless as possible is critical. And some of those things that in fact have begun, we're seeing that here from India. India's been a huge market, small opportunity because of the friction that's been involved in trying to bring money to the United States for investment purposes. Some of these efforts that have just been mentioned here is exactly what we're hoping to see. And we want to be a participant in helping that happen.
Thank you so much. I mean, it always feels, we are very proud when we see a set of panelists, who come from diverse backgrounds, probably from the same background, but then they have a common objective of having a very secure, streamlined future for the future, platform for the future, which is very efficient. I mean, that's what we are narrowing towards. So without much further ado, let me pose the first question to Riju. Riju, I mean, what do you think are the current challenges in the current landscape when it comes to cross-border payments?
Got it. Yeah, so I think, as I said, right, like the challenges are the ones that we're trying to solve, I think, and some of them were already mentioned, right? So one of the first challenges that came in processing LRS payments was that you only had to do that through the bank. And what that usually meant was, and this especially holds true for capital account transactions under the LRS, which is, investing in stocks and all, right, similar stocks, securities, and other assets. So there I think you have to go to the bank, which usually involves a paper form, and sometimes the bank comes up at your doorstep. The mode of transaction can only be a SWIFT, and it's a one-off transaction, right? So the costs associated are much higher. So let's say if you are trying to invest in a stock, it's very difficult for someone to invest 1,000 rupees, 2,000 rupees, right? Because the processing cost itself is maybe 2,000 rupees at least. Right, so that is one of the major challenges that is there. Then the documentation that is there was digital, was not digital, right? And hence all the paper signing that had to happen, and also the money, usually took much longer to kind of reach the destination, right? And reflect in your account and be available to invest in an actual stock. So that is a very specific one to LRS capital transactions that has been there. So the big change there, as I think the sandbox was also mentioned, right? So so RBI gave out, was pretty open to the idea of if an aggregator, being able to process these LRS capital transactions and kind of being able to achieve efficiencies in the documentation. For example, in documentation we are exploring a CKYC kind of a flow, which is supposed to be a pretty the most advanced of all the KYC flows for documentation, and it's a bulk aggregated kind of a settlement, so you save immensely on cost, right? It can be more than 50% lesser than what we are paying now, probably even more, and so even on the FX as well. right? And then the speed of settlement is next day. We're trying to get it down to the same day, right? So that's like a gist of the challenges, and it's the same kind of trend in LRS capital as well as current accounts, right? Current is majorly travel and education. So just to give a number, right, it's $20 billion or $24 billion annually. That's the processing volume of LRS payments, and around 30% each is education and travel, and they're the two largest segments, and growing around 20% annually for the last five years, right? So that's a sense of the market. And LRS capital, I think we have a lot of players from that, is around 5% of this, but it is the fastest growing one. So I think in the last 1 or 2 years it has grown 340%, and the pandemic has to do with that. But yeah, I think it's the fastest growing one, so that's just a sense, right?
Right, I agree. While the quantum of remittance, depends upon a lot of multiple factors, but then cost becomes a very key element, So my question to Ronit probably is around this. So what do you do to take this to the next level now? I'm sure there's a lot of scope for improvement in terms of speed, in terms of cost, but what do you do to take it to the next level?
Right. So, so just like Riju has mentioned, there are layers from starting from a customer level when he initiates the transaction, the cost level that comes at a banking level, and then obviously at a clearing side when the funds are actually out of the country, and then obviously at the receiving side of the US counterpart, for be it any reason. So the way I see it is, it has to be in a more in a more process-wise journey. First, you need to kind of automate the process. So when I talk about automation, the process, these are the checks that is being done at a bank level to understand whether whether is this customer genuine, the source of funds, proof of funds, or if there's any kind of account inactivity with respect to the funds, etc., that typically an AD bank does. So that process has to be automated as a step one, and we see industry taking the steps towards that direction. And then secondly is like pooling the funds instead of doing a direct one-on-one SWIFT transaction or which ideally incurs the direct charges onto the customer. It's better to pool the funds, as long as of course there is reporting challenges which also needs to be addressed, and all these things has to be addressed together. It's not that it's just one entity doing it. So obviously RBI as a whole will bless the process when we are following the correct protocol, whether we are pooling the funds, remitting outside, be it for any process, be it for any source code. But as long as we are able to put these puzzles in its places, right? Starting from acquiring the information, KYC part of the customers, to the bank account analysis part of the customer, sending it to the banks for processing it, enabling the banks to make sure they have an automated process to manage scale. So when we think, when we think of growth as a business, we always think of scale. So is the current ecosystem ready for that scale or not? And if suppose it is not, what needs to be done to reach that X+1 or X+N kind of scale? So process automation, cost control, and a user experience is something that needs to be done starting from the fintech level as a platform to the aggregators or to the statement providers, to the banks, and at the end to the US receiving end. So it's a work in process. I see a lot of people doing it, and there are many people over here who are part of the ecosystem. It's just matter of time that we are kind of democratizing it in a more broader way, instead of just keeping it a niche. So that's the bigger picture that all of us are seeing, and I think it's just about time that we reach there.
Okay, thank you so much. So let me shift the discussion a bit towards regulatory developments. Somnath, my question to you would be, what can the government do in terms of regulatory developments, in order to cost optimize it or to make it more convenient in terms of outward as well as inward remittances?
Right. So I think there are two aspects to kind of making this go to the next level. I think one is what Ronit mentioned on the costs, the process, that side of things, and I think RBI has come a long way in solving that. I think one side is the regulatory side, which is kind of not clear yet. I think one clear guidance needs to come from RBI, because they're kind of the controller for remittances, and one maybe from SEBI also, because they're the ones looking at investments and asset classes and around that aspect. So I think one thing from RBI, even though the encouraging, bringing this cohort, enabling this mode of collection of pool account and then kind of remitting it kind of has reduced costs. But on ground, we still see banks, are kind of scared to market these services because, marketing services to easily kind of enable outward remittance is something which a lot of countries don't look, positively about. Like say China has kind of curbed a lot of things. India also, we don't know the clear stance of what RBI thinks. 2 weeks back, we saw this video from Miss Madhabi Puribach from SEBI. She came out and gave out, a clear guidance on how brokers and SEBI intermediaries should look at futures and options. So, it's not like a written code that they came out with, but at least that clear thought process on how businesses should align when it comes to such a vertical. We at least got that. So I think something like that from RBI needs to come so that, currently the LRS is at 250K per year, $250,000. So if they say up to $100,000, we won't, bat an eyelid. You can do, clients can do whatever they want. Banks can market their services. But up to 100,000, if the source of funds are okay, if everything's okay, you can do whatever. If something like that comes, it becomes easier for the banks also, I think, to kind of partner with other players and, bring out like a clear picture. Another thing is from the SEBI side again is, we're a regulated broker. So what can brokers provide, like, maybe some platform guidelines or, referral guidelines on, whether whether, say, international investing can be made easy for regulated brokers? Because if you see the last 1-2 years, there have been a lot of negative sort of vibes when it comes to brokers enabling other sort of products. Especially, recently they came out with guidelines like if you have an associate NBFC, you can't promote lending against shares also for a broker. Last year, digital gold was kind of taken away, whether cryptocurrency can be sold or not. Brokers are kind of losing out on, such unregulated plays. Even last year, actually, mutual funds were kind of stopped to take international funds in the international schemes because there was some threshold from RBI which the whole industry had hit. All international schemes had to be stopped by AMCs. So things like that are not allowing us to be clear in our stance also. So I think that's something, like a guidance needs to be provided.
Okay, sounds great. Prakash, now with central bank allowing third-party entities to become a part of the customer-facing, leg on the floor, how do you think fintechs and financial institutes should revamp the way technology is to be used?
Yeah. So, taking just 5 steps back, so India has always been traditionally seen as a fairly regulated market when it comes to cross-border payments. So, and not as regulated as China, where you only have to use Alipay or WeChat Pay to collect funds, but still reasonably regulated. Now, that started changing with RBI setting up cohorts to experiment on the cross-border payment space. And a lot of those cohorts actually moved on to an approval from Reserve Bank of India to make that product live, which is, I think, has been a very, very future-looking decision and direction by the Reserve Bank of India. Now, because you have already started seeing the results of it, and there is products being created as we speak. Now, at this point in time, I feel that positive direction has gone to a level where fintechs and payment companies have taken cognizance of the fact that this probably might be the UPI moment in cross-border payments. I am saying this because, similar thing happened in UK and Europe some time back when there was a Payment Service Directive 4, which was sort of, which was put in place. And that led to a plethora of activities around open banking. So in UK, if you ask me, post the PSD4, there was a bunch of fintechs who could use an API stack of the large banks in UK, like the Barclays or the HSBCs of the world, and create their own products. I see a similar thing happening around cross-border payments in India. I see fintechs, payment companies working very closely with the banks and moving that tech stack that they have built in two major directions. There is money going out of the country. So there's, at the end of the day, there is money in India, which is going to US or Canada or Australia, whatever destination that you might have in mind. How do you make that simpler, easier? Yeah. So you at the end of that stack, there might be a large regulated entity, which might be a bank, but as a fintech and a payment company, you are probably creating a product which is going to make that payment experience much more smoother. So that is one direction that I see, where companies are going to invest their tech stack in building a far smoother journey. 4 clicks and your transaction is done. Now, we are slightly away from that, but I think companies would start putting their stack together in that direction. So that's one part of it. The other, which has always been a bone of contention in cross-border payments, is the KYC element. Now, we have strong directions from RBI as to what the KYC checks need to be. So, because a lot of fintechs work with banks who are regulated entities, they are supposed to do a part of the KYC, and the banks also have to do a KYC. Yeah. And the other part of that tech stack that, I see payment companies focus on is how easily and quickly you are doing this KYC checks. Because one is you've built the fantastic customer experience and you merge that with a fantastic low-touch KYC check process, and you have got a brilliant product. I see a lot of payment companies, players in the ecosystem doing that right now.
Great, sounds good, Prakash. Let me come to you, Anthony. I mean, you have a different background and different perspective, but I guess you're different from the rest. You represent the US brokers and the technology service providers receiving remittances. I think the audience will love to hear from you in terms of what are the historical challenges you have been facing to support Indian investors who want to invest in the United States.
Yeah, thank you. I mean, the classic way to phrase it, if anyone in this audience wants to invest $100 in Apple, wouldn't you like to see $100 show up in your US brokerage account to buy Apple? Yeah, the answer is yes. The answer is that's not going to happen. And the biggest problem in this process has been not the technology that these brokers have or that are available to brokers globally, quite frankly, worldwide. We all know how to do digital things. We know how to use technology to make things efficient. It's the cross-border payment where the problem has been. And so what happens today is, yes, you're going to pay a $15 SWIFT fee on this side. You'll pay a bank service charge on this side. So now let's assume your $100 is now $75. Money shows up in the US. Guess what I have to pay? $10 for the SWIFT to receive the SWIFT wire. I got to then pay for a KYC check. Come on. I mean, so what ends up happening is, and this is why I said, huge market, small opportunity, because you as an investor are smart. You're not looking to have $100 turn into a $30 cost, which equals a $30 loss before you even begin investing. You're not going to do that, right? And that has to go to zero, right? We can't, and by the way, the FX, okay? But let's assume the FX is always going to be there, and that really, probably is the element that should be the cost of a cross-border payment is the FX element, but that should be as tight as possible as well. But all these other fees are due to friction, due to, I'll say, business models of banks and others that have taken advantage of it. And my view is make it smaller, you're going to get more volume for sure. I think there's always the desire to invest globally. It does exist. We see it everywhere else. I mean, India is unique because of the size of the investment. I mean, the typical order we would see coming from overseas, our clients overseas today, $20,000, $15,000 per order type of thing. I mean, but from India, it's probably going to be $100, $200, $300 per order. You can't afford the built-in costs. So the sandbox was a critical thing, being able to eliminate sending individual wires, which means individual SWIFT messages that both sides are paying for, turning it into a bulk payment. That's all recent, allowing us to digitize the whole process. I mean, I'll give you another example on the US side. If we receive a wire, sometimes we don't know where to post it. Who sent the wire? Because the information doesn't contain the brokerage account, right? We ask for it. There's a field for it. Very often it's sometimes not filled. So then what do? I got to look at a name and an address. So what does that mean? I got to have a person. I mean, so you can just imagine how difficult it's been to try to bring money into the United States, an Indian resident wanting to send money to the US, invest it, it turns into where at the end of the day, the cost of opening the account versus the number that got funded, 10%, meaning we paid all the costs associated with opening the account, let's say 100 accounts, then they go and try to do the movement of funds, they realize how much it costs to move the money, they drop the funding, which means the account is now, we've incurred the account opening cost, but we're not receiving the funds. So what we call the funding ratio is very, very low. That's going to change with a lot of the things that are happening here in this process. So look, at the end of the day, if you ask me to dream, because I think it's a dream, what could help governments how many times do you need to be identified for the very same transaction by how many different people? The government should figure out, regulators, how do we create a single transaction, a single verification, trust what the Indian regulator has done or what the firm in India has done, right, in terms of verifying who you are, and let that pass all the way through to the United States. Don't have the same transaction occur, another cost and another cost just to say, who is Tony? Is Tony a good guy? Should we be sending the money and should we be receiving the money? So those are dreams, and maybe, but that would be wonderful if, because you asked that question earlier to one of the other panelists, can governments just get together and what's the purpose here? This individual who's a resident of this country has been identified as a good sender of money to the United States for investing. That's it. He's been identified. Let's all accept that, and we allow and take those costs out of the process and let them have $100 show up in their account in the United States. That would be the ideal.
So in short, dreams turn to reality when you have costs, convenience, and taken care of.
Absolutely.
Great.
It's all possible. It's just the will to do it.
We'll see. Time will come. My next question to you, Viram. I just mentioned earlier that India is the largest recipient of remittances. But when you look at statistics, outward remittances are absolutely not at par with them. What do you think are the critical reasons for the same? And if this opportunity of outward remittances needs to be converted to a potential opportunity for global companies, what is your suggestion on that?
Yeah, thanks. So, I mean, for context today, inward is, I think, 87 billion, right? And outward is 20 billion. So 1/4 is where we are at in terms of outward versus inward. If you ask me, I don't think that trend is ever going to change. I mean, structurally, if you look at it, we talked about the number of expats, right? About 30 million expats. I think amongst that, half of it is NRIs. So 13, 14 million is NRIs. Now, 30 million is likely the same number of people in India also that will remit abroad, right? That's the number of people who have credit cards, taxpayers, etc. So that's kind of the remittance market that you look at. And now, if you look at the amount that people have in terms of income abroad versus the same 30 million here, it's almost 3 to 4 times abroad, right? So it's very, very unlikely that the 30 million that's remitting outside is going to be able to remit the same amount as it's coming in. That's one thing. The other thing is also, if you look at outward needs, today it's driven by one-off needs. So today it's driven by education and travel primarily. Whereas the inward is more a recurring income that comes in, right? Somebody's making money, they're sending money back to their family and friends. So it's likely to happen over 10, 15 years. Whereas I'm traveling once or twice in a year, or I'm studying for 3 or 4 years. After that, the outward doesn't happen, right? So because of this, it's unlikely that it's going to change, and it's good, right? That like India benefits from that for their balance of payments. So while both might increase, it's not necessary that outward will become close to inward. I think one trend though that we see will likely play out, and what we see is essentially right now all of the outward has been consumption driven. It's been travel, it's been education. So those have been the two primary, and I think there is gifting also. Those two, though travel and education, have been the primary sources for sending money abroad. I think that trend will shift to becoming more consumption plus investments. I think that is something that over the next 5 years will play out. It played out in China actually. You see 2 massive companies actually that have come up in terms of Chinese investors investing internationally. And so in India, that's likely also to play out, and that will increase the outward volumes. That will make it more recurring as well, because you might do, let's say, an SIP or things like that when you're investing internationally. But unlikely that they'll come up to the same volume.
Brilliant. Thank you so much. Riju, my next question to you. There have been so many initiatives, new initiatives being taken by various bodies to broaden this entire landscape when it comes to cross-border payments. RBI has just announced that an NRI can do bill payments using BBPS. That's one initiative. Then you have the initiative of the LRS, the Liberalized Remittance Scheme. Then you also had the government of India along with Lyra Network, that's where I am associated with, taking UPI to Europe. We have taken that to France. So with so many initiatives being taken to broaden this entire landscape, do you think that this opens floodgates for players who are in this line of business, for fintechs, financial institutes, and maybe businesses who deal in this cross-border payments?
Yeah, I mean, definitely, right? And that's, I think, the gist of the discussion, right? I think Prakash made a point about the UPI movement for cross-border, right? And how that would look like probably is, let's say, for one, we have Zerodha and Grow here maybe, and everyone else. So I think, like, it would be very easy to, let's say, invest in stocks on multiple apps, right? Multiple fintech apps, I think, right? So that would be one. Secondly, it could be very easy to make, let's say, these cross-border remittances from any kind of third-party app, even WhatsApp for that matter, right? So that's what a UPI moment would look like, right? And what we are trying to solve here today is like, you would have to do a KYC for each payment, right? So just imagine you're doing scanning a UPI QR code and, trying to enter your KYC each time. So that's friction, right? So how do we try to solve that? Yeah, so those are some of the challenges I think we have discussed, right? And like, for instance, one of the ways we try to do it is, make the KYC at a per user level, right? And then not every time you do a transaction. So, right, so that for a repeat transaction, you don't have to, make the KYC every time, apart from, a more digital KYC process, right? So yeah, so that is an example. But yeah, I think to answer the question, right, there is a lot of opportunity, a lot of regulatory tailwind. Fintech players in India, I think, since they have, experienced the Indian market, which is highly innovative and very competitive, I think they're also, prepared. And we have seen a lot of companies, exploring markets outside of India to take the products that they've developed in India. So that's a take, I would say.
Right.
But like just one point, like I think we also need to be kind of wary of the guardrails here, right? Because there's a lot of talk about liberalization, right? But I think the guardrails need to be, in place or in check. And for us, like for LRS in particular, that is the $250K limit that is sacrosanct, right? So I think one of the biggest checks that happens is, is that limit hit or not? So that's where a lot of efforts goes in. So yeah, as system players, I think we have to ensure that, those checks and balances are maintained, right? So that's important, I think.
You have pros and cons everywhere, but I'm sure that with these new improvisations, it will only lead to acceleration of this in this entire landscape. Somnath, I would like to pose the next question to you. Reserve Bank of India intends to roll out the equivalent of a digital currency, rupee, right? Equivalent of that, which is basically India's own digital currency. Of course, this will give a big boost to India's digital economy. But then do you think that this currency will affect costs when it comes to cross-border payments?
So I'm not really sure actually. So I think this would probably help in inclusion, formalizing the economy. In those aspects, it will definitely help a lot. But when it comes to reducing costs for remittance, I think the current cohort which has got passed, I think that itself is going to reduce the costs a lot. And I think more than that, it might not really encourage banks also to participate because they also need an incentive to kind of bring that into play. So I think lower than this would be kind of really low for, kind of bringing more participants into this. So I'm not really sure how much cost it would reduce. I think we're already going quite low if this kind of passes. So yeah, I think it would really help on the inclusion and the formalizing aspect of the domestic economy more than anything around cross-border remittances.
Okay. Let's hope for the best.
Yeah.
That's what we can say. Ronit, when we speak of mutual funds or trades, you see a lot of restrictions there, and some significant amount of hesitation when it comes to this. What steps do you think that the government of India should take in order to ease out this entire pain?
So of course, the biggest thing is compliance, overall compliance in terms of handling the transaction, handling the settlement, handling the clearing, and the KYC. That we've been initiating a lot. So, like when there was a $7 billion mutual fund breach that happened, I think back last year, and that itself shows the intent of investors looking to diversify their products or their portfolio outside of the country to have a more balanced investments, and that's the sense that we have been picking up from the market as well. Be it mutual funds, be it stocks, be it any sort of instruments, ETFs, etc. Diversification has come as a basic need of investing or a financial support system in the country for us. So I mean, it's basically not keeping the eggs in the same basket. You're just diversifying. So in order to get to that foreign access, or in order to have that similar kind of experience, so right now any Indian investor who wishes to invest in stocks, MFs, they directly just do it in like couple of clicks. You just search for the instrument, you just pick the quantity, or you pick the volume, and that's it, it's done. Just 2 clicks and you're done. You want to fund your wallet, you have the UPI mechanism over there, you have the net banking mechanism over there. So it's hardly a matter of 3 to 5 clicks, and that is what has been evolving the market. And the local governance has been supporting this infrastructure in building the local or the domestic market in terms of volume, in terms of market participation from customers, not just a DIY or institutional, but also from retail customers. So this is, it's the same basis or the foundation of the governance that needs to be applied on remittances side as well. So I think we have covered most of the touch points where it is critical. But yes, when it comes to investments in foreign stocks, equities, we can see the regulators and government together coming in and supporting in this initiative. Gift City being the one, recent aspect where any foreign institutions can set up any local institutions who wishes to offer retail clients access to foreign equities. It is more governance. So as a business or as a regulated entity, let's put it from a regulatory side. As a regulated entity, anybody who's regulated either with SEBI or with RBI on any kind of capacity, they're more confident working under those jurisdictions. And from there you start building, right? You start building. The foundation is there. Now you start building. Okay, so now I want to offer my clients, say, a diversification to US stocks. I start off with that. Then I say I want to offer my clients a diversification to other equities, right? So you have exchanges over there working with participants like fintechs who are offering platforms, or any broker dealer in India who is currently offering products in the domestic region. So from a diversification point of view, from a global access point of view, I definitely see the blessings of the regulator and the government together in one way or the other. Cohort, Gift City, and then automation, account aggregator. I would say that's again a big, it's a big pointer, or it's a big contribution to the network. If I have to kind of pass an amount, if I have to say transfer, say X dollars to from my account to any third-party account outside of the country, instead of downloading the account statements, doing a mechanical checks, which itself can be tampered with. Right? So it's not full-fledged solution. So account aggregator kind of is one of those bridge that connects data. Right. So there's a data blessing also on the compliance part that is being widely accepted on the entity basis, be it bank, be it any institution, regulated institution. So all these things coming together is kind of building that basket that we are looking at. It's kind of contributing to that diversification that our customers or any customers are, a normal retail and normal Indian resident is looking to diversify. And in doing so, they are comfortable. Okay, this is regulated, or this has the blessing of the government, or this has the regulator blessing. Basically, it's not in the gray region, unlike what gold we have seen and for some other products. So that gives a lot of comfortness, and that is a direction in which the next initiatives have been taken, and I'm sure it's moving at a more rapid pace than we are thinking about.
Yeah, I'm sure these are great insights and views from all the panels. Viram, if I come to you, Reserve Bank of India, RBI, and the Ministry of Finance, they are pushing trade bodies to push cross-border rupee, cross-border rupee trade. What do you think? Where do you think this is heading? Is this a step towards internationalization of currency, the Indian currency?
I think I have a short answer to that. To me, it feels like it's more an opportunistic kind of bet, where if you want to protect your currency, and in today's environment, they have a unique opportunity to do trade with certain countries where the traditional payment networks are not working. And so this is an opportunity for you to grow demand for the rupee across the world. Overall, if you look at internationalization, I mean, as much as we would want it as fintechs, it would simplify all our lives. I think it's a long way to go. There are multiple factors that need to be considered if you completely let go of capital controls, right, in India. And does the regulator or the government have the incentive to do that? Like, what if it backfires, then who is going to be left holding the ball, right? So it's a tough call, which I don't think is going to be made anytime soon. But right now, this is a good step in that direction to essentially plug in sort of some of the weaknesses that we have in the economy, right, by promoting rupee trade.
I would love to see cross-border rupee trade happening in. I mean, it is probably a game changer for India as well. I'm sure of that. Prakash, pandemic is something which everybody speaks of, and pandemic has changed the way things have worked out, has changed how we live, Has it in any way impacted, or is there a post-pandemic impact on cross-border remittances?
Yeah. On a lighter note, the first thing that happened after the pandemic is, regulated entities started using this organization called DocuSign in a very, very big way. But the more important bit is, I saw a lot of direction towards digitization in multiple ways. There would be legacy regulated entities who were traditionally acquiring customers in a very brick and mortar way, and they started thinking digital. How do we sort of build a model where probably the acquiring bit of the transaction can happen online and the servicing is still back end, I saw that omni-channel model getting set up in India. I saw a lot of use cases around it. I've seen regulated entities who've been fairly archaic in the way they have acquired customers, changing that stance into acquiring customers through social media, digital channels like search, all of that. So that was one thing which has happened. The other thing that I've seen happening is, especially when in case of foreign exchange and cross-border remittances, there was a service center model which started cropping up. I wouldn't call that as a customer support or call center sort of approach, simply because these service excellence centers were critically supporting payments and transactions at a fundamental level. So there would be a transaction which would have got acquired at a digital level where probably he has completed about 60% of the transaction, whether INR part has come in, a certain degree of KYC checks has been done, all of that, but there is still 20-30% which is left, and these can be very, very large transactions, especially since I work in the education payment space. These transactions can be $60,000-$70,000, right? And I saw that movement within the payment companies where they started investing in these service excellence centers, because that probably would mean that if your completion rates are like 30%, it would probably move to about 70-75%. And sometimes when we talk about business and we talk about business models which are getting set up, we try to we don't probably give due importance to these service excellence centers because they're the ones who are at the back end trying to support transaction. But I saw this movement towards getting that basic fundamental support going into a service excellence center model. So that's the other bit that I saw. The last bit is the sheer innovation which happened post the pandemic. So I remember a friend of mine who set up an NBFC and he was focused in lending and BNPL. He saw this opportunity to tie up with educational institutes abroad. And because he saw there is a massive demand cropping up on online education, right? And he actually went across to education, and he's actually recently got a Series B done, and he actually went to multiple geographies, tied up with universities, and started creating product which was around BNPL. So there would be consumption that a student would enroll for a course and he would be funding that education through the BNPL model. Not only did he do that, he actually went into details of how he would settle the funds to the university. And that's where the conversation happened between me and him. And there would be a funding which would be done by the NBFC, and there would be a cross-border payment. So he created this entire model starting from offering, getting into the universities, creating a product, creating a BNPL product, and going to the end part of, solving for the cross-border remittance as well. So that was, so I saw that innovation happening. I saw a lot of innovation happening even in things like how taxes are collected on transaction. India is a well-taxed country that way, and cross-border remittances attract something called a tax collected at source and tax deducted at source, GST, all of that, right? And I saw companies, and that's a fairly decent component when you are sending, say, $20,000 or $30,000. I saw companies and fintechs and payment companies sit with their teams to see how fundamentally they will collect these taxes and how they would probably pay to the government. I saw a lot of innovation happening there, so which was heartening to see. Not many people talk about taxes and how complicated they are in India, and so I saw a lot of innovation around it. I don't know how many of us probably know there is this category of visa called EB-5 where you invest in a company in US and over a period of time your family gets naturalized to a US citizenship, and you need to actually send about $300,000 for that, and the limit in India is $250,000. I saw companies create products where $300,000 could be split between families, and these transactions could be executed. So that's the level of innovation which came about due to the pandemic.
Great, sounds great. As we come towards the end of our session, I think the last question, last but not least, to Anthony. Now, so this liberalization, how do you think has helped you in terms of making it easier for you to do cross-border remittances? And what do you think are the next steps putting forward?
I mean, many of the things we've talked about. I have to say, what's been happening recently, is particularly recently as the sandbox, is all positive. It's making things modern, if I can say that, right? So, look, at the end of the day, everyone on this panel solves problems. That's what a business by definition is, a problem solver. That's what we do for a living. We identify an issue, we fix the issue, we innovate, right, to solve these issues. We're good at that as a group. I'm not saying us, I'm saying all of us. Anyone who's an entrepreneur, anyone who's trying to solve problems, is in this business of fintech, is trying to solve problems. That's the nature of our business. I would say, look, if I can recommend, when government gets together and works with the industry, yes, work with the banks, work with the incumbents, work with the innovators, bring them into the table, because they've got to all be heard. And that's one of the things that I don't think happens often enough globally. It's not unique to here, it's global. And one thing I know working globally, it's all the same. There is no real difference. It's just who's doing it and how fast it happens and how comfortable they can get, how quickly they can get comfortable with the end result. So, but all these things that are happening here are wonderful. I think it's opening up the opportunities that we all knew the demand is there. It's creating the opportunity for all of us to capture that opportunity, and at the end of the day, to benefit the Indian resident, what they're trying to accomplish. At the end of the day, that's what this is all about. And I think anyone on this panel will agree, this is about the customer. It's not about us. The customer is the beneficiary of all of these innovations, all of this progressive thinking, all this modernization that's taking place in India. And I think we're all going to be better off for it at the end.
Right, Anthony, thank you so much. And thank you so much to all the panelists for this wonderful, intense session. I'm sure the audience enjoyed it a lot. Let's hope that this development and this momentum helps to make cross-border payments more frictionless, more seamless, more cost-efficient, and make it work out the best for all of you.
And customer-friendly.
And customer-friendly, as Anthony mentioned out. Thank you so much. Thank you so much. All I can say here is that, the trajectory of cross-border payments is headed in only one direction, and that's the upward direction. I mean, that's the best for everyone. Thank you so much, ladies and gentlemen. I want a big round of applause from you for all the speakers out here. Thank you so much. Thank you.
Thank you very much to the panel. It's onwards and upwards from now. May I request everyone to please pose for a group photograph before we exit the stage. Let's have a group picture of all our panelists and our moderator before we exit. Check. PA on. 1 second. All right, may we request, check. All right, may we request everyone to kindly be seated as we get ready for the next session. May we request everyone to kindly be seated as we get ready for the next session. Check. All right, everyone on stage able to hear me? Yes? Am I audible? All right, and before we begin with this panel discussion, a quick shout out to our sponsors, our theme partner WhatsApp, co-powered by Amazon Pay, spend management partner Encash in association with Perfios, payments partner Cash Free Payments, and CEO's dinner partner HSBC. The panel discussion coming up is on the topic Millennial to Gen Z, the new battlegrounds for neobanks and fintechs. This session is being moderated by Shilpa Mankar Aluwalia, fintech partner Shardul Amarchand Mangaldas and Company, and our panelists are Fang Jiang, Principal Operations Officer and FIG Advisory at Asia Pacific International Finance Corporation, Adam Rice, CEO and founder, Asset Direct, Loan Connect, Prabhu Rangarajan, co-founder and COO of M2P Fintech, Mr. S. Anand, the founder and Chief Executive Officer of PaySprint, and Mr. Sumit Gwalani, of a co-founder of FI. Over to you for the panel discussion.
Hi. This works? Okay. Super. Good afternoon, everyone, and welcome to this session. Great to be here. Great to see all of you here. And as I'm sure all of you know, as fintech consumers, that fintech has really fundamentally changed the way we consume financial services. I mean, for all of those who have gray hair in the room, I'm sure you remember 15 years ago, looking for change or cash or coins in your wallets or bags to pay for that cab or to pay for that vada pav. All of that has completely changed. But we do have a generation of consumers that completely, missed out on this era. And when you're looking at millennials or Gen Z as a consumer segment, it's not just that they consume financial services differently, but their expectations of financial services is also completely different. And today we're going to spend the next 40 minutes talking about a space in financial services where we are seeing and we will see a lot of disruption, a lot of innovation. Digital banks or neobanks are going to, if they haven't already, and I'm sure many of my panelists will argue that yes, we're already seeing that change, fundamentally change the way we consume and see banking services. We're going to broadly touch upon 4 themes today. One is the kinds of disruption we're seeing, the kinds of target markets that neobanks or digital banks are focusing on. And when we talk about the millennials or Gen Z as a borrower segment, how are neobanks really addressing their specific needs as a unique consumer set? No conversation on fintech, I think, and being a lawyer, I have to bring in regulation and data governance as part of the conversation. And also, I think we'll end with what next. Where do we see digital banking 5 years from now? So let me start. We have a fabulous panel here, which will bring perspectives across various dimensions. Sumit, let me start with you. What are neobanks doing differently? What is the big disruption that we're seeing today?
First of all, thank you for having me here. Great to be part of this panel. I think neobanks are already, I would say, disrupting in a variety of ways today. If I have to just sort of enumerate them, right? Hyper-personalization, convenience, ease of, use with design and stuff, transparency, and, some folks wouldn't agree with this, but even security and, data privacy. Let's sort of quickly jump into each of this topic in a second. So hyper-personalization. Today, neobanks allow you to customize the app for you, right? Gone are the days where, somebody with a 50-year-old and a 20-year-old is having the same app. You can have a fully personalized app to your needs. If you need something that's designed completely for you, you can't have, in today's habits, you could have 2 people with the same age, gone to the same background, studied same where, and still, their financial habits are very different, but their financial app is same. Their banking app is same, and that's where hyper-personalization comes in, when it's literally an app built for you. Think about building a Siri or Alexa as a personal financial assistant for your finances, right? That helps you answer anything and everything about your finances, helps you go on this financial journey. In terms of convenience, right? You don't have to worry about IMPS, NEFT, RTGS. You decide whom you want to pay, and it will choose between UPI, IMPS, NEFT, and take care of that for you. Example of convenience. In terms of transparency, things are straightforward. Your terms of service is more easy to read and understand. In terms of cutting costs, right? Some of the tech also helps you to automate everything and then end up cutting costs overall, which sort of also plays a big role. And then lastly, but not the least, security, right? I want to add to that. People think about neobanks more as just better UI design, but I think it also allows us opportunity to add more layers of security than what was there. So it helps actually improve the security field and not decrease it. So that's how I would say they're innovating across the board, which ends up being a better experience of banking for the consumers, which is what we all are aiming for, right? Create an impact for our consumers.
Absolutely, and Sumit, I think you made a very important point, and that's something I believe in quite strongly. Is digital banking is not really using a different medium to deliver traditional banking products. It is a completely different ecosystem altogether. Like Sumit said, in terms of customizing financial solutions, the kind of target markets, it is a different animal altogether. Prabhu, let me bring you in. When we're talking about customer acquisition, and particularly the segments that we're talking about today, sort of the millennials, the Gen Z that have different expectations of financial services. How do neobanks, sort of use customer acquisition tools for these segments that are different from traditional banking?
Sure. Thank you, Shilpa. Thanks for having me here. So
I would rather take a step back, right? Like, for instance, when we, in our childhood, right, the conversation that we had with our parents were about how much pocket money do we need, right? And now that is now moving towards more and more digital journeys and more e-commerce purchases and stuff like that. Now it is about how do we actually, pay the pocket money, right? It's like the channel that is becoming more important. And all of us actually had a very, I would say, like a stepwise or an iterative kind of a growth pattern when it comes to we being fully physical and then now moving on to digital. We have gone through that journey, but the Gen Z and the millennials are actually jumping directly into the digital world. So the customer acquisition strategies also have to be very different. Can you bring in a neobanking experience in their tuition, in their college, in their educational system, where right from the fee payment to the way they attend classes, they like most of the kids are probably most of the kids that are there today are up like in fact they're going through courses with White Hat Junior and stuff like that, right? And many of these folks have gone through the EdTech journey as well. So the way the neobanking journeys for these folks, the way we acquire these customers will not be probably from the traditional banking channels. It will probably be from the embedded journeys, like embedded with education, embedded with sports, embedded with gaming, right? So that's where the customer acquisition targets have to move towards. And traditional journeys won't cut ties because we probably stood in a teller counter at a bank. I don't think any of the kids these days will even know where the bank branch exists, right? So that bank branch being a funnel for acquisition is gone now, right? We'll have to rethink the entire strategy. So I think embedded finance and embedded neobanking through the regular channels where these kids go to, right? That's where the acquisition game has to be played. That's my
Prabhu, and I think I agree with you. I mean, to think that the concept of bank branches could become obsolete is quite a thought. So, I'm leaving it out there for all of you to think about. But clearly, I think as opposed to sort of a push model, it's more you sort of pull people into their digital ecosystems that they're already, operating in.
Right.
Jumping to, I'm going to pull in sort of Adam and Fang into this discussion. So when you look at digital banking, and in fact, Sumit and I were talking about this earlier, is broadly, I think we've seen three business models, whether in India or globally. One is the standalone digital bank, where you have a framework, a license for digital banks to operate sort of independently as independent units. The second is the partnership model, where the neobanks or the fintech platforms who actually power a lot of the innovation partner with the traditional banks to offer innovative solutions, and that's something that we're seeing in the Indian market and ecosystem today. And the third, which I think is actually the most conservative and may not be the best to move to the next generation of innovation, is where you have digital banking units within the legacy or the more traditional banks. I think there are some challenges with that approach. But Adam, let me bring you in. I mean, what are you seeing globally? What works best? Because India is sort of, I think, starting out its journey in some sense.
Thanks, Shilpa, and thanks for having me here today. It's good to be here. So, there's digital banks that are out there that are fintechs and they're being successful, right? So you see Nubank in Brazil, over 60 million customers. They're acquiring people. They're doing things creative, as been discussed here earlier, and they're building a business. But I think as we push further, we're going to see more digitization of the banks, and the fintechs are going to have to become more than just a digital bank, right? You got these digital banks, these fintechs, these neobanks who are essentially providing digital services, and it's their own products and services that they're providing, very much like what the bank down the road offers. So it's, I think, really important that we, as neobanks or as we develop neobanks, we try to really push on some differentiation. And part of that is acquisition and really helping, certain clients access certain products, right? So you've got students. What products can you provide for students? It's also being different than what the bank has, right? If the bank down the road can develop student products as well, what makes you better? And there's a challenge there, right? Because these neobanks, they're new, they're nascent. You've got SBI, I think they have 22,000 branches or so in India. Deep pockets. People who are cash-based still, especially tier 2, tier 3 cities are still using these branches, right? So there's already some value attached to that. So our neobanks need to provide more value than the value that's provided by those guys. And I think that's really done through innovation, creating, an easier path for people to do things that they need to do in their everyday life, right? What can you do in payments? What can you provide that is going to be better and more streamlined? And security is another piece, right? Can you have better security? I think we're on a journey here. I really feel, there's an opportunity as well, like you mentioned, to partner with financial institutions. So in Canada, we partnered with a main bank to house our central bank account, right? And we're utilizing the trust that people have in that bank, for people to hold their deposits and do everyday banking and everything like that. And then on the periphery, we have a universe of hundreds of different products and services. So from that bank account, you can search one of 200 alternative lenders, get the right loan and attach it to your bank, right? You can access mortgages from another 100 providers. You can access insurance, etc., right? And so we utilize the trust of the existing account, the bank that already exists, and we build something that's much more valuable, allowing that bank to become, better positioned in market to contain, some better value proposition in the bank down the road, because we actually have the universe of fintech that we've attached with it. So there's a few different models, a few different ways to go. I just feel, some of these digital banks have multi-billion-dollar valuations, small client lists, and I just have trouble sometimes seeing the differentiation. So I think we need to focus on that.
Right. No, absolutely. Multiple models, and I think multiple learnings from across different jurisdictions. Fang, as IFC, you see this from sort of a macro perspective. You have the benefit of looking at IFC's investments in digital banks across many jurisdictions. So, what are you seeing? What models work well? What should we be thinking about as we start this sort of journey of regulation and growth in some sense?
Thank you very much. First of all, it's great to be here, and thanks for having me here. Before I answer that question, for those who don't know IFC yet, we are International Finance Corporation, part of the World Bank Group, and I'm covering digital financial inclusion across Asia Pacific. So on the financial institution side, we have been investing more than 900 financial institutions across the world, including neobanks, digital banks. So we have been working, for example, the top 3 digital banks in China. In average, they have 200 million to 300 million customers. And we also work with Nubank, you said earlier, in Brazil, and the digital bank, Greenfield Digital Bank in the Philippines, Indonesia. We're working closely with many of them. So I'm happy to pick the question you just answered based on our observation and the interaction with those customers. I mean, my personal view is the market is big enough to accommodate various different business models. But if you look at the top 10, those are the ones which actually create their own ecosystem and partnership with everyone. So give you one concrete example, WeBank, which is backed by Tencent, is a standalone licensed digital bank. But at the same time, they work with traditional banks because as a digital bank, it's very hard for them to mobilize deposit as they don't have physical branch. So they co-lend with those traditional banks because traditional banks have money. So they bring in customer, bringing more advanced underwriting technology and work with traditional banks to support the unbanked population in China. At the same time, on the other side, I mean, besides the funding source side, they also work with hundreds of different platforms in China. Can be e-commerce platform, second-hand car shop, etc. Travel agencies, so on and so forth. So you don't see them actually because they embedded their service behind all those super platform or even second tier, third tier platform. It's really like a banking as a service, what they're doing. And right now, they might be one of the most profitable digital bank in the world. So like I said earlier, I think various models, I believe, depending on local context and also regulatory regime, they can all survive and also do something really good to society. But the most successful one is really the one which owns the ecosystem and build a partnership with everyone. Thanks.
Bang, and I think you made an important point, right? I mean, what we're seeing now is we're seeing banking as a service. And I think the big change is it's not traditional banking relying on tech, but it's more tech is powering. I mean, whether you look at like you said, e-commerce or big tech, it's the tech solutions and the platforms that are actually powering this change. So absolutely, I think the partnership model has a lot of potential. Anand, let me bring you in. I think one big question that I certainly have, I don't know how many of you in this room do, is when you look at target markets for a neobank, would you say neobanks sort of operate in the same space really as traditional banks and just do things differently? Or would you say that neobanks really target a completely different segment? I mean, how do you think about that?
Oh, well, I think thanks, Shilpa. If you really were to ask me, neobanks today work in different segments, right? They also work in segments which the traditional banks do. What do neobanks bring in largely, right? A great customer experience, right? And how do you differentiate from a traditional bank? You probably use technology to create a great experience. You bring in larger innovation to ensure that your same service is probably a great customer experience, right? So neobanks also we have banks which work also specifically on customers who are in traditional, but giving a great service. Like someone said, I mean, you could probably create better innovation to create that. Apart from that, I think millennials obviously are a great segment to work with because they are mobile first, right? And that really helps to bring in a very differentiated kind of a service. They're looking at services which probably, as Prabhu said, they will not go to a bank. Nobody knows where the bank is, right? And that's a fact today. So if you have customers who probably need services, who are mobile first, who probably don't know beyond mobiles, they would want everything on their fingertips, right? And that's a big segment today, and especially in India, which is a young nation, and that segment makes a lot of sense because you're able to offer a lot of services across, especially in the banking space, to these customers. And if you look around, I think everything today, I mean, maybe grocery, maybe medicines, everything is today on mobiles. It's no longer you need to walk in any way to get across. So I think the space is quite huge, and anybody who's able to bring a great customer experience, great customer delight, I think can go across to those customers. So the opportunity size is huge, both for traditional and also for both millennials. So that's how we look at it. Thank you.
I think sort of, drawing from that same theme, Sumit, I'm going to sort of ask you a similar question. Is, like I said, I sort of when you look at younger target markets like millennials and Gen Z, would you say, yes, their expectations of banking services and financial services is different? And how are neobanks sort of reacting to that?
Great question, right? Like, I think if you look at the millennial or the Gen Z, they've grown up with Snapchats and Instagrams and other, great apps out there. So your level of expectation in terms of both UI design, sophistication, ease of use is at a level way, way higher than sort of the financial industry provides today. So for whether it's any banking app, neobank, whatever we want to call, right, the level that they have to play to even say satisfactory performance is a huge one, right? And that's just the starting point of it. Post that, the expectation if you look at millennials and Gen Z, is they want things very transparently. You don't want things hidden behind privacy policies, terms of service. You want it clear and upfront. They want to understand what they are doing. And how do you ensure you provide that to them? Even in terms of features, right? Everyone is individual. You're living in a Netflix world where it's able to tell you which movie to watch or which show to watch. Similarly, for banking, when you're dealing with investments or lending, how do I get the best for me? And that level of personalization is all, I would say, minimum expectations today. It's not that, that is differentiation or innovation. I think innovation will come on top of those. But just for this generation, you need to give this as even a starting point.
Right. No, absolutely. And I think, Sumit, when you're talking about sort of customizing financial solutions, I think it's no secret that that's one thing that fintech does best, and a key raw material for that innovation is data. coming to sort of a real hot topic for fintech, regulation at least, is data governance. I think and like you said, right? I mean, when you're looking at segments like millennials and Gen Z, a lot of what they do is they transact in the digital economy and they leave data trails, and the number of sort of data that's generated just by everyday things like booking a ticket or buying a t-shirt or making a payment. There's a data trail for each of these activities. And what fintech has done phenomenally well is been able to sort of analyze this data and customize and create financial solutions. But I think the flip side is data governance becomes key, and that's certainly becoming a key focus area for regulators as well. So Prabhu, let me ask you to sort of comment on how are neobanks sort of dealing with the challenges around data privacy, data security, and just data governance.
Yeah, it's a very great question, great topic. I think if you look at banking overall, banking is all about trust, right? It's basically you trust the banker to kind of safekeep your money, safekeep your records, the KYC records or whatever personal identifiable information that you share with the bank. And there are also the banking is the channel where you get your salaries, you get your most of your expenses and stuff like that. So the data that you actually share is like part of your life, right? Which means the banks or the neobanks or the fintechs are interested with a very, very personal part of the customer, right? Like so, data becomes very, very important to be safe kept and stuff like that. I think, and we are living in a part of the world where the regulator is like quite proactive when it comes to who stores what data. And there are very, very clear guidelines about how is your KYC authenticated. Like let's say if you use Aadhaar, in what format has the Aadhaar number to be entered, how it is transmitted, how it is stored. So I think this is going to get much deeper. Each and every element that you share with the bank or the app or the fintech or a partner, what will they store? As Sumit mentioned, I think transparency around who stores what, who takes what information for what purpose has to be revealed to the customer. It is already being done to a certain extent. I think that will become even much more clearer, right? Transparency is the only way to gain trust. And any data governance policy has to evolve around transparency and trust, right? That's one part. And then there is also a factor of, these Gen Z or the millennial population are definitely, I think, a large chunk of these folks are going to go abroad, study abroad. So you also start sharing information outside, like across the borders. So cross-border banking and a neo-banking twist towards that is actually happening. It has already started. It is only going to get more and more profound, right? So what data goes out to the other party on the other end will also play a big role. So I think, yeah, transparency is the key there, and to be very, very specific about who holds what data will be quite important. And I think regulation is good to kind of be prescriptive about what companies do with the data.
Something
absolutely, yes,
right? The regulator has already shown us the way with the account aggregator, right? So the basic principles of account aggregator around explicit consent, showing what the reason for which the data is being asked for, how it's going to be used, how long the data would be stored, and the right to ask for both data deletion and consent deletion is sort of the way to go across all data things.
No, absolutely, Sumit. I couldn't agree more. And just reacting, I think, to what both of you said. So, Prabhu, you made a very important comment, which is banking is all about trust. And I think traditionally it's all been, consumers have, the trust has been, do I trust you with my money? But I think when we look at neobanks or digital banks, it's going to be not just, do I trust you with my money, but do I trust you with my money and my data? And that's going to be key to sort of building and I think growing products for neobanks. And, Sumit, reacting to what you specifically said on yes, absolutely. I think data governance has become a real focus area for regulators. Principles around consent and around data control. I think the idea being that as a consumer, I need to be the ultimate sort of owner and controller of my data to be able to say what can be collected, how it is processed, for what it is processed, where it is stored, and whom it is shared with. So I think that's going to be critical going forward for neobanks to be able to demonstrate to regulators that they are able to deal with data securely, which will, I think, build trust both vis-a-vis regulators, and consumers. Shifting gear a little bit, I'm also conscious of time. Adam, I'm going to ask you to sort of comment on another aspect of digital banking, which is financial inclusion. So, a lot has been said on the policy side that digital banks and neobanks are very well positioned, given reach, given their reliance on tech, to meet the goals of financial inclusion. Is that something you would agree with, disagree with?
Yeah. Sorry, just quickly to close on this this last topic. Like I'm incredibly shocked when I see a phone of one of my colleagues here in India and I look at their SMS messages. We don't have that in Canada. That never happens, right? We have an opt-out. Nobody messages me. I don't get any of that stuff. And I think that India will eventually go that way, right? Following into GDPR and all of that stuff. So I think, the fintechs that are going to do well are the ones that are following GDPR today, right? And really getting the consents and being able to be in touch with those people on the other side of what's going on, because this crazy SMS stuff it's just crazy to see. Okay, cool. So financial inclusion. So there's a lot of I think momentum here. I do feel there's a big opportunity for neobanks to help service these customers, tier 2, tier 3 cities. They do have the branch network. Like you said, many of them aren't engaging with them here. But again, it comes back to the value proposition. It comes back to what you're offering these people. I think that it all comes down to that. And, if you're going to go one way or the other, the bank can provide their own value proposition too, right? They have access in these areas. They may already have these customers, right? I think State Bank of India has 450 million customers, right? When you guys went through that whole transformation, the bunch of accounts were open. So there's already some sort of an access to that individual, right? I think another challenge that's going on is the cost of acquisition, is being able to find the right people to get them to come into your enclave. And, that is a focus of the fintech itself. So, if you have a fintech that's going after people with a 750 credit score, financial inclusion isn't very much your focus, right? It's not your target. So I think you got to find them locally. You got to find a way that you can acquire them affordably. You can bring them in, and it can make sense on the revenue line, because all neobanks are funded by someone, and there's a dictum from on high on those instances as well. But I think there is a massive opportunity. If you look in India, 7% of Indians have been able to get a loan from a bank. 93% have not. Right? There is some massive opportunity there. And, if fintech's able to provide better user experience, better way to capture and access those people and provide something that's valuable, you bring them in and you can hold them from the bank, right? The bank won't be able to take them from you. So it's acquisition, but it's value proposition, it's focus, a lot of layers to that, but definitely a staggering opportunity here in India. And, we're looking forward to kind of really trying to tackle that ourselves.
Absolutely. Anand, did you want to react to that?
Yeah, I think very interesting. I mean, I think, let's say 5 years back, financial inclusion would be a great topic to discuss. We talk about a lot of financial inclusion in India. And what's interesting, especially, in India, is that three things have changed in India, right? One is that you have Aadhaar, you have billion Aadhaar cards in India. You have probably 90% of Indians have accounts, bank accounts. And I think we already have close to about 600 million smartphones, and probably a billion probably next about 2-3 years. So I think the basic infrastructure for a financial inclusion which was missing is in place, and I think thanks to it, I think a lot of fintechs, our ability to reach out to, let's say, tier 2, tier 3, tier 4 cities, which was earlier a big question, I think it's all gone in. I think the financial services have started reaching there, and I sincerely feel that it's just a matter of time that you would probably, I don't think next 5 years you're going to talk about financial inclusion anymore, right? I think you would be there, and you would be in a position to offer much more than what you're offering today. And I think that's going to be quite exciting, and that's a big opportunity in India today, and it's going to be a good one to look at what's happening. Yeah, thank you.
Yeah, it's super exciting. for sure. I can't wait to see what's going to happen in the next 5 years. But
Absolutely.
I think there's also a really big opportunity for some of these bigger brands, right? Google or Netflix or otherwise, who also have the customer base that they can bring them into the enclave. But in accessing them, I think for us right now, we're in 400 different cities, and we're accessing people through the Corona shops directly and bringing them in that way, which has been really, really interesting as a journey for us. But yeah, it's fun. It's fun to be in here.
I mean, infrastructure is placed. You just need to know how to reach there now. That's it. So I think that's been quite exciting now.
Well, I think if there's one thing that's clear from this panel is we can expect a lot of innovation and change in neobanking. Now, before we get into wrap-up mode and I open it up for questions, Fang, if you can just quickly maybe just summarize on regulation. I mean, you've seen across the various jurisdictions where neobanking has really grown. What are some of the models around regulation? We don't have a distinct regulatory framework in India, so what are some of the things we should be thinking through?
Yeah, that's a very good question and also very timely. Right now, we are seeing that digital bank licensing is really rising. If you look around, all the major economies in Asia have introduced digital bank license, including Korea, Japan, China, Indonesia, Philippines, Singapore, Malaysia. And I know many other countries are also considering that, like Thailand, Mongolia, and Bangladesh, as well as India. So it really depends on what's the key objective of the regulator for bringing digital bank. In most of the markets, regulator will ask themselves 4 questions to define if they want to introduce a new license or new player or not. The first question they will ask is that how big is still our financial inclusion gap? Not only just about access to account, but access to credit, especially SMEs. And secondly, can existing market players satisfy them? Can they narrow down the gap in the near future? If not, then let's look at the third question. Who are the potential digital bank players in local market? How mature are they? Can they control the risk? Because that's critical. And the fourth question they will ask themselves is, how is the market ready for digital, let's say digital readiness? This depends on the infrastructure. Do you have eKYC, credit bureau, open banking, e-signature, e-invoicing all in place? And also, how comfortable are your customers to use digital channels and those digital products? Last but not least, the question is that as a regulator, are we ready? Are we able to supervise those new type of players? Do we want to introduce sandbox to test and see how it works? So if the answer of the 5 questions I just mentioned, if the answer are all yes, I don't see a reason why can't we introduce new digital bank license. In mature markets, I mean, like advanced market like Japan, Korea, and Singapore, where you have already almost attuned, let's say, financial markets, you have lots of international leading banks sitting in those markets. Still, regulator introduce licensed digital bank. But they guide them. They guide them to support, for example, in Singapore, 3 out of 5 digital bank license issued. They request those digital bank focus on SMEs only.
Right. No, absolutely. And I think that's linked to the target markets as well. So I'm looking at the clock. I'm going to sort of ask each one of you here to respond to one question before we wrap up. Where do you see neobanks 5 years from now, as we get into the cusp of innovation, a central bank digital currency, blockchain, linked financial services, new target markets? We've spoken of a lot. So just in 30 seconds, where do you see neobanks 5 years from now? Let's start with you, Sumit.
So I think the magic is yet to happen, right? I think what we have focused on is digitizing existing banking rails, whether it be payments, investments, lending, account opening, KYC. But the real magic of the secret sauce of helping people in their financial lives, whether it's related to savings, investments, just dealing and understanding with their finances, yet to come. So I would say in 3 to 5 years, licenses, hopefully or not, you will see the user as the customer as the winner, where you will see awesome tools coming in from fintechs, neobanks to make people's lives a lot better.
That's a good picture. Fang.
Yeah, actually out of 250 digital banks right now, only 5% is profitable. So in the next 3 to 5 years, I hope we will be able to see more profitable digital banks across the world. And many of them will be able to innovate faster and quicker, and also in partnership with traditional banks to jointly support the unbanked population. Thanks.
Terrific. Adam.
One massive marketplace of financial products and services with a central bank account through which you can access all financial products regardless of where they come from. One login to access everything. One layer of financial, the next layer of additional products and services, right? What other things could we get you? Could we get you insurance? Can we get you used vehicles? Could we get you homes, etc., right? And then a lot of this stuff that is dictated or shown within that universe comes out of the information we're pulling from the account, right? So we can see certain things are going on and we can better recommend the products and services that might fit that individual. But it's fully customized and it's fully focused on the consumer. It's not focused on the fintech. It's not focused on the bank. It's focused on ensuring that that consumer is receiving the best possible thing. And that's why they're going out and they're using rate comparison platforms today anyway, because they're looking for that. Why can't we provide that from one place? I think that's where it's going. And I see it as happening globally, right? One big global marketplace, multiple countries, and then where does that go? I mean, do you partner with other bigger online players to help you provide that service, right? How do you access the customer base?
So a conversion, yes, absolutely. Anand.
So I think the journey of a neobank has just started. I think rightly said, we're innovating the current banking processes. But I think the future, the way I look at it is you'll have a lot of new banks who are going to be personalized, working on specific target segments, right? And I think that's typically how it's going to go. And we have banks who only work on one segment, on one set of customers, because I think I think the opportunity size is very huge, and I think every segment requires an innovation today. And I see a new banking which will work with various segments, with specific segments to work with, unlike a complete cover. So that's what I look at as you go across. Thank you.
Prabhu.
So I think it's not just going to be global; it's going to be universal. When I say universe, it also involves the metaverses, and in 5 years, I think we're going to go to Mars. Banking will reach Mars, and I think it's going to be fully inclusive. And we believe every company in the world can become a fintech. Going back to the same embedded finance topic that I spoke about, I think it's going to be an embedded journey. Banking will not be explicitly banking; it will be embedded through the journeys that we undergo every day.
So I think the big takeaway is we certainly need to watch this space because a lot is yet to happen. I know we're out of time, but thank you everyone for being here for a fabulous discussion. I think lots of thoughts, ideas, and the one thing that's really come out is we're really going to see a lot of disruption, a lot of change. So thank you everyone.
Thank you so much.
May we request everyone to kindly be seated. Check. Everyone sitting at the back, if you can come forward, you're welcome to come and be seated forward. There's a lot of space in the front, a lot of empty chairs. The closer you sit to the stage, the more we'll take back from this session. Let's make it a closer, intimate setup here. You all can come forward, everyone sitting at the back. We have some empty chairs to your right, towards the stage. And before we begin, we'd like to thank our partners, our communication partner, Kalera, our banking partner, Standard Chartered Bank, Diamond Partners, PayU, AWS, Kia.ai, Infrasoft, and Paytm, and our networking partner, Buddy Loan. With that, we PA off. With that, we start with the fireside chat on importance of alternative data and emerging technologies to improve credit decisioning and prevent fraud. And for that, for the fireside chat, we have with us Mr. Sachin Seth, Managing Director and CEO, BSE eBix Insurance Broking, and Mr. Bikram Singh, Head of Credit Services and Strategic Initiatives at Experian India. Over to you, sir.
Thank you so much. Thank you. And really wonderful to be here, talking on the topic, which is like talk of the town for last many, many years, that, how to make credit process or underwriting and decisioning process more and more enriched with non-financial data. And I'm sure many of you have heard this, say that data is a new oil, data is new gold, data is new whatever it is. I would say data is a new sunlight. We are talking about all green energy. So sunlight is in abundance. It's up to us to see how do we use it. So probably that's a phrase I want to start with and ask my panelist here, Bikram. Welcome here for the discussion.
Thank you, Sachin.
So Bikram, just starting the conversation between us on this topic. I mean, all of us know that the credit decisionings, fraud detection, everything is happening on financial data for ages, right? I mean, there has been a traditional way of doing it, etc. But of late, I mean, data is flooding in from all sources, right? Now, how do you really make out that, what kind of data is relevant in the, process of making a credit decision? And, coming from a very strong background of the bureau and, credit decision practice, how do you see that, what kind of sources do you think is relevant for this kind of approach of alternate data?
Yeah, thanks for that, Sachin, and very good afternoon to everyone here. Pleasure being a part of this panel. Sachin started with saying that, data is the new oil. Let me just take 2 steps back and say that oil comes from crude oil, and, alternate data is just like crude oil. Let me put it that way, an analogy to that. Because reason is that crude oil in itself is of no use. But the minute you start processing crude oil and you make jet fuel out of it, or you make petrol out of it, or you make diesel out of it, is when it starts getting used. Same is the case with alternate data. So alternate data is, in another analogy, is just like pieces of Lego in different shapes, forms, colors. And it depends on how you join them together to make something out of it. Now, different, companies, different people, different industries have different ways of looking at alternate data. Some people look at it for a very, very specific niche understanding of a need of a consumer. Someone looks at from a risk management perspective. Someone looks at it from a consumer profiling perspective. Having said that, I would not say any one of these is wrong, but alternate data has to be used in a very different fashion. If I have to put it, in simplistic form, the right alternate data, when used, can improve, predictive model, can improve the risk models, can lead to fraud detection, and needless to say, can lead to lead scoring. So here it's a combination of both risk, credit, and business. So when we look at alternate data, it is coming in from various ways, means, forms today. A simple thing like a handset that all of us carry, and that's the most popular one people talk about alternate data, is that it gives you a lot of information on the consumer's preference, consumer's location, consumer's spending pattern, consumers' choices on certain things, and all that stuff. But when you look back, and you look at alternate data holistically, one should not look at it in silos. It has to be combined and looked at it holistically. And that's, if I might say, what is our meticulous approach to alternate data? To me, when one looks at it holistically, one, it has to have a broad and consistent coverage. Two, it should be, it should have accurate updation, and the frequency of updation has to be, there, because, since the data is so dynamic, a data which on a consumer might be there 3 months back or 6 months back might have changed on the same consumer in terms of the preferences. It should be very specific in terms of the info which it is providing on the consumer. It can't be all over the place. So, if you're trying to figure out a consumer for from an e-com perspective, it has to be very, very specific in terms of what you're trying to understand from that data. Can it predict a consumer behavior, as an example? So that's an important part of, alternate data that one has to look at. And since I come from a bureau, as Sachin mentioned, can it complement the bureau data? See, eventually, everything starts boiling down to the fact that today a lender will look at a combination of substances when it comes to any lending decision to be taken. Lenders are becoming more and more, I would say, forward-looking in their approach from only looking at bureau data to, looking at alternate data now. And that's something which is encouraging. But still, I think the experimentation and the way data is today getting used is still very limited. And there's a lot more we can do around, with that data. I'll just take, a number or quote a number. So there is this annual survey which the government does on, the workforce of India. And it's slightly outdated, but relevant even that today it would not have changed much. So for the year 2021, if I remember it correctly, that workforce survey of India said that there are about 14 or 15% people who have a salaried job in the country, in the workforce. There are about 55% who are self-employed, and there are about another 25% who are in casual jobs, and then there are vocational jobs. Now, why I mentioned about this data is because of the fact that the most sweet spot for a lender has always been salaried. Why? Because data is structured. You are able to estimate a consumer's income, his employment details, his stability, and to a large extent, the possibility of fraud is much lesser when it comes to salaried vis-a-vis the other side. But now let's look at it, it's only 15% of the population, the workforce. 85% still lies outside of it. And that's where alternate data plays a role. And that's where, alternate data becomes extremely important if we are talking about, democratizing credit, last mile connectivity, so and so forth. Good terms to use, but then how do you end up servicing the consumer? How do you end up getting him into the mainstream of credit? That matters a lot. And that is where, again, this kind of data sets become important. And that's, what I think. And I think it's not only limited to credit as an example, Sachin. I think similarly, other industries like insurance, as a matter of fact, and we are an underinsured economy, underinsured, country, can use it to a lot of benefit. And actually, you might be able to shed some light on that how can that be used on the other end of the spectrum as well.
Wonderful. Vikram, I think very well said as far as the credit side is concerned, and really, good insights. As I think it's more of a conversation, and then you wanted me to bring in the insurance perspective. I mean, it's really amazing that some of the things which are happening and how data can prevent them from happening, right? Whether we are talking about underwriting process or we are talking about fraud process. I'll give you an example. I don't know whether some of you noticed, I think about 2 or 3 days back in the newspaper, there was a small article about, a mechanic had purchased a car which was salvage or which was basically classified as something to be sort of, completely sort of, what do you call it, scrapped, right? And basically this mechanic purchased this car in Bombay, I think in western suburbs. And this mechanic was trying to really salvage the car to make it workable. He had bought it in an auction. Now, very interestingly, when he visited, basically he got a, information that on the same number of the car, basically there are SMSs coming of the, traffic violation. Now, how can a car which is in the garage in Mumbai in a completely, broken condition can have the sort of a traffic violation happening in Pune? And the traffic violation was happening in Pune. Now, there's the beauty of data and surrogate data and how the fraud gets caught. So he approached the police and he said, I'm receiving these, messages, but the car is not even in a working condition. So police got in action, and in fact, they figured out that actually when insurance company scraps the vehicle, there are certain people who actually take that data. They actually then steal the vehicle of other people. They put this number plate and change the engine number, etc., engine plate, and they are selling those cars in the market, and those cars are, being sold as some used car. So you see how the correlation is, right? I mean, there is a car which is actually originally carrying that number of RTO is in non-working condition, and there are 2 cars running in Pune with the same number or similar numbers and doing traffic violation. And how do you catch them? Because traffic violation nowadays in every city is captured digitally, right? So when you capture digitally, you basically are able to send the SMS to the owners, etc. So I'm just sharing with you, the kind of frauds are happening and where the data is becoming, very, very relevant. Another point I wanted to bring, Vikram, from insurance perspective. In fact, I think many of you would have seen that, insurance companies are also launching new innovative products. They are doing different kind of underwriting, credit decisioning, etc. And of late, we have seen that, pay as you drive or pay how much you drive, right? So these kind of products also have been launched very recently. I think there is a lot of innovation happening in that. Interestingly, there are devices put in the cars with the permission of the, the owner of the car. And it's a driving behavior which is being captured, or the usage of the car which is captured, right? And this is like a very, very powerful alternate data which can actually, if regulators allow, tomorrow could become one of the credit, the surrogate data, because you would be able to understand the behavior of a owner of a vehicle, whether it's a car or a bike or anything, and you would be able to correlate it to the financial aspects of it, right? And that would also become a very, very important. Third thing, Vikram, I just want to add that I think the amount of data being captured from a lot of other surrogate sources. I mean, I without naming specific startups, I mean, I'm sure they are doing a great job and they are within the purview of the sort of data privacy guidelines. But you might find that, some startups have solutions wherein they will manage the parking of a, building or a hospital or a corporate. And very interestingly, you would notice that, the kind of data they would generate out of it, right? I mean, which clearly shows that, which car, and it's also connected to the FASTag, right? So the movement of the people, how much time they are spending where, what exactly they are doing, if there is a correlation of that this person working in this company, it can be correlated with the parking data, that whether the car the person owns actually goes to that building where the, the person is claiming to be working. And that's what we talked about, the salaried class, etc. It could be about the business people also, right? So I think those are the kind of sort of things happening. And I'm sure not everything is sort of exploited enough in this, but with the regulatory frameworks becoming more and more tuned towards sort of driving the credit growth in a structured manner and basically helping organizations find more and more about the sort of borrowers, right? I think this will become a lot more sort of progressive thing, right? So Vikram, coming back to you, your thoughts on, I mean, just a use case wanted to share. and this is completely out of whack. So it could be just a extempore surprise. Tell me that all these people who are attending this GFF here, and they are actually posting on their social media that they are in GFF, they are doing this, they are doing that, Twitter, Facebook, Instagram. Can this help a lender, understand the behavior of or classify them in a particular bucket with using some of this data? And can this also be useful?
Am I audible? Yeah, okay. I think yes, to an extent, yes. No, I would not jump to a conclusion on how it can be used. But, as it is said that no data is useless data if one looks at it. But let's look at it, the minute you post something that I am in GFF and I am attending this and all that stuff, it kind of translates into the kind of profile that you have, and then your profile then further translates into the kind of consumption behavior or consumption pattern you will have. So those kind of things when fed into the system, and see again, when we look at data, there are a lot of people who gather a lot of data, and you mentioned about it. Gathering of data is, I think, the least of what any smart data company can do. It's about how you are able to make sense out of that data. So important things like are you using AI to make sense out of that data? Are you using deep learning? Are you using anonymized metadata? And why I use the word anonymized in particular is because of the fact that with all due respect, as you mentioned about this parking example, there's a lot of misuse of data which happens. Customer does not know that his data is getting used. Consent is not taken. And today, forget anybody else or the consumer. The government and the regulator is now very, very clear on this, that you will not take that data of a consumer which is not relevant for a certain decision making for which you are trying to work with him. So for example, in the latest digital lending guidelines which the RBI came out with, they've clearly called out that only that data has to be taken and used which is meant for that decision making. Don't keep on carrying and gathering data of consumer without that use. So the minute it starts feeding into that data and starts talking about consumer preference, consumer profile, there's a lot more to offer from that data. I'll give you another example since you mentioned about parking. A lot of us stay in condominiums which have a entry-exit system where if some visitor is coming to your home, you will be notified either through a phone call, but now phone calls are outdated, so you have apps which notify you, and those apps also are in turn your society billing apps, blah blah blah, and all that. Now today those apps actually are capturing data on you, in a manner where they are able to profile you to the last T. So I'll give you an example. Problem is that a lot of data becomes heterogeneous. Now look at this data which is getting captured. Now let's say you stay in JVLR in Oberoi Splendor, just an example here. Now that's a very homogeneous set, which means if you're staying in Oberoi Splendor, you have a certain profile, you belong to a certain income band, you have a certain preference for a certain location and a certain kind of condo that you want to stay in, and if you apply for a loan thereof, the lender is able to relate to your profile very, very fast and simply on those lines. Plus, what is this app able to do there? The app is able to even figure out whether you are a guy who's carrying a home loan or you are a tenant. The reason is simple, because over there, when you register for that app, you have to say whether you're an owner or a tenant. Now, it means that tomorrow, if they go and tie up with lenders, the lenders know whom to reach out for what. So if you're a tenant, it means aspirationally you want to, maybe buy something in that same condo because you're staying, or similar condo because your life cycle, your quality of life or your life cycle is such, and that's how they can actually do very, very targeted, reach out to them. So to me, if I have to say, what are the key elements that our alternate data set should reflect, are around what are the habits that it is telling us as a lender, what is the behavior of a consumer. You mentioned about driving a car as an example. Now, how you drive your car reflects a behavior that you have, and it turn can be actually fed into credit decisioning at some point of time. It shows, your behavior. It shows the character of the person. How, is he someone who's very, very meticulous, regular with his things and all that stuff. And it shows the consumer preference. So these are key components which, the data set should reflect when it comes to alternate data, and then fed into, any kind of decisioning engine. But on top of it, we should not forget that it can only be done when there is, things like artificial intelligence, deep learning, and all that stuff riding on top of it, because then it starts making it to a structured format and make relevance for anyone to consume that data.
Yeah, no, I think Vikram, that's really, really insightful and really gives a very good perspective of that, how decisions are being sort of looked at in future, and what kind of data sources are could be used. But at the same time, as a consumers, we also have a responsibility to ensure that we only agree to share that data which is relevant for the decisions we are looking for as far as our lending is concerned. So we have some time. Maybe we'll come for the questions in the last. But one more quick question to you, Vikram. We did talk about the credit decisioning, underwriting quite a bit, and we covered quite a bit of that. We probably just bringing a thought on the fraud side, right? Because obviously, when you are underwriting, when you are making a credit decisioning, you are looking at ability to pay, intent to pay, past records, etc. So let's say even if there is a intent to pay, and there is a ability to pay, but the question is that what has been the past track record? What's the tendency of a person, or what could be the possibility that this could become a fraudulent activity kind of thing? So anything you would like to add on to that, or maybe some one or two data sources or data point of views which could add into making a decision and segregating some of those sort of kind of customer base?
Yeah, see, before I get into very specific on the consumer data which is getting used at a consumer level, I would say at an aggregate level, how can data be used? So for example, today there are platforms available which can drill down, consumers in an anonymized fashion, of course, but can drill down in a micro market level, on a geotagging level. As an example, even Experian has such a platform where this can be done. Now, how does it help? For example, if a lender is lending at a place, fraud detection is something which is important, and fraud prevention is something which is very important to him. Now, if they find that at a geotagging level, they are able to find that in a certain small micro market, they find that there are high fraudulent activities which are happening, or there are tendency where such activities are going to happen as a matter of fact, or they find something of that, they can actually take very conscious call when they are underwriting anything at that point of time. So outside of the fact that what are we doing at a consumer level, when a credit or a risk team is writing the policy for the organization, these kind of data sets become extremely important. These platforms become very important for them, because these platforms in turn help them, reach out to a larger policy making, because, the application comes at a much later date from that area, but the policy has to be built first on that.
Right. No, I think that's very important. So what do you mean? I mean, just taking it a little bit forward, what you're saying it as an example, let's say use case are basically at a pin code level. We know that a pin code level or a micro market within the pin code,
yes,
we should be able to sort of look at that, the possibility of data of the fraud from the past, and then we can sort of make a credit policy decisions on that. Yeah,
that's right. So it is not it's not pin code, because pin code does not help, because pin codes are wide, right? So it's something, for example, where we can say it's a 200 by 200 grid or something of that nature. So that's part one. So that is where some primary data is available, where you are able to assess. Outside of that, there are a lot of alternate data sets. Just as an example, Experian runs the country's largest fraud repository, or the largest application fraud repository. And that's where, for example, if we impose that data on top of it, that's something which is not, if I might say, publicly available data, but is primary data, because we know that this is coming in as is part of our fraud repository. So those kind of data, which is a combination of primary as well as, alternate data or secondary data, when both are put together and structured, that's the intelligence which starts building on top of it. But coming to the point which, you also mentioned about, fraud, I'll just take an example, when someone is, okay, today, most of the the credit transactions are starting from a mobile phone, as an example, and that's becoming the port of interaction also with the consumer today. So when it starts, what are the things that a device, as an example, the handset that you carry, what are the things that it can tell you? That also is a lot. So as an example, when someone is filling in an application online on the phone, so does the device, or does the intelligence from the device can be gathered to tell that is there the user and the device, do they share a history, or is it that, for example, Sachin is using my device and doing something, so is there a history to that? And this is available today. So this is not something that I'm talking hypothetically can be done. This is available today, right? Does this device configuration is in line with the user's preference? As an example, let's take me as an example. I am someone who might not take a STPL but might take a BNPL. So if I'm taking a STPL, should someone be conscious of the fact that why would he take a 1 lakh rupee or a 50,000 rupee loan, as an example? Third thing around is that is the device impersonating multiple users? Is there a malware on the device? Is this device associated with any previous crime? And these are all data points that we are talking, which are coming in from a device instead of coming in from any primary source of data which is coming. So that's the reason this alternate data starts playing a very important role when it comes to fraud detection.
Yeah. No, I think this really, great insight. So I think we are about 4.5, 5 minutes left, so we could continue to talk for hours on this topic. But I see that there might be curiosity among the audience as well. So happy to have questions. I can see some hands raising. So requesting for the mic and for the audience to ask the questions, please.
Thank you. My name is Madhur. We are seeing in terms of data aggregators and data companies coming up, three types of companies that are in terms of sourcing the data. One can be, as you were rightly saying, taking users' consent and taking mobile analytics, device data, and converting that to useful analytical models. The second is publicly available data scraping and social profiling of the customer, whatever footprint they might have left. And the third is leveraging the already existing data sets, data providers, buying data from them. We are seeing all three types of companies providing some models on these three. Which of these three companies do you think sustainable from a regulatory point of view, from a long-term perspective? Like, are all these three sources, I know there's a lot of gray area in terms of getting this data. So which of these three do you think is sustainable model from a regulatory point of view going in future?
Madhur, I will limit it to how we look at from an Experian perspective, because we are a regulated entity. For us, anything which is consumer consented and within the regulatory framework is something which is sustainable. Outside of that, it's a matter of time here or there, be it through the regulator, which is RBI, or be it through the data privacy bill, which will now subsequently come in the new avatar whenever it comes. Which is going to, put a strain on that entire piece. So when we look at data, even as a bureau or as a regulated entity, we are very, very clear that this data has to be 2-3 things which are like basic hygiene for us. One, has this data been consented? Does the customer even know that his data is getting used, and what is it getting used? More importantly, two is that once it is used, the customer should get to know that his data has got used. And third, the data should lie within the boundaries of the country. So these are hygiene factors that, we go with. And to us, if we have to look at any kind of data partnerships also, we will always keep these hygiene factors in mind for any kind of thing. We will not do anything which is on the sidelines, while it in the near future, it will make a lot more economic sense for us. But I think it is not a sustainable piece. unless Sachin, you have a different.
No, absolutely. I fully agree with him. And I mean, while people keep experimenting with new things in the hope that, those things will get covered in terms of regulation, it will be allowed, etc., etc. And obviously, those experimentations people continue. Data is being captured from everywhere, whether it's online, offline, tags, this, that. It's a question of that. Where is the data to be used by that company, whichever company that forms in that category, and then regulation will apply accordingly. And as I think Vikram mentioned, there are RBI is one of them. So which is on the lending side, on the basically on the capital market side, you have SEBI, insurance, you have IRDA, and then you have TRAI on the telecom side, right? And obviously, I'm seeing a lot more regulators will come because the data is not only being captured from here. I mean, it's being captured from other sources also. And as data privacy bills, etc., are becoming more and more robust, I think the customer consent or the use of data will become a lot more I would say, lot more refined kind of activity rather than free for all, which goes on sometimes, and then we have to do the course correction. Yeah.
Hello.
Yeah.
Hi, I'm Radhika Biani from Narottam Seksaria Family Office. So here at the event, we have been hearing a lot about financial inclusion, and I think alternative data and emerging technologies is the key to bring that inclusion. But I understand that product customization is required to include these people, to include them, these people into financial services, and product customization to the certain extent is required for the same. And that customization, which includes seasonality of their businesses into consideration, is a key. So is there a way we are making business seasonality available in a cost-effective way?
Yeah, so I'll give it a shot, and then Vikram, you can definitely bring your perspective, expert perspective, I would say. So yeah, I mean, financial inclusion, when we talk about, obviously, I'll just take 10 seconds to, let's say, broaden it up. We are talking about people who are basically not banked or unbanked or do not have access to finance, let's say, right? And those set of people could be in urban areas, could be in rural areas, could be in semi-urban areas. Primarily, they are more tend to be towards semi-urban and rural areas, right? Now, the question is that the product fitment for them. Very good point. And I think many of the startups, good to see that they are working on it. I mean, personally, I've engaged with a lot of startups who have created products for those kind of segments. Obviously, within the regulatory boundaries, they have taken the approach of utilizing certain kind of data, which is, if possible, to get. I mean, if it's a farmer, right, you don't have a salary data. You have basically a farmer income coming only in crops time, expense happening in a different time, most of the expense happening in cash, right? But then there are ways and means to look at that, whether the farmer is good enough in managing his business or her business, and there is an ability to pay back, right? So there are various kind of sources. I mean, people are talking about, the whole data which is coming from land records or coming from the rural economy. I mean, it could be like, just hypothetically saying that a farmer is using a state transport bus and there is a ticket he uses and probably he spends 2,000 rupees in a ticketing, right? So that could also be used. So I'm sure companies are utilizing this kind of data in different ways, and there are products there, but obviously it's a long way to go. And I'm sure with the startups and the fintechs coming in an aggressive manner to basically cover that gap, I can see a lot of innovation coming in that space here. Thanks. I think there was one more last question. Time's up. So if we
Let's take it off.
Yeah, done. Thank you so much. Thank you. Wonderful.
Thank you.
Thank you.
Check. Yeah, thank you so much. Thank you. All right, any questions? You all are more than welcome to ask them offline. We have to start with the next session due to shortage of time. While we set up for our next session, we'd like to thank our partners for the Global Fintech Fest 2022, starting with our theme partner, WhatsApp, co-powered by Amazon Pay, spend management partner, Encash, in association with Perfios, payments partner, Cash Free Payments, and CEO's dinner partner, HSBC. The next discussion is a panel discussion on establishing India as powerhouse of payments globally. E-payments for everyone, everywhere, every time. Yeah, am I audible to everyone on stage? Yes? Okay. Audible? Can you hear me? You need the volume? Upper or lower? Okay. Is this better? Because the music was quite loud. You need to increase the volume? Am I audible to you, sir? Audible? Yeah? Okay. All right, with that, let me introduce our panel on the stage for this panel discussion, which is... I'm just introducing the topic. Which is to establish India as powerhouse of payments globally, e-payments for everyone, everywhere, every time. We have with us our esteemed panel on the stage. The session is being moderated by Mr. Amit Goel, Vice President and Country Head India at Prove. And our panel comprises of Mr. Sanjeev Moghe, President and Head Cards and Payments, Axis Bank, Mr. Vikas Bansal, Director, Amazon Pay and Head of Payments and FS at Amazon, Mr. Miten Sampath of Cred, Ms. Vidya Pradeep, Executive Vice President, Head of Credit Cards, Debit Cards Portfolio and PayZapp for HDFC Bank, and Sri Sachin Sharma, Deputy General Manager, Reserve Bank of India. Let's welcome the panel with a round of applause, everyone. And over to you, sir.
Can you guys hear me?
Yeah. Clear.
Okay. So, they say it takes a village to do something big. And, I'm very happy that today we have people who have built payments and cards and other businesses at banks. We have fintech companies and we have somebody from the regulatory side as well. So it's quite a group. Obviously there are more types of people who actually sort of help to create a village and create something big, such as telecom infrastructure, such as government. And we have been hearing over the last 1.5 days from people from those sectors as well. The topic today that we have is very interesting. We are talking about already, I think India is taking a lead in payments in terms of, the technology, in terms of how, like 1 billion plus people can use payments anywhere, anytime. But I think we will actually sort of take it to the next level in this discussion and talk about the challenges, the opportunities and various things which are there. I think where I will start with, and I would actually ask everyone to speak on this topic, is that we have some amazing systems, right? We have UPI, we have Aadhaar-enabled payment system, BBPS, there's work happening on the B2B payments. There's so many things happening in the sector. I would like each one of you to talk about something that you are really excited about, or you think that that's a great example of the strides we have made in payments. Maybe Vidya, we can start from you.
You're able to hear me?
Yes.
I think that overall, if you see most of the volumes, digital volumes, I think for most people in this room, we would know how everything is crossed miles ahead, even during the COVID period. Even when we had like impact on spends, etc., digital payments is hitting the roof. Of course, with UPI leading. And I think a lot of the initiatives that were taken where we thought that these might take us some time to scale, we are seeing India taking a lot of this and moving ahead very fast. So one of the examples are also tap and pay transactions that we see on credit cards, or if it is the volumes that we see on, despite everything, COVID, credit card market has hit about 1 lakh crores and above a month. And Bharat Bill Pay, which we work very closely with to drum up volumes, we've seen huge growth in the last 1 year. We are seeing tier 2, 3 locations, even in the bank, wanting to come and make their bill payments online, which was not happening so much. It is a lot of integration work that's happened behind the scene by a lot of fintechs, banks, etc. But Bharat Bill Pay system is, I think, hitting about 17,000 crores a month. So it just goes to show that even one of the use cases, as in bill payments, is growing leaps ahead. So I think almost every product, every digital solution has a great story. In fact, the payment vision also states that most of the form factors will grow anywhere between 30 to 50%.
Right. Thanks, Vidya. Vikas?
Yeah, hi.
So first of all, really glad to be here, and this is just vibrant conference, and just loving it. In terms of Amit, you mentioned that there's so much innovation that India has already seen, right? With UPI, APS, BBPO, there's so much going on, and we are in fact at the cutting edge now when we look at the fintech and payments around the world, and and what's really heartening to see is that even within what we have today, we are continue to innovate. And there is one example, which is UPI, right? We all know it's really powerful and it's really working well. But within that, there's one thing that I'm very excited about is if you go back like 5 to 7 years back, prepaids, was really was really big thing. But what was the issue with prepaid was that it was on closed loop network, right? and 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 the companies had to build their own proprietary networks. But what I'm excited about is now through UPI on how working with industry and the regulator, we've enabled interoperable on UPI, right? And now if and then PPI to us is really solving the digital payments for Bharat. When a customer, we know when they don't have a functional bank account, or is it just too hard to set up a regular UPI, or the problem is that they earn in cash and they spend in cash, there the prepaid instrument becomes very powerful. And guess what? Now you can use it on any QR in the country. It's even more powerful. So I think there's a lot of innovation, but this one is I'm very excited about is now not only bank payments, but now we've taken it to prepaid accounts. Now we're taking to credit cards, RuPay credit cards, and just continues. And when we continue on that journey is when we will see like almost like digital India, right? That we all envision. So that's one example that very close, and something that at Amazon Pay we are very invested behind it. So.
No, the India public goods, digital public goods is a very good framework as opposed to a lot of proprietary models which exist in the US and other countries.
Exactly, and it is wonderful.
Yeah, yeah. Sachin sir.
Very good afternoon. I hope I'm audible.
Yes.
Right? So as we address this August audience in the month of September, there are a few things that I would like to say. Apart from congratulating the organizers, it's difficult for a regulator to pinpoint a particular success story. But since our focus is to look at the larger picture and to see where the larger masses are benefited, I would say the goal of financial inclusion is something that we have been able to accomplish through this fast and swift pace of growth of digital payments. And how it is, like in NACH, they say that 245 crore direct benefit transfers, in fact, government had released on their website, is that 9 million DBT payments almost every day were being done last year. And if you would realize, there were issues because there were leakages in those DBT payments, and that have been plugged in through the onset or through the onboarding of digital payments for that particular route. So that has actually benefited the masses a lot. Apart from that, the QR story, yes, in 2020, when we came out with interoperability circular, the number of QR codes, which was roughly around 2 crores in March 2020, has now gone to around 20 crores. And what it has benefited, or means the section of cross-section of people, is not just at the payers end, but at the payee end. So millions of merchants who were not onboarded into digital payments domain before the wide-scale proliferation of QR codes, they have also been onboarded into this particular domain. So these are a few things that I would like to start with.
Thank you, sir. That was very helpful. And Amit, thanks for having me on this panel. Folks, I'm with Cred. I think the example that comes to my mind, which is the most exciting one, is actually all this infrastructure that we have, which is available for large institutions, small institutions, government, startups. I think that's really the most exciting thing that I see. I think this conference here is a great example of the fact that we have thousands of companies innovating on top of this infrastructure and really taking us leaps and bounds ahead of most other countries, right? I lived in the US for many years. The cost of moving money in the US is a really bad tax, and it actually hurts people who are the least fortunate. And so I think if you look at most of the infrastructure that we've created here and the scale of startups and the scale of market cap that's creating, for everyone in this room and outside this room as well. I think that's really the biggest success story, and I think India therefore is going to be the largest sort of source of innovation in payments for many countries, and so to me that's the most exciting part from all of this.
Right. A taxi driver in Singapore once told me that it's easier to innovate in a 1 BHK and clean it up and do many things, but when you have this Taj Mahal, it's very hard. And we have like 134 crore Indians who have a digital identity today. It's doing it at this scale is what is amazing, right? With all of these platforms that we have.
And just imagine, you couldn't have this. I mean, look at the scale of this event. Boss, there are thousands of people here and all innovating on top of this infrastructure. If this infrastructure didn't exist, like half the story would be,
Right.
would not even happen.
Right. Sanjeev, sir.
I hope I'm audible.
Yes.
Yeah, okay. It's kind of strange speaking like this. Nobody's ever here. But I think quite a few things. One is just this place is quite amazing.
Yeah.
The look and feel, and you can go to Vegas, participate in Money 2020, and this is as good, better. And obviously great to have all of us Indians here, right? Pretty proud moment for all of us. I think to the question you had, I think there are a few ways to look at what payments does. Oftentimes we look at payment as an output of the fact that we are doing a transaction. What we don't realize what it is leading to. The country now is a $3 trillion plus dollar-wise economy. And if you look at just digital payments, I'm removing all payments which are, let's say, B2B, NEFT, RTGS, you remove IMPS because that's largely a P2P transaction. You just look at UPI, you look at cards, and all of this if you take together. Today, payments is close to 41% of India's economy. I'm not saying that's the contribution to the economy because this is flow. GDP finally is a measure of how big the economy is. But fact is, this number was what 2 years back? India was close to, I think, a 2.5, 2.6 trillion then. It was 17%. That 17 became 26 as the economy stayed stagnant, stroke reduced a bit in FY21. Last year, India has crossed 3 trillion. This measure has crossed 41%. Now that's huge. What it is doing is actually two things. One, payment by itself, and once you take out the categories which are P2P, in essence is a commercial transaction. I'm paying for something. I'm able to pay much faster now. I'm able to pay to almost everybody as compared to very few merchants earlier, for example. And third part is, to a large degree, it's secure. We'll talk about this, I think, when we get down to fraud topic later on. Second part, this means as that payment happens, the economy is humming and buzzing. So the economy grows. Second part, it also formalizes that economy. So our ratio of formalization, let's say when we were 1.5 trillion or 2 trillion and 2.5 trillion to what it is now when it's 3 trillion is far higher. It actually, therefore, payment becomes very, very important, not only because it's taking out from the GDP, it's only a byproduct, it's actually leading to that GDP growth in itself. Once you look at it that way, it places a far higher responsibility on all of us here, all of us here, all of us in this venue itself, and obviously lots of us who are not here, but people working on this outside. I think that's the context in which I look at it. Once you look at it that way, it has to be a digital public good. It can't be proprietary, it can't be private left to certain systems which then by definition become either monopolistic or definitely oligopolistic. Yeah, that's my context.
Very well said. Now, with this quality of speakers, it will be injustice to the audience if we keep drinking the Kool-Aid and talk about all the success and all the good things. So let me switch the gears. Let's talk about the difficult things, right? So the topic given to us was e-payments everywhere, for everyone, anytime. Now that actually comes with a lot of challenges, right? One, fraud. That is something we don't talk about much as an industry or as a nation, right? We talk about a lot of success. Then there are people who do not have internet access, people who do not have smartphones. So I want to touch on these three topics. Maybe Vidya, we can start with you first.
I think this will get tackled. It's already getting tackled. See, I think, like Sanjeev just quoted, look at the numbers we are talking about. Look at the scale that we are driving. Definitely at those levels, you're going to have, as an absolute number, you look at it, there is fraud itself is of two kinds. There are actual frauds and then there's abuse. You are bound to have a lot of innovation in that zone as well, and it's happening. We see it, especially social engineering, where you tempt the customer and then you get him to transact and then you don't deliver the goods. And so we are very clearly seeing absolute numbers going up, but FTS rates as an industry for all form factors they are manageable. It is not skyrocketing. And I think everybody is making a lot of investments to make sure that whichever platform we talk about, whether it's a mobile payment instrument or it's a credit card or it's a debit card, I think all issuers, we've also invested heavily in centralized risk management system, PRM, and their central fraud repository that the regulators are talking about. So I think it is going to get tackled. I would say that as there it is growing as absolute numbers, but as a percentage of the total volume that you're doing, it is still very, very decent and manageable right now. And I think it will get tackled very well in the coming couple of years as well. To the topic that you spoke of, which I think is very popular topic amongst most of us who are trying to solve, is even as a bank, how are we going to give a payment instrument to a customer who doesn't have a smartphone? I would say the population that doesn't have internet is there. And if you look at the payments vision paper that's come out, or most of the efforts that a lot of us are involved as banks, and a lot of common solutions as well, to look at what are we going to do for smartphone users. And I think non-smartphone users, you have offline payments, which is in the sandbox mode right now. But I think it is something that will unveil itself as another big solution in the coming 2 years, where there will be consumers who will be able to make payments even offline. And there'll be a lot of use cases. Initially, it will start with QR. It might be wallet-based. But I'm sure that, in the coming couple of years, like how quickly we are all innovating, making offline payments is definitely going to be a reality. I think most banks, and we are definitely working on it. And for a lot of customers, they're liking, when we do consumer research, they're liking voice-based payments as well. So I think the more especially in tier 2, 3 cities, when we've reached out and speak about it, it's coming out as a very comfortable solution for them. And I think if we have good solutions and we scale, we make sure that they're aware of it. I think we have, in another 2 years, I see both of it picking up.
Yeah, voice payments are interesting. Sachin sir, if you could say something about the topic.
Definitely. So, first of all, this topic itself, e-payment for everyone, everywhere and every time. This is the theme of our Vision 2025. And I can take a little bit of pride in stating that I coined this catchphrase. But apart from that, but it's not something that we have envisaged just for next 3 years. We have been traveling this road for some time now. And for non-smartphone users, which is roughly 40 crore plus population or users in this particular country, the UPI 123 Pay was launched by our governor in March 2022. The uptake will definitely be in due course of time, because UPI was launched in 2016, and I think the juncture at which it is now, it has been over a period of 5-6 years. So even UPI 123 Pay, you can't expect that overnight or within a matter of couple of months it will reach the same stage. Yes, we have started traveling along that path, and we will ultimately reach some destination, but give it some time. Apart from that, if you consider that areas where there is no internet connectivity, so we also came out with the framework for offline payments, small value retail payments. That was in January 2022. Based on that framework, earlier it was allowed only for transit, but for retail payments it was extended in January 2022. And this National Common Mobility Card, which is a product launched by NPCI, their small offline purse was sitting on that particular card, and offline payments were happening, but only for the transit purpose. Now the same purse gets this offline wallet, which is sitting in that card, can now be used for retail payments as well. But to enable that payment, the acceptance infrastructure needs to be created. So roughly 65,000-70,000 odd POS machines have been enabled for that, and it will grow over a period of time. But apart from that, I think Hdfc has pushed one solution in the regulatory sandbox, where they are testing a particular product of theirs, which will be riding on the QR code. So, and I think in due course of time, more and more solutions, because the framework is device agnostic, channel agnostic. So we have created a lot of scope for innovators in the market to come out with their own solutions, but they need to be interoperable. That's the need of the hour. And apart from that, everywhere. So everywhere, this offline framework takes care of it. Now we are also traveling beyond our geographical boundaries. UPI is QR code based P2M payments are being accepted in Bhutan, Singapore, and UAE, and this is just a beginning. I think in next 1 year we'll see quite a good traction and some other countries also being roped in. So that's what I have to say. Thanks.
Sajid sir, anything to add to this?
So two parts. Let me take the fraud part first, and then I'll go on to the everyone, everywhere part. I think fraud, Vidya did say the fraud rates in India are significantly lower than the Western world. RBI has ensured over I think almost last 10, 12 years, all regulations. First is OTP, 2FA for e-com, chip and pin card, then contactless 2,000 limit increased to 5,000. Now tokenization has ensured that India is, I think, at the forefront of all of these regulations. Europe used to be slightly ahead. Now, frankly, with tokenization coming in, I think we'll be ahead of Europe. Europe itself is the most secure kind of geography in terms of digital transactions. Second part, UPI by design obviously is a tokenized account, so that part ensures it. However, we have to understand in India, the population we are taking it to is massive with all levels of literacy. So it's not about ensuring it's safe in Nariman Point, it's also ensuring it's safe in Bastar with all of those calls going from Jamtara. So I think in that context, if you look at it, the regulations and the environment will have to be far more secure. It's a walk. The fraud rates in India are better than most of the rest of the world, but even 4 to 5 basis points, let's say on cards fraud to sales or UPIs, I think hitting 1 now, will need to be significantly lower because it's not about what those rates are. Those rates look good on an Excel sheet. The guy who loses that 20,000 rupees, the guy who loses that 5,000 rupees, that becomes a problem. And that then means he says, oh, cash is better. Let me just go back. I think there are some of these things we need to understand at a different level. Finally, technology will ensure answers, but technology by itself does not take calls, people take calls. I think once you understand that context and the linkages, we will keep walking down, partly driven by regulatory changes, partly what all of us as players need to do. I think that's the first context on FTS. So India is better than rest. That's not good enough with the population depth and just the kind of variety that we have over here. On the everyone, everywhere, every time, I think it's very, very interesting juncture. In fact, yesterday when I was thinking of this theme, I realized, let's say 10 years back, we would have given somebody a theme in bank or any of us, saying NEFT transaction should operate on card. We would have said, this is science fiction and not possible. How can a transaction which is happening on banking rails dovetail into cards? Then see what has happened in India. So you had NEFT, there was then an IMPS version. IMPS was given a different UI, UX with UPI. That's what it is, let's say 5 years back. Suddenly, and there is a parallel cards industry which is running. Then you say, I can do UPI on cards. Now just imagine this is happening in front of us. And sometimes we go back and say, oh, this is what happened then 500 years back. It's happening in front of us. There is an IMPS transaction which is now hitting card rails. And it is going to work. Got launched yesterday. Some of us are joining. All of us will join, obviously, and we hope to join pretty shortly. But fact is, this is real science fiction happening, made reality in front of us. That's the opportunity. Once you do it, smartphone, non-smartphone, I think it's not so much about can you enable, it's about doing, the experience has to be smooth. The non-smartphone population, by definition, is lower levels of literacy, stroke illiterate. How do you take this feature to them? How do you make them understand this is available? Is the answer voice? Is the answer text? Is the answer Varnak? I think we need to figure out those answers. Those answers may not come in a day. UPI took off smarter because people were already smart on smartphones. The rest of the population is also smart. It's just that the language is different. So some of those aspects I think will address the everyone part. Everywhere is started, I think yesterday 3 countries, and it will keep going further. We used to see, you go to Greece, you go to some place and you see those stickers of China Union Pay and you can pay. You used to wonder, India ka kab hoga? Now we are there, right? So it started off, and obviously whatever you start off, you'll keep walking down the path. Every time is fine. I think every time today you can do a transaction, NEFT is 24/7, so all of this is anyway there. I think every deal and pay more. That's important. Obviously, it's always got to be responsible, but I think that there is reasonable understanding in the industry today. But that is a very, very exciting opportunity. So I don't see it as counterpoints. It's not east and west and all that stuff, etc. This is all going to play with each other very, very closely together.
Existence and cash is also not. Yeah, Mithil, you want to say?
I actually, just to, Vidya, you want to go first? I actually think the linking of the UPI network and credit is actually going to lead to phenomenal growth. And actually in the last couple of years, I think the numbers Sanjeev said, these are all big numbers on big bases, right? These percentage points are not on small base. So I actually think that the linking of these systems will just massively accelerate the need for credit cards in the mind of the customer. The safety factor also on UPI is considered to be, great. And so I actually think that we're in a moment of actually massive acceleration. I think we're at the starting point, and it's going to be up and to the right.
Yes.
Yeah, I think I completely agree with Sanjeev. I think we are all extremely, we want to push all form factor of payments. And I think if you see what's happened in the last 3 years, and it's there in both RBI data, any bank data, I think what's really getting compressed is cash withdrawals from the system. What's getting compressed is checks. Payments Vision calls out that it will become eventually 0.25%. So with everything increasing for cards, I would say very, very exciting times on credit cards, because we are all doing great numbers. It's come in the recent articles about 40-50% growth rates from even last year, huge amount of consumption. And if we go to the core of what credit card solves, it is extremely aspirational as a product, and we want the economy to grow. We want consumers to aspire to have a credit card, to have a credit-free period. And at the core of it, a lot of consumers, a lot of Indians want credit. So it plays at the heart of that. So we see a lot of use cases expanding, like we called out, commercial payments is becoming very big, retail credit cards, a lot of the young professionals, a lot of the college kids also aspiring to want to have a credit card. And in the recent times, we are also seeing a lot of the self-employed community becoming a very strong use case. I mean, most of them want proper business solutions on a credit card. So MSME rollouts that are happening by all banks addressing that segment. So I think it is very, very exciting times for even credit cards. The volume speaks for it. The top line, if all of us are doing together, speaks for that. And I think most of us are working on a lot of partnerships also to drive that growth. So I think it's good times for all form factors, I would say.
Yeah, partnerships has been really, really, really good in India. Vikas, bringing it back to you. So again, let's talk a little bit more about the challenges, right? I'm still not satisfied with the discussion we had so far on that. Can you talk about what are the challenges in, say, P2P payments, merchant payments, from a non-bank perspective, if you can throw some light?
Sure. So first of all, like as you said, Amit, we talk a lot about the successes, right? And we had phenomenal success in India. But any success comes with the challenges, and those challenges are true and real today, and I'll talk about a few of them today, right? So the first challenge is with the success rate, still with the success rate. So when I, was part of the India journey, almost 1 in 2 transaction used to fail, right? And I remember even in e-commerce, it was even higher. When we fast forward to today, 1 in 10 is still failing, right? Even in UPI today, our success rates are about 90% at a total level. Now, when you compare it, so that's the success rates when the customer actually initiates and completes the transaction, but there's a lot of times the payment is not available, right? And then my guess is that's another 10%. So almost 20%, or other transactions, and 2 in 10, that are still kind of failing or not available. And in a system where we have phenomenal rise in payments, where, Sanjeev said 40% of the economy is kind of on digital payments, the payments just needs to work and work and work, right? Work everywhere, anytime, and anywhere. So we have to collectively solve for the success rates problem, because what we learn is when the customer payments fail and the monies kind of get stuck, is that's a very, very moment of anxiety. It leads to a lot of issues with trust, like should I really trust digital payment system, and should I just go back to cash, because cash always works. So, and then I think there are a lot of initiatives. What's good and heartening is there are a lot of initiatives that are sort of envisioned now that will address this problem. UPI Lite is one that problem, because a lot of success rates were because if internet is not available, right, or there is issue on the bank side or on the network and PCA side, and so and then also a lot of times customers don't remember the pins and other things, right? I think we are on it, but then there's still some real challenges on success rates that we still have to take to really make sure that it is working and working 100% of the time. So to me, that's number one, right? Number two, which is also very close to everybody's heart here, is around business model, right? While we've really made leaps and bounds in terms of adoption, customer adoption, but we still are challenged in terms of the business model and commercials, right? And something that my fundamental belief is that if there is a value that's getting added in the ecosystem, right, then everybody should participate and get part of that value. So there is a tremendous amount of value where customer was earlier paying cash in terms of counting cash, delaying, sales, long lines, all of it, right, is gone, and then now you can pay instantly and get out of the store. And if there's a value that's added to the merchant, to the entire ecosystem, there should be some value. And today it's kind of debated, but I think something that we have to really make sure that it cannot be so expensive that nobody adopts it, but it cannot be where it is today. So I think we have to collectively solve for what is there's so many stories, right, when you look at other developed markets where you can pick up from and then sort of see it. But I really think that if the commercials or business model does not exist, then you will not see the innovation in say 5 years from now that we see today, because that has to continue. So the commercials is the second part, and the third challenge is also on awareness and customer education, right? We discuss about frauds and how India is not really one India, I think hundreds of India, right? And each market has their own set of challenges in terms of literacy, in terms of digital adoption, in terms of all of these things, and awareness is a huge problem. I come from a tier 3 city in India, and people there, when you go and talk to them, they're just afraid of using anything digitally, right? Or just even adopting it, because they see don't know what's going to happen anytime I link something to my bank account. The money gets out, right? Immediately, instantly, and all my savings are gone. So the awareness, and while we've made tremendous amount of progress, but I don't think we've still hit 200 million customers. I think we're still in the 150 million customers that are using digital payments today. And then we have 500 or north of 500 million that have smartphones, right, and using digital content today. So there's a huge push we have to give to really educate customers in those of the benefits of digital payments, of why they're safe and secure, and how they can simplify, your life, right? Because people in my town still go and sort of stand in front of the queue and pay their electricity bill, where they can do from the convenience of their home. So I think this customer awareness and education, and then they also get prey to frauds, right? Fraudulent calls all the time, and then we've all of these stories that we hear every day. So as an industry, we have to also really up the ante on customer education and awareness, which I think will provide a trust. So those were I think the top 3 challenges that I see from my vantage point that we need to really solve to take this to the next level.
Very well summarized. Nitin, from your perspective, the challenges.
I actually have a very simple one point. I think all of us, again, we're all sort of from the industry, and we talk in very technical terms, and AEPS and NEFT and RTGS and UPI and all this technical mambo jambo, right? Normal customer doesn't care about all this. Normal customer cares about a magical, simple payment experience, right? And so ultimately, in my view, that's where the biggest challenge is. What is the killer, encapsulation of making all this completely invisible, right? right? Payment should actually be invisible. It should be safe, invisible, available everywhere. And so if you look back, right, I think credit cards was one example of that, right? Like if I tell you, if I woke you up, in the 90s, and if you were born in the 70s, and I said, oh, I'm going to give you a card which you can swipe anywhere and buy anything in any part of the world, that would feel like magic, right? Because actually it's actually indistinguishable from magic, right? And that's the same thing now you see with UPI, right? Which is from your phone, you can scan anything and you can pay. And that's again a great sort of, encapsulation. So in my view, I think to some of the points that Sanjeev made around getting more people into the system, because the points that you made around taking the 200 to 500 will actually come from a lot of use case simplification, making it easy for people to say, yeah, this is the better way to do it, this is a smarter way to do it, and you're missing out by not doing this, right? Whenever new innovations come by, you've seen adoption in India is crazy. When short video came, when TikTok came, we were the fastest to adopt it. So to me, it's not about throwing these terms at customers, कि तू ये करेगा, उधर करेगा, इधर करेगा, ये system है, वो system है. Boss, what's the benefit? Why do I care? And I think to a large extent, I don't think we're doing enough on that.
So I'm going to ask you to also talk about what does the future of payments look like? Are you looking at new technologies or new stuff coming up?
I think I'll speak a little bit from my perspective as a user and my wish list. I think that there are three large things that are going to happen, right? I think one that Vidya, you spoke about in your excitement around tap and pay, right? It's one of those magic experiences, right? You take your phone, you tap, money goes, no need to worry about it. And there's a lot of personalization that can happen. There's a lot of safety that can happen. There's a lot of that kind of stuff, right? So one is that dimension of just making it far easier to use. And I think, UPI Lite is a good example. I'm hoping UPI Lite will also enable tap and pay at some point. I'm sure Sachin, you're thinking about it, and the department's thinking about it. So one is the simplification of how to use it. I think the second is actually bringing down costs. And while I think a lot of my peers in the industry will think that costs are already very low, I think all of us will win a lot more if the acceptance networks and the acceptability and the interest in accepting just keeps going up and up and up. And we'll find ways to make money in other formats. So I think the reduction of costs even further is really, I think very important. And I think the last one is that I think the cost of credit over time also needs to come down. And again, I think, going back to how Sanjeev, you explained the progress of the country in many ways, right? When I was a young adult, at that point, the number of profiles on the bureau was, less than 100 million. Now we're charting 400 million. So our ability to underwrite, our ability to sort of make credit available and improve people's lives, like what does credit ultimately do? It enables people to get an experience today which they would have otherwise had to, wait for a longer period of time. And I think that dovetails right back into India's GDP growth. And you can see in most markets, most developed markets, consumer credit penetration is directly correlated to GDP growth. So to me, these are three things, just to, experience, acceptability, and reducing cost of credit.
Very interesting. Because anything to add, especially on future technologies or stuff that we have not seen yet?
Yeah, so no, it's very exciting in terms of the future ahead. So there's one that's very close to me is, right, when we look back, we all used to pay in cash, right? Then there came cards and made life a lot more easier for everyone. And then came mobile phones to say, like, look, can I pay from my mobile and I don't even have to carry my wallet, right? And it's all there on my phone. And I still feel like the next frontier to me is also voice. Voice-based payments, and I'm seeing it live with me that now even I find it convenient to sort of open the app and look for it and then sort of touch and then pay, right? It's a lot of steps, and as opposed to this, I can just talk and say, like, hey, in our case, Alexa, just pay my bill, and it just happens. The magic happens with the same level of security, with the same level of two-factor authentication, with the same convenience. Now you just talk to someone and just everything is done, right? And hey, just buy me something, pay my bill, do this, order me food, any of those things. So I really think the next frontier is on voice-based payments, and something that I'm very excited about. We are doing, a lot of use cases within Amazon Pay, but something as an industry is some where we can really leapfrog in terms of convenience, providing convenience for consumers and businesses, right, to make payments. The other one is tap and pay, and I think Miten touched on that. Uh, the thing is, any type of digital payments, who are we fighting against? We're fighting against cash, and cash just works, and it's very convenient, right? From a customer standpoint, you just take it out and then you just pay, and it works 100% of the time. And similarly, when you look at some of our experiences, still there are multiple steps, right? When you measure it from taking out your wallet, giving cash, and then it's done. So I think tap and pay is one such powerful experience when we get it on our phone, is something that makes it as convenient as cash. And I do these simple time and motion studies where I look at it, right, compared to when I'm paying in cash versus what I'm paying on digitally, whether we're paying on, I think tap and pay is one such experience which comes very close to it. So and voice is another one which comes even better than paying on cash, right? So I personally, and then there's always, more stuff on decentralized finance and everything that I don't want to mention, but I think the two that immediate ones that are very exciting that we are getting behind is, one is voice-based payments and two is tap and pay payments.
On the voice-based payments, just to clarify, are you talking about the one involving voice biometrics?
Yeah, so yeah, exactly. So today what we do is in our own ecosystem where you can just talk to Alexa and pay anything, right? What we are saying is we need more interoperable standards where instead of your PIN, your voice biometrics become the authentication, the level of authentication. And then when this happens, it's very powerful, right? Your whether it's biometric, your fingerprints, then your eye retina, and then your voice. Voice is a very, very powerful authentication, and it's very, very personal to you, right? With a very low any type of fraud rates or anything, because you're talking to live voice. So I really think that if we can really solve it as an industry, will be the next frontier to really raise the convenience of payments to the next level.
Very interesting.
So just on a lighter note, so you're trying to say that if you ask Siri to pay on behalf of Alexa, that would also be possible?
Yes, of course.
Siri and Alexa say
yes, of course.
eye to eye.
Yes.
So actually on that note, from a regulatory perspective, what are the viewpoints and initiatives regarding payments and settlement as we move into the future, as we think about how to grow it even further?
Yeah, so we have been talking about the vision document, and there are 5 goalposts identified for that. 5 I's, because catchphrases, we like them. So it's innovation, integrity, inclusiveness, institutionalization, and internationalization. So on the integrity part of it, we have been talking about frauds. So I think in UPI, what is the biggest enabler is that when you try to make the payment, you enter the VP or you scan the QR code, and what it fetches for you is the real account name of the payee. That gives you a trust that the person you're going to pay is actually the right recipient or the beneficiary. In NEFT or few other payment systems, the instances of frauds or instances of, you can say, the funds going to unintended beneficiaries, because it's account number based payment transfer. If a person by mistake or inadvertently enters a wrong account number, the funds end up going to a wrong beneficiary. So if we can have a similar kind of facility, pay lookup within NEFT or other kind of payment systems, that is one thing that was proposed there. Apart from that, something that is envisaged is Digital Payment Protection Fund, how it's going to pan out. But yeah, if we can have some sort of you can say consumer protection through that fund, it's what we're going to look into it on a bigger scale. Then on the inclusive part of it, how PIDF, which has almost created a good acceptance infrastructure within 1.5 years of its operationalization, January, and it has almost 3.5 to 4 times overshot its achievements. The intended targets were almost 30 lakhs, creation of 30 lakh touch points a year, and more than 1 crore plus has already been created. So how we can broaden the scope of PIDF? Because yesterday, if you would see during the governance launch, one of the partner who was there with UPI 123 Pay, he had asked that if the cost of operationalization of some of the modules in UPI 123 Pay is high, so what can be done? So if something can be thought on similar lines within PIDF, this is just loud thinking on my part, how it's going to pan out. But but then the scope needs to be revisited. And on terms of innovation, definitely we have traveled some part, but with the help of geotagging, how more we can go ahead in terms of reaching those geographies where so far we have not been able to touch upon. With the help of industry, a lot of fintech players are there. Maybe with new innovative technology, we'll just be prescribing the frameworks, but it's you who have to come ahead and make use of that framework to reach out those untapped geographies as of now. Apart from that, institutionalization. A payment advisory council has been, you can say, envisaged in that. So it will be, if as I understand it's going to come out, is that there will be players from the industry, some experts who will be roped in, and maybe it can be a project specific or it can be a permanent standing advisory body. Let's see how it comes out. But then they will be giving some inputs on a particular policy initiative if it is envisaged. And then those initiatives can be factored in by the apex body, which is the board for payment and settlement systems at RBI, while taking some policy initiatives. So that's going to increase the, you can say, the stakeholder partnership as we go ahead. And in internationalization, we are going to, I think 3 countries we already talked about, and handful of countries we're already reaching out to, but we are, I think, quite aggressive in our intent that our domestic payment systems as digital public goods should reach out to as many countries as possible, making life easier for our diaspora there, for NRIs there, while they send remittances, and for our tourists as well. Indians like traveling. I think apart from China, Indians are the second largest globetrotters. So as we go out, we can use our own apps rather than buying forex cards for that purpose. So this is something that I have.
Right. In fact, on the last point, I think Sanjeev was also mentioning, I have myself also seen, from Times Square to New York taxis to Dubai Mall to everywhere, right? We see these Chinese apps with, which allow you to pay with, QR code or other. This question is actually open for everyone, that is there an opportunity, a really big opportunity to export our payment technology now? And, initiatives have already been made, but anything else which can happen?
Anything else which can happen is that as and when it is rolled out, more and more expats over there, they start utilizing it. And I think COVID maybe pulled us down because the globe trotting habits were curtailed a bit. But I think in the countries where Indian tourists go, and mostly in European countries and in the Middle East, where most of our workforce lies, I think that they're going to take benefit of it. With the UAE and other countries, the P2M payments have already been enabled in UAE. But I think UK is also looking on a similar kind of partnership. So as we start entering the European territory, so you can see traction going over there. And there, means even the South American countries, even North America, they have displayed some sort of interest in our UPI framework. So how the partnerships are going to unfold, whether it will be direct integration or they're going to adopt the specifications, that time only will tell. But yeah, our digital public goods are something that we can definitely export.
Miten, you wanted to add something?
I just want to say something funny, actually. I think that if this was a private company building this, it would already be, probably $100 billion company, right? Like, at some point we have to wonder, government's doing a great job building the infrastructure, but actually taking this overseas probably will work well as a commercial enterprise. And I'm sure a lot of my VC friends in the crowd will happily fund it. It's actually pretty phenomenal if we get it out there, right? Vidya agrees as well, so.
Yeah, we also fine with the idea. There are 3 modes of partnerships: network to network agreements, central bank to central bank, and
so
sovereign.
TPG is right here to fund you, right here.
Sovereign to sovereign. But it depends on what kind of partnerships are envisaged by the partnering countries. Their jurisdictions also have to agree. They're also taking caution steps in this domain because it's not easy.
Anybody wants to add to this or any departing thought, last thoughts?
Just one, I think on the challenge part, I missed out my chance. I think one part we have to understand is there are two wheels to the payment infrastructure. Right? One is the issuing side, second is the acquiring side. The challenge today, one of the challenges is the acquiring side, there is no money at all, whether it's UPI, whether it's cards. I think that's something we have to look at as we are deepening. PIDF is definitely a fantastic measure on that side, but it's still not the core profitability in itself. I think that's something we have to, if the grease of the wheel comes off, it does get creaky. If you have to make it secure, you have to make it hold the kind of TPSs we need to look at that side of it. I think that's something we will look at separately, but that's one challenge which definitely does kind of hold us back. To what extent, I don't know.
Right. You know, we have 30 seconds left. I will just say a couple of things that I learned like 10 years back when we started, you know, building a fintech platform. And so one thing is that nobody gets up in the morning and thinks about making a payment today. Like, it's not something that you get excited about. And here we are, right? 10 years down the line, so much technology has been built, so many use cases. We are growing so fast. I think it will be very interesting to watch out, how some of the stuff that you guys talked about, which will come in the future, and about the business models and all of that. So thank you so much, guys. Thank you so much for all your inputs.
Just one last funny thing is that you do think of making the payment as the first thing you get up if it's your last date of a credit card payment.
You just did an ad for cred, I think.
We'll remind you on time, don't worry.
Okay, thank you so much, guys. Thanks.
Thank you. Come on, the number of people that are here in the room. Let's have a louder round of applause for that discussion. Thank you so much to the panelists, to this panel for this panel discussion. All right, also a reminder to everyone, or a note to everyone, that we have a session with the Deputy Chief Minister of Maharashtra, Devendra Fadnavis, happening in Jasmine 1 at 6:30 p.m. today. So we hope to see you all there. A session with Devendra Fadnavis, Honorable Deputy Chief Minister of Maharashtra, at 6:30 p.m. in Jasmine 1. And with that, we continue with our next session, the panel discussion on the gamification of investing, where to draw boundaries. While we set up for the next panel discussion, we'd like to thank our partners, our country partners, UKFCO and Kingdom of Netherlands, our credit score partner, Paisa Bazaar, conversational commerce partner, Carix, P2P lending partner, Faircent, VIP lounge partner, Cred, and our InsurTech partner, Cover Genius. We request everyone to kindly be seated. Everyone at the back, if you would like to move towards the front, there's a lot of space in the front. All right, we start with the panel discussion on gamification of investing, where to draw the boundaries. But before that, once again, now that you all are wearing your headphones, a gentle reminder that 6:30 p.m. today we have a session with the Deputy Chief Minister of Maharashtra, Shri Devendra Fadnavis, in Jasmine 1. So we'll see you there at 6:30. And right now, let's get started with this panel discussion. The moderator is Sagarika Shah, co-founder of Connextdoor. And on the panel, we have Ankita Das, CEO, Bullsmart; Saman Sikka, Chief Dreamer and founder, Squirrel Fintech, a wealth tech platform of Cashfree; Viram Shah, CEO and co-founder of Vested Finance; and Mr. Karan Mehra, founder of Tyke. Over to you, Sagarika.
Thank you. Is this audible?
Yeah.
Awesome. I think welcome to a in-person Zoom session, it feels like. I'll quickly start without wasting a time. I think we're running a little late. So I think welcome to all the panelists. We had a great session, a pre-session discussion about all things wealth tech back in the speakers lounge. So Ankit, I'm going to start with you, right? So the topic is gamification of investment, and just to set the grounds right, I think before we move on to the further questions, one common question for all of you is that what, in your perspective, is gamification when it comes to investing? Because it means quite a lot of different things, right? At times it's just confettis flowing over, or at times it's actually changing user behavior to, buy or sell something, right? So from your perspective, what do you mean by gamification investing?
Thank you so much, Sagarika, and good afternoon to one and all. So for me, gamification is 75% psychology and 25% technology, because gamification means, how you're getting the game inside, whether it be fintech, whether it be, healthcare, or whether it be anything, any education or learning. Everywhere, if you see right now, everything is gamified. So like we have seen many examples of, the discount brokers which are coming up recently. Okay, so the technology is growing, but at the same time you need to understand the psychology of the users, or psychology of the investors, that how they are thinking about the investment. Because the background from where I'm coming, I'm from a very middle class background. Okay, when I started back in 2011, when I was doing graduation from Alliance University, Bangalore. So at that point of time, I was not having any clue. Like, what is investment? I was not aware about the words stocks or investment. And yes, so because of, our internship, we have to do one internship for which we have to go to, one company, right? So I started with Reliance Capital, and my first investment was rupees 500 SIP. Then I got to know, okay, there is something, and it is glorified for me, because it was so amazing, because, with 500 I can, later on I can get huge returns. But at that point of time when, I was doing my MBA, I was not having that much enough knowledge, though curriculum was there, investment was there, a part of curriculum, right? But still I was not having that knowledge. Why? Because right now, if you see the generation over here in India, like only 3% of us are doing investment. Rest doesn't do any kind of investment. Why? Because they lack knowledge. They lack the access. Yes.
So I think from your perspective, it's about how you use gamification to give access to knowledge to the larger Indians.
Yes, not only access to knowledge, but we have to make it very much interesting, so that, because now if I'm very much scared, when it comes to money, everybody gets scared, right? Because it's about losing money, and it's about hard-earned money. So if, we make it very much interesting to the users or the investors, more people will come up, especially the young generation. Why not start from school? Why not we should start it from school?
Makes
right?
sense. Viram, over to you. Same question. What does gamification mean in your perspective?
Yeah. So, thanks. So for me, I think I've been trying to think of how do you break down gamification, right? And essentially, what the word itself means is implementing elements of a game, right, into an investment platform. And so then I was thinking of I used to be a very avid gamer, so I was trying to think of, okay, what kept me hooked onto a game, and I could break it down into three things, and I think that also sort of is relevant for the investing domain. One was every game has a goal, right? You have a sort of an end goal. If you're playing FIFA, you want to sort of beat your opponent or whatever you have. So you have an end goal in mind. That is one key part of gamification. Without a goal, it doesn't really work. Then the other thing that keeps you hooked onto a game is rewards, right? You want these. The goal is typically a very long-term goal, but you want to keep getting these rewards or variable rewards in between, so that you keep playing it. So that rewards bit is very important to a game, right? And the third thing that I found was interesting, and might not be in all games, but competition. Like, you want to beat somebody else, you want to be better than them, and that's what keeps you playing a game. So to me, all of these three principles actually apply to investing as well. What is inherently, I think, already there in investing, because it's so real time, right? Stock prices are moving up and down. You can buy, sell. So the goal thing is pretty much already there. Like, it's all real time. And you might have a long-term goal, you might have a short-term goal if you're a trader. So goal you don't need to really solve for. I mean, you can create UIs that help there. But the rewards and competition bit, I think there are interesting things that can be done.
Samant, to you, the same question. What does gamification mean in your perspective?
So I'm just going to kind of pick up from what my colleague here just was mentioning about. So I think if you have, while we are discussing this topic, I think it's important to understand that there are, to connect the dots, right? So we are saying gamification in the context of financial services and for the new age consumer. So I think it's very important to connect these three dots. And like Viram was mentioning, that every game has an outcome, but then it is a journey, right? Akin to levels, right? And then, of course, the most important thing in a game format is what? Is actually the player. He's the hero in that plot. And the other most important thing is that there is no defined path. So the player itself charts out a certain route, and depending upon their skill sets, kind of achieves the outcome. And I think when you bring all of these things to the financial services, we are any which way is one of the most complex and jargonized ecosystems. I often say that the list of things we cannot do is longer than the list of things we can do. Overlay the compliance aspects of it. We talk a different language. A common consumer today does not understand the language that we speak. And therefore, the principles of gamification become all the more important for somebody like financial services or fintech, so to say. And I think that, to me, is where the magic is going to happen. How do you simplify the adoption? How do you play the journey? It is no longer about selling a product. The other very important thing about financial services is, unlike, let's say, you ordered something on Zomato or you ordered something on Amazon, you completed the payment, you got the delivery of the product. That is the end of the relationship as far as that transaction is concerned. But on the contrary, in financial services, after the payment has been made, it is actually the start of a journey which could be very long. Now, if somebody is saving for a goal or is saving for taxes, it could be for years put together. And I think it is therefore very important to draw on those gamification principles, that how do we therefore continue to engage with the users and partake in the final outcome? How do we ensure that it is not about starting a SIP or buying a particular investment or buying a stock? How do we ensure that the outcome is actually achieved? And that, to me, is the real crux of gamification. If you put all these three dots together of financial services and the new age consumer that we have and the principles of the gaming itself.
Thanks, Samant. Karan, over to you.
Thanks, Agrika, and I think all of them have given a brilliant answer. I'm Karan, I'm the co-founder of Tyke. We built a bank for startups one of the services that we provide is called Tyke Invest, where companies can raise capital from their users starting as low as 5,000 rupees. So I represent the alternate investing angle of this panel. For me, gamification is the ability to get users to your happy flow faster and to get users to think that they have won while you have won as well. So it's a win-win situation to nudge and guide your user to invest in a certain manner or to do a certain action while creating a sense of reward and creating a sense of doing it again. Personally, I think gamification of investing does have certain boundaries which we will mention about later, but it definitely is the only way, or it's the only habit forming structure in which repetitive investments or repetitive actions can happen. So for me, summarizing what I said, gamification is the ability to make the consumer win while you're winning as well.
Interesting. Ankita, to you. So I think, like building up on what you spoke about awareness, right? So in India, if we have observed over a period of time, investing, especially when it comes to trading from a trading perspective or equity asset classes, has been handled by a small minority of very wealthy people, right? And it has now started moving, I think thanks to COVID as well. We have seen a couple of demat accounts opening up last year, but it has now started moving towards the larger consumer base. People at young age are starting to pick up, right? So in your perspective, how are you at Bullsmart, or in general, what's your perspective about how has gamification helped solve this problem about awareness? And since at Bullsmart you are currently solving for awareness as well, so your take on that.
Yeah, thank you so much, Sagarika. So at Bullsmart, we believe in 3 C's. The first one is continuing education, second one is companionship, and third one is community. And that's what we believe for. So continuing education, why? Because if we want to get more and more, younger generation, if we want younger generation to invest with us, not only just because we as a company want to earn profits, or as a company we want to earn fees or commissions, whatever we charge for, no. Because we want that, if a huge population, especially the youngsters, if they'll get the proper education about stocks market or investment, or how to save their money, how they'll get the return in future, those things can also help them to just complete their short-term goals like traveling or education, or buying some phone, anything it can be, right? So first focus should be continuing with the awareness program, continuing with the education from the very beginning stage, especially from the school. I'll not prefer that only colleges should be covered or universities should be covered. It should be covered from the very basic. So I would just like to cite an example over here. Like recently I've been to an orphanage, especially which was meant for disabled people. I mean, especially disabled kids. And I was amazed to see, like how they were, they have built their own community and they were exchanging the news for financials, and they are just 3 to 4 years. So, I thought that, yes, I have to do this. We have to come up with a platform where we can build the proper community for the retail investors, where, they can just exchange their thoughts as a friends. Okay? They should be at their bad time. They should be at their good time. They should be with when the bear market is going up, when the bull market is going up, and when the bear market is going down. So that kind of thing we have to build up, wherein, we have to support the retail investor in such a way that a proper community should be made. So here the gamification comes, right? Because whenever we see some challenges coming up, or when something is very complex, we'll restrict ourselves for that. Like will think यार क्यों करना है, यार मेरे से नहीं होगा, आज मेरे पास पैसा नहीं है, आज मैं नहीं कर सकती, मेरे को इन्वेस्टमेंट मार्केट के बारे में कुछ भी नहीं पता. I'm just a kid or I'm just a student. I don't know anything. Indian community is based like that. Whenever it's been talked about money or finances, kids are kept away from that, right? So that thing, first of all, we have to remove all those barriers, entry barriers towards the investment or securities or wealth market. Then only we can grow. We have to think about the people and how it can be done. We have to make it very easy. We have to make such user interfaces where people will enjoy doing investment. But yes, as Karan also said, that we have to keep in mind about the boundaries, so for which we'll talk about it later. Thank you so much, Sagar.
Thanks. Viram, over to you. So I think you have been into the US investment space, and in my own trading experience, what I have noticed in general parlance is that people move to US markets as a in long term in their journey, right? It's the first step is always the domestic markets. They try to explore things there. Only if they're comfortable with the domestic investments is when they move to maybe go explore equity options in US market, right? So since you are building a direct to customer product on the US markets, how have you maybe used certain aspects of gamification to make that journey easier so that it comes at an ease that you can directly step on and move to US markets simultaneously while you're doing the domestic markets, right? So your thoughts on that?
Yeah, thanks. So we might have done some things unknowingly actually. Is now when I look back at it, this seems more gamified, is what I realized when I was thinking about, what have we done. But you're absolutely right? So for our customer is a sort of a financially educated customer who basically would have started their journey from fixed deposits, went to mutual funds, did direct equity in India, and then eventually graduated to US stocks, right? So that person does not necessarily be old as they go through their journey, but it can be a young person who has sort of upskilled themselves as well, right? So these kind of financially educated people, now what you need to do to them is make them realize that you should be doing this. Like there is a part of your portfolio that should be diversified internationally. So for us, what we realized very quickly was getting people to the first trade, that first aha moment of buying an Apple stock is the most important thing that we need to do. Once they do that, then they keep coming back again and again because they realize, right, these are all companies that are phenomenal. They know about them. Why have they not been doing that till now? So that's been pretty much solely our focus over the last 2 years, where a lot of it actually was infrastructure building, which didn't exist, to open US brokerage accounts instantly, to allow people to transfer funds instantly. But there are some things that we have done from a gamification perspective to help people get to that first trade as far as possible. So 2 examples that, one is a minor one. So one is basically whenever you're transferring funds, we've built this product called Vested Direct, which allows you to load money in your US brokerage account instantly and online. Now, what we've done there is we've enabled live FX rates. So that's a sort of a gamification aspect where, hey, you can keep refreshing and the FX rate will keep moving up. So you're converting your rupee to dollar, right? So you'll keep seeing that price change, and that kind of interaction is something that people like. Like it's just, we've seen that people are just refreshing it for the sake of refreshing it, just to see it move up and down, and then they can sort of invest. So that's something which is a very small kind of gamification thing. It could have been a fixed rate. We decided to make it sort of real time. The second thing we've done, which was based on what is our primary goal, is getting people to invest first, is the referral program. Right now it's become very common, but we've kind of launched a referral program based on points. So from the goal, competition, rewards, we've done the rewards bit driving our most important goal, which is new account. So we've done rewards for folks who want to start investing. We started off with a simple kind of, hey, you'll get $10 yourself, and your sort of friend will get $10 if they invest. Now we've moved it to a new sort of points system where you can not only earn when whoever we've referred funds their account, but if they refer somebody and they also, so sort of a multi-level scheme, but not a Ponzi multi-level scheme. It's a legit multi-level scheme where you can earn more points, right? So there is a larger element of rewards in this entire picture. And I think lastly, what we've done, this is not towards our primary goal, which is getting somebody to start investing. This is more for people who are already investing in the US markets. The problem there is once you start, you don't know enough companies because when you're not hearing from your relatives daily, yaar, ye stock kharid lo, ye stock kharid lo. So discovery of new companies is something that was a problem that we saw in our customer base. And so there we used the competition element of it. So what we did was we launched a competition. We did it for the first time recently. It was called a sort of a DIY West competition where you create your own portfolio and enter it into the competition, and you will be competing against others based on returns that you see on a weekly basis, and then there's a grand prize sort of for whoever is the monthly champion. And so that was again something that actually, when we talk to our users, help them in awareness. Ki, yaar, oh, this company is also there. This is there in the leaderboard. This guy has added it to his portfolio, so I should look at it. And so we had almost about 1,300, 1,400 folks in the first edition participate and submit their portfolios. And we saw that these people were much more engaged, almost 40% more engaged than somebody who didn't participate. So competition in itself can help drive engagement was our conclusion. And this was an experiment which worked out. So we'll do more of these going forward.
That's very interesting. Thanks. Samant, so I think when we talk about Squirrel, for me, the first thing that pops up is the chitta saving aspect of it. And you were one of the first movers there, right? And that concept in India has specifically picked up quite a lot because Indians are very much into savings, right? And they would like to save each penny that they get, right? And with the whole now UPI thing that you can auto invest and stuff like that, how do you think is that part going to move? And also, if you can touch a little bit about upon the mutual funds aspect of it, since Squirrel is focused on mutual funds. So yeah.
Thanks. So I think, and this will be interesting for the audience as well, because Viram is obviously coming from a different side, right? He's looked at the, like I was having a chat with him, his average customer ticket size is far, far greater than what our average ticket size is. And he's looking at people who are, who understand at least some part of financial investments, have some investments, could have invested in a stock or an FD or an SIP, and now are going actually looking at cross-border, right? Whereas on the other side, we are trying to look at people who are just starting out. And our fundamental assumption is that they don't know anything about investing. And I think for us, it is not just about investing, it is also about saving. I think that is the first step that you need to start with straight away before going to investing. So we have multiple products on our platform, and obviously she mentioned about Squirrel Away, which is the roundup feature. That is more from building a automated savings habit. Now, we did a lot of consumer research, especially amongst the young Indians. And I must say that in a lot of forums and publications, they are talked about saying, oh, they are irresponsible with money and so on and so forth. I actually beg to differ. To me, the young Indians is probably one of the smartest race. I actually call them a different species. I think they are very, very smart. They have a very good idea of what they want to accomplish. It may be at variance with what people like me or my parents or the older generation may have wanted or maybe wanting them to do. But for them, finance, the moment you start talking about it, it is boring, jargonized, they lose interest. You start talking about shopping, that's much more fun. And the simple fundamental learning that we got from that is, they feel all this does not add value to their life. They feel, my last stint was with a bank, a retail bank in India, and they hardly contribute any footfall to any branches. They feel bank is boring, it does not add any value, investing is also stocks, it's speculative, only the brokers make money, and it's not about them. Obviously, last couple of years, lots has changed, but I'm just talking about a generic assumption. And therefore, it is very important to actually bring them into the fold and take baby steps, right? And when I was studying, one of the biggest successful products in India, an alien product category that was introduced to Indians, was shampoo. And the way they did it is, we were all used to taking soap bars to wash our face. And the shampoos actually came and they started with a sachet, a 1 rupee sachet, to say, it's a trial pack, try it out. If you don't like it, if you like it for 20, 30 days, then invest in a bottle, right? That's another matter. Indians being Indians would use the sachet for 4 days. We'll make a sachet last for a week. But coming back, I think Squirrel Away does that exactly. It is about building the trust with the user and taking it down to that unit economic of 1 rupee. Saying you can use, there is an antithesis here, right? What will your parents tell you? Don't spend money. What we are trying to say is the more you spend, the more you save. Because every time you spend now, there is a positive connotation. The loose change is going to get saved away, stashed away, down to 1 rupee, right? So that is the whole power of Squirrel Away. And to take those baby steps and get them into fold, earn their trust, earn the badge to say, okay, these guys have helped me do this. Now what more can I do? Next step is then goals. Now, what I feel is that in financial services, product selling is passé. For this consumer audience, you have to actually add value. So they don't really care what the product is, especially in mutual fund industry. This is a large cap, mid cap, this, that, and the other. They are saying, boss, मुझे तो vacation पे जाना है, तुम मुझे बताओ उसके लिए कैसे help कर सकते हो? And I think that is where we change the conversation by starting to talk about the product. Rather, let's keep the customer in the middle. We talked about that whole gamified approach. What is important for you? How can we help you get there? And in that journey, then we've built the sachets to say there is an adventurous way to get there, there is a practical way to get there. The remote control always has to be in the hand of consumers. You cannot talk down to them saying, मैं बोल रहा हूँ आप ये कर लो. It doesn't work. For this generation, the next generation, they want to be in control of whatever is happening. So I think those are the things that we are trying to implement. Of course, it's a long journey. You need to keep your ears close to the ground, need to keep speaking to them. And there are those nudges that you can build that Viram was also talking about, saying, okay, for this goal, for this duration goal, this is the most popular sachet that is being bought by everyone. Because this is a world of not advertising, but I would say influencing. So it's very important that you bring out the right metrics to speak to them, to engage with them. And I think those are the learnings that, that you get from the consumers themselves. It's just that you need to be nimble about then going back and implementing it and fail quickly. I mean, some things don't work, go back to the drawing board and kind of fix it, move ahead.
I think sachets help us do that very well, right? But thanks. I think the way you explained it kind of just hit me that how important gamification is in the journey of investing, right? Karan, coming to you, I think you are into the alternative asset classes, and it's not regular or it's not popular in India yet, right? So especially when it comes to startup, the word around is that it's a very, very risky investment, and which it is. So how are you kind of dealing with the whole consumer onboarding when it comes? Because I think you have to throw in a lot of rules and tools how to use about your platform. So how are you going about it and kind of gamifying the whole journey of onboarding?
Well, thanks, Agarika. That's actually a very interesting question. So I think one of our main responsibilities when it comes to making people give access to invest in companies which are fairly young is giving fair disclosures, right? That's how we started off, by disclosing to people that this may not be the right place to put in your entire savings. But as we've moved on, we've realized that people also want them to guide you or nudge you in a way where they're getting some understanding of, okay, you know what, if I have the ability of putting in 1 lakh rupees in a year in risky assets, how should I go about it? So one of the recent things we've launched is this feature called Tyke Expert. Now Tyke Expert is our way of nudging and guiding the user by helping him set up a prominent strategy to invest in companies which are live on the platform. One of the rules that we share over there is the 10-10 rule. A 10-10 rule is basically that you must invest only 10% of your disposable income in 10 different companies to be able to have a diversified portfolio. Additionally, I also think the ability for getting these users to continue investing is also by helping them understand that they can actually invest in products of companies that they personally use. These days, all of us are using products of early stage startups, and these products are actually what makes them try the particular company out. So we've seen multiple use cases where companies are actually setting up strategies in that manner, where they're actually inviting their own communities, their own user base, to back their community round, and that's increased retention, that's increased the ability of referring new users to the platform, and also a win-win, as I mentioned earlier, in the gamification aspect, that if I am able to get my friends to use his product, which is a good product, I win and so does the company win. So I think that's our way of gamifying, which is nudging you towards getting access to right opportunities in the right way, and at the same time allowing you to help the company grow while your investment grows. That's our thesis.
I think one of the things that he mentioned, communities, is something that again takes me back to childhood. Like I remember how loyal I was to my Counter-Strike clan or World of Warcraft clan, right? So that's something that in investing also can be applicable. But I don't think it's been, at least on a large scale, done well yet in India. And so there's a massive opportunity there where I think multiple folks are trying to solve. We'll see how it goes.
I think there are a couple of Telegram groups at max, but
WhatsApp,
we've not moved ahead of that.
I think we've got lots to learn. So I have two boys, and they are massively into gaming, from Minecraft and Roblox. I think if you watch these two platforms, the way they have changed the whole gaming community and the gaming as a, I would say, the game itself, it is much more social now, right?
Yeah.
And it is no longer about that Mario Brothers that I used to play. It's about, what is being co-created and played together. The competition bit that he talked about, Viram talked about. I think those are very, very fascinating subjects, and they have very deep applications for all of us in financial services.
Yeah, makes sense. So I think since we have very diversified backgrounds, every one of y'all, what I have done is maybe I have 4 different points in gamification, which I'm going to mention. And what maybe we can do is you can pick 1 or 2 on depending on in your journey what's the most important aspect, right? So the first one is discovery itself, where the user is just coming to know about your company or what you do, right? Or in general, if we just refer to the gamification aspect, it's the first step is discovery step, right? The second one is the onboarding, wherein the question that I asked Karan comes into play on how smooth is the onboarding journey, on how clearly maybe you're putting in the important intrinsic aspect about what's coming their way in their journey. The third one is scaffolding, which is largely repeated steps, if we can say that, just to clear the level, you have to certainly make some moves that are repeated in manner. And the fourth one is end game, which is essentially the user retention, that they come and play games again and again. So maybe from these 4 aspects, what is the most important aspect, Ankita, to start with you? When it comes to awareness or the sector that you're dealing with, which is maybe going to take a turn into a proper trading company, right? What is the most important aspect out of these 4 for you, for your users?
Okay, so let me just simplify it. I believe that for gamification, there are 3 factors. Okay, one is progression, second is competition, and third is community. Okay, so when I'm just talking about the journey. Okay, like everybody has their life journeys, everybody has their financial journey, everybody has their personal journey. Okay, so we go step by step. Okay, if we complete the first level, then only we can go to second level, then third level, then fourth level, right? So for me, the most important thing is that to simplify the things, to get the connection strong. Okay, if you are my friend, I would believe you. Okay, you are telling, we are giving rewards, we are, like leaderboards are also there, right? And sometimes we feel insecure also when we are in college, we feel insecure. Okay, this girl, Sagarika, knows so much about, stocks. I don't know anything. But yes, then you start, learning from your friends. Okay, this platform is coming up. So Bullsmart is also, it is about that. It's basically a fintech and investment platform wherein the community based AI would be interactive AI, where investors can correlate within themselves. They can discuss the things. Okay, they can just educate among themselves. So that is what the main important part is about Bullsmart.
Thanks, Nikita. Viram, over to you.
Okay.
Do you want me to repeat the 4 points if it got?
I'll try. Let me try and remember. I mean, I think I would pick two. And I mean, as a startup, you have limited resources. So probably one or two that you can pick, right? And one that I would focus on is the onboarding bit, because one learning that we've had in our last 2-3 years is kind of the first 30 seconds or the first 30 minutes of how a customer interacts with your platform is the most important. Like that will determine everything else beyond that, right? So if you're able to keep their attention for that much period of time I mean, if you gamify it and it helps you and things like that, like you show progress bars, all of those things, right? Then that will reap rewards across the entire journey, right? So your entire funnel becomes better. So that's one. And I think then later on the last one, I would pick retention, right? Because you can do so many things then. Once you have a pool of customers, you can make them compete against each other. You can sort of show what others are doing. You can, use all of that social proofing to drive certain behaviors, right? And now, where do you draw the boundaries there is the question. But if the end goal you have is clear in your mind, which is I am going to help sort of kind of like network effect, right? More people coming on my platform, I'm going to help them help others. And if you use gamification from that perspective, I think overall that retention of the platform increases. And so that's, I think, two areas where we'd want to invest. Yeah.
Massive advantages of sitting after Viram, because we obviously...
Because I mess it up and then you can...
Not at all. I think he articulates very well. But I think I'll start with the first one, discovery. From the perspective that I came on earlier, I think we are talking about a country of 130 crore people where only 4 crore PAN cards exist. And everything that the entire industry and all in this Geo World Center, the financial services is doing, is a subset of that 4 crore people, right? So I think the larger problem for all of us to solve is to first get more people to start engaging with the industry and their products and services. So discovery, to my mind, is a $1 billion problem to solve for, and therefore cumulatively and individually for all of us, a very, very important goalpost to focus on. The second thing you talked about was onboarding. And like I said, I think onboarding is something that you can do only marginally improve. The law of the land is law of the land for everyone. KYC has to be done, and there are certain things that have to be done as a part of process. I can polish it up, I can kind of make it a little slick, but fact of the matter is I can't avoid it. So to that extent, I would say that is a given. And I would also say that past few years, things are improving, definitely. So that's something that has to happen at a regulator and an ecosystem level. So I would just leave it at that. I think the second important thing for us, therefore, becomes retention. Now, why that becomes important is also, the context is important. We are not in ed tech, food tech. When I meet other founders and businesses, 40%, 50%, 80% margins are something that is par for the course for a lot of industries. We are a basis points game. And therefore, when you look at a basis point game business, the only way you can make money is at scale. And at the end of the day, when you go to marketplace to acquire customers, unfortunately or fortunately, you're fighting with the same guys for the eyeballs. So you're fighting with an Amazon, we're fighting with the e-com guys, Zomato guys, to acquire the same customer, let's say, on a Google App Store. So your CACs are not necessarily very different. And therefore, the second most important, therefore, it becomes the retention. That all the hard work that you've done of getting a customer to get up in the morning and say, I want to save money today. And then within the save money, I don't want to buy crypto. I don't want to buy anything else. I want to, let's say, invest in a mutual fund, or I want to invest money somewhere. And then the third decision to say, okay, amongst hundreds of options, I will, let's say, come to Squirrel. after you've crossed all those hoops and he's come into your fold, therefore it is very, very important that you work hard to make sure that that customer is well looked after and is felt welcomed and comfortable for as long as possible. So I would say that from our standpoint, the discovery part and the retention part are the true North Stars. North Star is a wrong thing because there are actually two of them in our case, but those are the two most important goalposts to look out for.
Thanks, Amant. Karan, coming to you, I think onboarding aspect we already spoke about, but anything else that you would want to talk about?
No, definitely. I'd also like to talk about discovery. Like Sir said, we're competing in a huge ocean of digital marketing spend with people of larger muscle compared to all of us here. So it becomes very difficult to get people to be interested in something different, right? So definitely getting even, and our target audience is actually much smaller because very few people are even understand alternate investments, right? So what we do is we actually tried something different. We asked our companies to throw in a notification on their website or on their application, telling their users that, hey, you know what, we're doing a community round, and because you believed in us from day one, why don't you check it out? Now, a company that is selling supplements or a company that is selling insurance is suddenly sending you a notification or an email saying that, hey, you know what, back us in our next round. And that really helped us with discovery. That really helped a lot of people come on board, a lot of credible people come on board and convert faster. So I think discovery, again, was a form of gamification for us, where we actually told the end user, which is basically, technically, if you link it to the stock market, it's Reliance telling everybody, saying, hey, you know what, come back as our next FPO, right? So that sort of really worked out well for us. Additionally, I think what I would also like to talk about is retention, which is again where the community comes in. The community actually is helping other companies that they personally have backed by buying their products in their community rounds. So that really helped us to retention. So our job as Tyke was to get as many widely known private startups on our platform, and that really helped us get a good number of users on board. But I think for us, like Sir said, it's exactly the same thing for us. Retention and onboarding are more importantly the most important things to solve for. Other things I think do fall in place.
Thanks, Karan. So I think coming to the last part of the topic, which is where to draw a line, right? And for me, just to put a perspective when it comes to investing, I think the line is the thin line of difference between a gamification technique turning into a recommendation, right? And how, in your perspective, can we avoid anything that maybe turns too much into recommendation to completely change the user behavior and make them do completely something that they would not have done otherwise? Ankita, starting with you.
In this generation with the millennial and Gen Z generation, I mean, people get easily influenced or distracted, right? We have seen in the past, like, when they get addicted. I mean, you have seen in the case of Robin Hood, because of, that one young boy committed suicide, right? So that thing we have to keep in mind, that whatever it is, it shouldn't be that much addictive. Yes, we have to gamify the things. We have to, make it easier for the complete crowd. But we, at that point of time, we have to also see that platform is sustainable, and the business should not only think about their short term goal. They have to think about the long term goal, and the long term would be, if you focus on the awareness, it will, if you would be focusing on making the things easy and efficient for the users, right? So for me, I think the drawing the line would be to make a platform very much sustainable. Otherwise, it would be game over.
Thanks, Ankita.
Yeah. There's a fundamental issue with investing platforms is that you make money off of something that might, if you incentivize more, might not necessarily be the best for the user, right? So if you're making money off of trading, and naturally you as a product manager, as a founder, you don't want people to trade that much, but then your revenue model is driven by that, and so then eventually you're going to be measured in terms of, if you're raising money or things like that, you're going to be measured in terms of, okay, what's the trading volume? So then you're going to be like, okay, how do I incentivize trading volume? And then you end up putting in gamification techniques to make people trade more, which is the big issue, right? And which is what kind of has happened across companies. And so I think recommendation is a part of it, right? You give them a recommendation so they know what to buy, and then they again invest more and things like that. So I mean, in the end, I think this is such a weird thing where your incentives are not aligned as a company, and so either you don't take money externally, which pushes you towards increasing revenue, which I think Zerodha has done really well, or as a founder, you have to be very, very clear that, you know, I'm not going to push the wrong things for my customers. I'm not. I mean, it's tough though. If especially when you're facing a lot of heat, it's tough to take that decision that I don't want to push sort of a behavior that's going to be wrong for my customer. But then you have to draw a line somewhere saying that, okay, this is not right. Long term, it will benefit me. Right now, I don't want to push it forward.
Makes sense. So I think just try to avoid as much as more often trading behavior. If that's not something that your customer often does, you should not maybe nudge that behavior, to conclude.
Correct. Yeah, exactly. But it's very difficult to do because your revenue is going to come from that. So how do you do it?
Yeah. Someone coming to you, I think.
So I think the hardest thing that I've learned in life is to maintain balance. I think it is very easy to take an extremist stand on anything. I think the hardest thing is to keep the balance right. And I think I would go back to that same statement when we're talking about gamification. To ensure that you don't go overboard with gamification, I think the biggest risk that you run is that you may actually lose the seriousness itself of what you're doing in the eyes of the consumer. If it is too gamified, the customer may actually find it very flimsy. So I think that is one part. The second problem that I have is, and I want to go back to the point that I think Ankita alluded to, unfortunately, in our country, financial awareness is a pittance, right? We're all so busy making our kids learn physics, chemistry, maths, and make more money, but they don't know what to do with that money once they've made it, right? And I think that literacy is a big issue around here. So let me ask a question. How many of you believe, just a show of hands, or have heard of this statement, or agree with it, high risk is equal to high return? 30, 40, 50% of the hall feels right? By that logic, right, if I keep increasing the risk, infinite risk should be infinite return, right? So actually it doesn't work. Higher risk actually equals to lower returns. And there is this whole thing about the line between speculation and investment has got completely dimmed out, blurred out, especially in the context of what's happening in the last 2 years, right? So when Sagarika says that I started trading, so my red lights kind of go up, right? That actually, do people really understand the difference between trading and investing, the speculation and investment part? And I'm not saying anything to you. Please continue to do that.
Sure.
but I think that is where the line has to be drawn from a gamification standpoint as well, that you cannot, and then last point on the gamification part, and I again go back, if you are in financial services business and you cannot respect and appreciate the compliance part of the business, please find something else to do. Because I think you have to build a deep respect for that before you try and build out that business. If you're going to be disrespectful about compliances and regulations, I don't think you have a very long story. Game over, like she said. Even either now or some point in future where you'll be out of money and capital and time and opportunity cost. So I think from a gamification standpoint as well, just to gamify and add that gimmickiness should not come at the cost of regulations and compliance. I think that has to be, I see so many people are in a quick hurry to launch something, and after it has reached a certain milestone is when they're starting to now think about, okay, how do we now start becoming compliant? But I think some of that stuff has to be baked in right from day 0 or -1, to be honest. So I think that is where I would draw the boundaries as far as this topic is concerned.
Thanks, Amant. And I think in India, the whole, SEBI has been quite actively doing the compliance check before anyone or gets into the game. But Karan, coming to you, where do you think we should draw the line?
I actually have a different opinion. I think there has to be a way in which you can nudge or guide the user into a certain activity without necessarily telling him what to do, right? So let's take an example of how professionals invest, right? Professionals invest by studying research papers, by studying volatility in the market, by studying the global markets, right? That's how they invest. Is there a way in which us fintechs can present that data to them in a very simple manner and say, hey, this is what is happening in the world, and this is the information basis which people are making decisions? Do you think this information allows you to make an informed decision which is entirely yours without any corruption coming from my end or gamification in that sense? I think that is, I personally think that is where regulatorily and as a business you're happy, right? That is the right balance. I personally think you need to tell people that this is how experts or wealth managers or top players invest. This is what they do. This is the information that they have. These are the trends that are going on in this space. This is the information I'm providing you for free in a very simple manner. If this information allows you to make a decision, that decision should be completely yours. And I want to be able to reward myself for giving you that data and not for tipping you to invest somewhere, right? I think that personally for me would be a happy position to be and a long-term play to be in as well, where you're creating financial awareness directly or indirectly, and at the same time you're increasing the wallet share of your own user, and you're able to increase trades and volumes as well. So that's my personal take, and I think that's my happy flow.
That's a very interesting point. I think if we had more time, we would have maybe touched upon data plus gaming aspect. That looks very interesting. But I think we are short, time's up, and thank you so much everyone for being here. I hope you learned about gamification aspects. I see someone has a question. Can we take a question? Is there someone?
Hey, hello. My name is Charvak. I want Mr. Sikka to specifically, explicitly answer this particular context of why we as an industry are being focusing so much. See, we have been discussing a lot on the credit gap that we have, people not being able to access the formal credit that we have. We are not discussing a lot about the this investing gap that we have. The topic itself resonates where to draw the boundaries. So gamification, it's something. Please correct me if I'm wrong. Investment is a multi-generational business, right? So gamification has to be restricted up to some point where in which we make people understand that you really need to get in touch with the financial markets so that we as an economy can leverage that potential as well. But why there hasn't been hype around this particular context? I really want to understand what are your opinions about it. Thank you.
Sorry, I didn't understand your question properly, but your question is that why aren't we creating the hype?
Yes, as compared to the credit hype that we have.
Yeah. So I think clearly we are a credit-starved, we are a capital-starved nation. There is no doubt about it, right? The number of entrepreneurs that you meet and the fact that we have had chit funds and we have had informal credit where people pay 20, 30, 40, 50% interest. They're not even able to calculate the amount of interest that they are paying on their business. And their business is actually able to afford that kind of margin. So clearly, I think credit is a very large problem to solve. But heart of hearts, I'm very happy that you asked this question. I believe that all this BNPL, buy now, pay later, actually should be SN, BL, save now and buy later. I think this delayed gratification has to be built into our society, because then we are also seeing on the other side of the pendulum of what it does. 20 years of aggressive credit-led behavior on retail, what it does to the society in terms of their saving habits. And therefore, it brings me back to that same point of staying middle of the fairway, right? That balance is very important to say that are we going to be a completely credit-led society or are we going to be a completely saving society? I'm not, batting for either of those. If at the moment, because of the alignment of stars, credit is starting to do well and we are putting in place all the machinery for that industry to do well, by all means does not mean we need to put brakes on that. Can we do more on this side as well? Answer is yes. I think SEBI has done, I would think, perfectly well. Personally, I feel that they could do much, much more. But I think keeping my personal ambitions and ideas aside, I think we are on the right path. And as an economy, we are doing extremely well. Look at the number of new additions that we have had to capital markets in the last 2 years. Unfortunately, due to COVID. But fact of the matter is that I'm assuming those guys are come. A lot of people will burn their hands, but may not go back from the industry, will try different approaches and continue to participate. So can more be done? Answer is a big yes.
Hello. Oh, yeah. I'll just add one more point. Fundamentally, also credit is just easier to scale, right? You're giving somebody free money versus investing. You have to put in your hard-earned money, and then you lose some, and then you're going to drop off. So, I mean, that's. I don't know how you solve that.
One anecdotal story. When I was starting this venture, I went to my CA and I told him कि मुझे एक company form करनी है. He asked me, Samant, what are you planning to do? I said, I'm planning to do this investment business. He says, why don't you start a lending business? So I said, look, this is what I know. This is my bread and butter. I've done this for 20 years. He says, मेरे ऑफिस के बाहर अगर 2 लोग बैठे होंगे, एक मुझे लोन देने आया है और एक इन्वेस्टमेंट्स के लिए लेने आया है, तेरे को क्या लगता है मैं ऑफिस में पहले किसको बुलाऊंगा? Right?
Very
so
well put. Very well put.
Clearly there is the die is rolled against us and in favor of them from that matter. But I just feel that both of them have to go hand in hand. So one shouldn't feel let down to that extent.
Hi, can you hear me now?
Yeah.
Yeah, I'm Deepak. I'm coming from True Balance actually, which is a lending platform actually. So this question is for both of you actually, Vikram and Samad actually. So because
Viram and
yeah.
Name always gets messed up.
Yeah. So what I see is from the entire gamification, what you guys are discussing is about the people who are onboarded to investment platform. Okay, but if you can also think about the gamification part, when a normal layman comes into a banking financial sector, it doesn't come into a place where the investment or the insurance category, which is the last 2 categories actually of a financial sector. But first 2 categories is the saving account, then lending account, and after that only the investment comes and goes actually. So if you're building a system for the entire generation, it could be really helpful for us to see your gamification should include multiple funnels actually, so that you teach them first is a saving account, then saving the money, then putting that investment money, then creating an insurance upon that. So this is my approach, what I see as a strength of gamification. So if you have any comments, it will be really helpful.
I think very well put. The fact of the matter is, unfortunately, our country has a multi-tiered regulatory environment. So, RBI looks at the banking system, SEBI looks at the capital markets, IRDA looks at the insurance part of the piece. So there have been historically, everybody's looked at it myopically with blinkers on to say, how can I solve? I will only do this, I will only do this, I will only do that. And to that extent, that is the opportunity for all of us, including you, to see how we can actually bring all of them to a consumer together. right? And there are multiple people who are trying to solve that problem, including you guys. All this talk of neobanks, to my mind, is exactly that. So I think we're on the right path on that, and coming, maybe, I don't think you have to wait for a decade. I think next 5 years will change the character of how consumers buy, sell, engage with financial services and products.
Yeah, I mean, I was just going to say exactly that, right? Kind of what we're doing is going deep into the investment domain, but what essentially neobanks are looking to do is apply that gamification layer across all your financial life. So it's definitely going to be something that you'll see in the near future.
And sorry, one word of caution, right? Please don't read my comment saying that I've written off the existing incumbents. I think the banks are also the smartest guys in the room and the biggest guys with a lot of capital and customers. So they're also coming to the party. They may be coming through a different door, but they are not going to miss this party. They're going to be here.
Thanks. I think if we have time for one last question.
Actually, we'll have to take both. Yeah, please.
Yeah. Hi, I'm Manpreet. You all are founders here from the investing startups, I can say. So my concern is here because I'm a part of that industry also, and I'm also a trader and an investor in the market from past 5 to 7 years. But what I am seeing right now, what companies or startups are doing, if we go with that gamification term, what exactly they are doing, they are kind of, to make it interesting, to keep the interest of the customer. They are now manipulating their interest with that kind of contest you guys have discussed going on within the app. And there are some platforms which are providing that simulation thing for trading, like paper trading as we say the term. But in that, they are also providing for the investors, like you can invest your real money, very small, with the 100 rupees only, the 10 rupees only. But what's your thought on that thing? Because SEBI has their compliances, their regulations on that, but still those apps are, kind of influencing the greed of the retail investor. So how you guys can, make, I can say, put the stop on those stuff, because that is not kind of investing thing.
So, Manpreet, I'll take that quickly because we're running out of time.
Sure.
We need to take one more question. So, my answer is very simple, right? The laws of nature will take over, right? If I am running a platform and I am trying to make it gimmicky for you and I'm trying to give you rewards for continuing to trade where I make my fee and you don't end up making money, my life or relationship with you is short-lived. You will very soon be out of money, and you will definitely not just leave me, you will look at everybody else with suspicion. So I think this is the law of nature, and this is also I would say, part of democracy. I can't say what you are doing is wrong, right? And the consumer is actually going to decide what if I'm doing wrong or you are doing right, the consumer will reward with their wallet. So I think there will be companies that will come, and many will come, and many will fail, and few will survive. But that's absolutely fine. I don't think we need to be judgmental about it today. I think we need to encourage everybody and let the consumer vote with his wallet.
Thanks. I think just one last quick question.
Thank you so much. Hi, I'm Riddhi from Lakshmi. It's a fintech platform for women, and like we were discussing, a neo-banking platform.
More power to you.
Thank you. Yes. And like you were saying, the right journey where you learn, get confident, save, invest, then loan, collateralize it for better interest rates, right? Now what we faced, and we're looking at gamification. And like you also said, we don't do anything that's not regulated. We don't do digital gold. We'll say only gold mutual funds or sovereign gold bonds. But now there's obviously a lot of players coming in the market, and they'll promote digital gold. Now, as per compliance, you cannot give financial benefits for investing. But most of them come and say, here we can get the share of Apple, or you can get digital gold. They're not being compliant. We're not sure how. So do you think with gamification and without breaking or following compliance, there are ways to kind of compete with these other guys who are not following compliance?
My answer is an absolute yes. How long have you been doing this?
It's a year, so we are fairly new.
So first of all, I want to tell you that women are better investors than men.
Yeah.
I think you guys have far more stronger emotional quotient when handling money. We guys end up pressing all kinds of buttons on the app and buying everything. But you guys are definitely better. So a good choice of focusing on women. The other part is, I think if you continue to do this for 10 years, many will come and go. And I think the intent is to, so when I look at it the other way, I think getting rich is easy. The hardest part is staying rich. You can make a trade today and make whatever 50,000 rupees, and you will be feeling on top of the world. And just the chat that we were having, that tomorrow you feel you are the know it all, and the market has a way of teaching you. And I think to that extent, the intent has to be survival, and therefore the focus is on making sure that the business cannot be at risk, consumers' money cannot be at risk. Everything else is, and it is a daily battle. I'm saying it very easily. It happens every single day. Sir, competition ने ये launch कर दिया, उसने ये launch कर दिया. So I think that is the distraction and the noise that you need to kind of insulate yourself with. And the idea is if you, so here is the other thing, right? Discipline eats strategy for breakfast. So if you decide that this is what I'm going to do, and this is what I'm going to do, then I don't think there is a reason for you to worry about what somebody else is doing today and tomorrow and day after.
Is there time for one last comment?
Thank you.
So,
no time.
Yeah, we're already very late.
Fine, no
So we can take that offline though. You can discuss that with her offline. Thank you. Let's have a round of applause for this panel, everyone. Thank you so much. And our photographer is missing. Okay. Yeah, photographer is here. Can we have a group photo picture, please, of the panel before we exit? And once again, we have a session with the Deputy Chief Minister of Maharashtra, Devendra Fadnavis, happening in Jasmine 1 at 6:30. We hope to see all of you there. And we will be back in a short while with a panel discussion on how digital lending and fintechs are changing the SME finance scenario, UK and India perspective. We're taking a short break here, but we'll be back soon. Thank you. Check, check. Check. You'll have to wear it to be able to hear me. Check, check. Am I audible? Audible? Yeah? All right, may we request everyone to kindly wear your headphones and get ready for the session. We start with the next panel discussion, but before that, we'd like to thank our partners, theme partner WhatsApp, co-powered by Amazon Pay, spend management partner Encash, in association with Perfios, our payments partner Cash Free Payments, and CEO's dinner partner HSBC. We now start with a panel discussion on how digital lending and fintechs are changing the SME finance scenario, a UK and India perspective. For this session, our moderator is Ms. Visa Kannan, partner Sison Capital. And on the panel, we have Mr. Anup Nair, Country Head, India, Interpolitan Money, Mr. Akshay Chopra, Senior Director, Growth, Jokata, Mr. Vishal Gupta, CEO and co-founder, Hylobiz at Vienna, Mr. Gurjot Pal Singh, CEO, India, Tide, Mr. Sandeep Kakar, Chief Business Officer, Veen, and Mr. Vipul Sharma, founder and CEO of Checkbook. Let's welcome them with a round of applause, everyone. And over to you, Ms. Kannan, for the panel.
Thank you. Thanks so much. Can you all hear me, everyone? Okay, fantastic. Thank you, everybody, for joining us for this SME lending panel. So I think SME lending has largely been in the news for about 5 to 10 years now. The credit gap in India and all emerging markets is actually pretty well known in terms of how difficult it is for SMEs to access loans from traditional financial institutions. And fintechs in a very large way have tried to bridge this gap. So welcome all fellow panelists to this discussion. Would love to get everybody's perspective. And everybody comes from very diverse fields here to tackle the same problem. So hopefully it should be an interesting discussion. So just to, I think, kick things off, let me go to Vishal. And if you can, lay out what the problem statement is, what fintechs are doing to help, and just kick us off into this ride would be lovely.
Sure. As fintechs, right, within the SME world, the whole supply chain ecosystem, fintechs are essentially expected to go few miles deep into the SME's life, understand their day-to-day trade, and I guess then effectively the credit can be laid, essentially the segment that we are talking mid-tier and going into the long tail. What is missing and what has been missing all this while for the traditional banks and the FIs is largely access to data. What is that these SMEs do? Whom do they deal with? Whom do they sell to? Whom do they buy from? That visibility is very rarely available, or it's highly unorganized. It's in possibly 5 different tools and 10 different systems, or possibly just on the piece of paper. for the segment of SMEs essentially that we are talking of. See it as wholesalers, distributors, traders, regional manufacturers, going long tail into retailers, micro distributors. I mean, that's the segment essentially, just to lay out the position that within the value chain that at HiloBiz we address. And to be able to handle that, I guess from fintech's perspective, what we always looked at it is go after solving the 4 C's problem of these SMEs. And these 4 C's being help them ease out on their day-to-day commerce. So basically you need to be there on the day-to-day transactions of this SME, ease out their commerce, which is their day-to-day trade documents, orders, invoices, purchases and stuff. Second C, ease out on their cash flows, basically their collections, their payouts, and digitize it through, again, being as much as invisible that you can be. And both these pieces are possible today through connected ERP APIs, through connected banking APIs. We can look at commerce getting digitized. We can look at banking getting digitized, AR and AP getting digitized. Third C, as and where applicable, is largely the compliance, wherein in an infrastructure that India kind of nation provides, GST data is available, e-way bills, e-invoices, plug into that, solve that side of the problem, and again, be on the flow of the transactions for these SMEs. And these are the 3 C's, which from HiloBiz and Vayana's perspective, as a fintech, we see is the strength that we can deliver in the ecosystem. And then credit is something which becomes much easier for a FI to lay on top of this data. So I guess largely the data availability, easy access to data to be given to FIs to be able to underwrite is the problem, and that's what fintechs are solving for, and that's what we are doing.
Got it. Guju, just bringing you into this conversation, I think Vishal's point largely is that the fintechs use a lot of data to, lend better. So you underwrite better. You kind of have an ability to kind of figure out, I guess, intent and, ability to pay. Given you come from a UK, India kind of perspective on SMEs, would love to get you in on where you think the UK is different. Is it different? Are SMEs in developed countries? Are they ahead of us in terms of, where the credit gap is? What does India do to get there from a fintech landscape perspective?
Sure. As he said, it's very important to get the digital footprint for SME, for anybody to underwrite and lend efficiently. That is an important problem to solve. But how do you get to that? So in UK, we are the largest challenger bank focusing on SMEs. We have close to 9% market share there. Now, how did we manage to do that? Was that we were present where a SME needed us. So we start with offering him a financial platform when he needs it very quickly. So we do everything digitally and enable him with a financial platform so that his pay-ins, payouts of the business start. From there on, we play important role in their journey of getting organized. So the new to organized and unorganized to organized are both very important TGs for us. 20% of our base has registered on Company House, which is a combination of say MC and GST for India, through our platform. So that's a role we play, and then we bring bunch of tools. I'll talk about a few. Right, we help them do tax compliant invoices. With that, we have built tools which will help them collect, right, reminders, etc. And as they collect, right, how do you reconcile that payment? So helping them with this entire financial and admin essentially, solves a problem, and hence, they are likely to use the platform, and we will get more rich data from their side. Another product which has done very well for us in the UK, we call it Credit Builder. Now, a very important question for micro and small enterprises is, who gives you your first loan, right? So with this product, with all the data that we have, right, we assist them in, starting with smaller lines so that over time they are able to get efficient credit from the formal, financial ecosystem. Now, this is all in UK. Now, coming to India, right, our thesis has been that, the SME needs globally are very similar. And considering, UK and India have similar framework in terms of in terms of the way our systems and laws work, right? We saw a fitment there, and that's been the case with a very small base that we have now. When we interact with the users, if you look at these micro and small enterprises, somewhere around 60% of them do not have anybody doing, to do finance on their teams, or they do not even have GST. They waste a lot of time in bookkeeping, reconciliation, these kind of pieces. So if we, when we bring these to them, right, it's really helpful. Other pieces, the traditional banking system, right, they do not see it as a transparent system. A very large percentage of them are impacted by hidden costs, are impacted by off times, and then they need to spend a lot of time doing admin and cash management, etc. So if we try to bring all that to one platform, and when we do that, there is more likelihood of him using it and bringing more data, and which essentially solves the chicken and egg problem. You have the data, and then you bring the first credit, and then that flywheel starts, and you are able to bring working capital to the micro and small enterprise as and when he needs. So that's been our view in the ecosystem.
Sure. So that sounds pretty similar, actually, the India experience and the UK experience in terms of, the necessity for credit, of course, but also, how you go about solving it sounds pretty similar. I think this is a great time to...
And maybe sorry about that, just to add to it, just one last piece. With the UK and India trade agreement coming up, right? I think it's again a very good opportunity for somebody like us to have SMEs on both the sides, do business in a very organized way. So that's also a great opportunity we see, and a focus area for us.
Great. I think, like I said, great time to bring in Vipul. In terms of, I think what Gurjot mentioned was a lot of SMEs, and I think we also know this intuitively in India, right? They're not ready for any sort of data services because they don't have the entire platform ready, or they don't have preparedness to access financial services. And we know that you've been trying to solve this problem for a couple of years now. So, what is your perspective on this readiness to access financial services?
Right. So I think, if you go back to like when I joined, Hdfc Bank in like 2006 time, a lot of people over here as well might remember that at one point you could, they used to get cash salary, salary with check and so on and so forth. And banks used to accept that when they would give loans. And then I remember in 2006-07 in HDFC Bank, ICICI Bank, the larger banks, we all kind of decided that, okay, you need to have the salary coming in your account, and only then you will get, loans on credit cards and auto loans and so on and so forth. So that was really the watershed movement when, suddenly all corporates started having salary accounts and deposit in the accounts and so on and so forth. And for a lot of people in the salaried segment, which is about, about 7 crore customers in India, the reality is that the reason why the salaries go in the account and all of that is because it becomes a ledger of information, basis which then you can get your credit cards, your auto loans, your home loans, and so on and so forth. And I think that ledger ecosystem hasn't really built up on the MSME side, on the sole proprietor side. And, you must have heard about 63 million MSMEs in India and so on and so forth, which is about 6.5 crores, similar in size to the salaried ecosystem. And the reality is that only about 50 lakhs are private limited and partnership firms. The rest, almost 5.5, 6 crores are actually sole proprietorships, running shops, running, cloth stores, bartan ki dukaan, chemists, all of that stuff. So that's the large ecosystem. The problem is that why they don't put money in accounts is because they don't get lending against it. Just like if you weren't getting your home loans and I wasn't getting my home loan, auto loan, I would be like, why should I get money in my account, right? So I think the reality is that that's the culture we need to give. And there's a catch-22 situation there where larger, older banks at times have said, once you have like a 1 crore turnover, 2 crore turnover, then I'll open your current account, I'll let you have access to lending, and so on and so forth. And that kind of becomes a very weird situation because the customer actually, the Kirana store owner, for example, actually needs lending to be able to get to that turnover. So that's Cash 22 is what we're trying to solve for by really giving him the opportunity to open sort of a digital account, right, a current account. So we let customers open a current account in 3 minutes. In traditionally it takes almost a month to open a current account. We're able to give him access to lending from the get-go, and we give him what we call needle mover loans. 3 lakh, 4 lakh loans, because if you give him a 5-10,000 loan, it just goes into some kind of consumption or goes into buying working capital or whatever. But needle mover loans allow him to actually modernize a shop, actually get into a new distributor relationship, or get into a new ancillary business. We have customers who are at a grocery store, and then they set up a kitchen at the back, and now they are also making food and delivering in the ecosystem. So I think that is transformative for the customer and actually leads to higher revenues. So similarly, we give insurance. So we have an insurance broking entity, which is a 100% subsidiary, and through that we are able to give a credit life. So if the customer dies, it doesn't mean that the family has to sell the shop. And we've seen situations where the customer died because of COVID or whatever, and the son, they had to pay off the loans, they had to sell the shop, and the son became an Ola driver. It's unacceptable. It's a generational loss. So how do you kind of fix that is where we come in. We're like, okay, you got insurance. If something happens, unfortunately, your loan is covered. You continue on your path, right? Giving shop insurance in case of a burglary or fire, it can get protected. So all those things, so these are sort of the building blocks of it. Build the ledger of the customer through accounts, current accounts, make it super simple for him to open it, which we've done. Give him access to lending so that he has needle mover loans, which actually increase his revenues and allows him to increase his turnover. And of course, give insurance. So these are the 3 main sort of blocks that we have, we feel are super important for almost 6.5 crore customers. And that segment is growing at 17% year on year. And the reality is that the number of business loans in India is very, very less. So out of 50 crore CIBIL, bureau reports, less than 3 crore business loans exist, where a lot of private limited companies actually have multiple business loans and so on and so forth. So access to credit is something that we are really passionately solving for. And ledgers and insurance and all that stuff really adds to the confidence that the customer gets in the product and the program. And I think there's a long way to go for an ecosystem. I think one of the key differences is that if you go to a store in Germany or you go to a store in London, the guy will have a credit card, to pay for his working capital, to pay, let's say, a Metro Cash and Carry, or to pay one of his suppliers or Amazon or whatever it is. But in India, that is non-existent, and I think we want to change that. Will our retailer community or trader community 10 years from now be as sophisticated as a retailer abroad? Will the stores be as modern as like a 7-Eleven that you see abroad? Definitely. And I think that's where the opportunity is.
Wonderful. Thank you so much. I think the 3 of you have kind of spoken about more global format in terms of, how do you digitize the MSMEs and SMEs? You get rich data from them and then you lend on the back of that. Would love to get in, Sandeep on the supply chain invoicing and enabling that ecosystem as a specific loan product. And after that, maybe Gurjot, you can talk about the BNPL part of it. Would love to kind of just deep dive a little bit into types of kind of loans in the MSME ecosystem.
Sure. So, basically, MSME, to my mind, in an ecosystem is 2 kinds. Okay, there are manufacturers who supply to large corporates and medium corporates, and there are the distribution channel. There are distributors, sub-dealers, retailers. Now, if you look at the ecosystem today, it's massive. And if one adds the turnover of companies above 1,000 crores in India, okay, on the sales side, it probably back of the envelope calculation should come to approximately 6 to 7 lakh crores, okay. And if I look at the procurement side, SMEs supplying to large corporate across different tiers, tier 1, tier 2, tier 3, That should also probably add up around 2 to 3 lakh crores. The supply chain finance book today by the top banks and the few top NBFCs today, approximately, is about 80 to 90,000 crores. Now, you see the massive gap which is available to finance. For the simple reason why this is not happening is because most of the banks have only touched the upper layer of the pyramid. Everybody is looking at a direct distributor, large distributor of HLL to finance. Nobody is actually looking at a small sub-dealer or a retailer. Things are happening, there is a change happening. And to my mind, the only way to solve this is that there has to be more and more lenders coming into this space. Okay? And it also solves a problem for the SME because most of these, the long tail SMEs borrow unsecured BL for about 3 years and actually put in for working capital use. So there is a massive asset liability mismatch they're undertaking. So just to conclude, to my mind, I think so. Most of the banks and NBFCs actually should do about 25% of their book through supply chain finance. Okay, and that's the way to actually solve this problem of direct access to this. Thanks.
I'm going to just wait on you a little bit, and maybe Akshay, you can just kind of maybe respond to Sandeep on in terms of how you guys try to enable banks, and what is really the way to get banks to be more involved in this SME lending ecosystem, given the credit gaps he just highlighted.
Great segue actually. There are a couple of things that we as Jakarta really enable, and we've been trying to do that now for the past 3 to 4 years. What we have seen is banks traditionally have a lot of legacy systems. Now, on top of those legacy systems, they're not able to match what some of the new fintechs are able to do. And which is where partners like us come sit on top of their legacy systems and help them move the needle. A typical SME proposal would take, a small ticket proposal would take about 4 to 5 days just to get logged in into a typical legacy system. And a larger ticket SME proposal would be anywhere between 10 to 15 days. Now, data solves a lot of that. We did speak about data coming in very quickly and solving for that. But systems that sit on top of the legacy systems really enable a lot of that to move faster within a traditional bank, which didn't happen. And today we are seeing, some of the journeys that we enable. We are seeing small ticket really being STP, and most of the borrowers now getting loans in literally 3 to 4 minutes if we solve for some of the KYC problems. So ETB, NTB, there is always that, but we're seeing that happen now. Proposals for larger ticket because of the data being available and systems now accessing and collaborating or getting all of that data together, helping the bank take a decision faster is getting the RM or the customer a decision in less than 10 minutes for a larger proposal. Our research has shown that it's not important to get the money in the bank in that time, but it's about how fast can I tell you that I'm willing to give you a facility. And that for us has been how we've enabled traditional banks really change that. Another aspect that we have enabled is decisions were largely taken, if you had to take a GST return earlier, it would be 12 months of GST returns physically entered into a system. But with one OTP now, you can actually understand the entire business behavior of that entity. So we're now enabling the whole decision life cycle as well. Not only the whole process life cycle, but the decision life cycle. And which is where traditional banks are now trying to get much better at what they've been doing. So I think 2 primary aspects there.
Got it. Gurjot, just moving on to you from supply chain financing, is there a BNPL aspect here that kind of blends into this ecosystem?
Right. So our thesis is that SME, needs to has cash crunch at different periods of his life cycle, right? And we try to solve this. People, different, fintechs are trying to solve it in different shapes and forms, and supply chain finance or a buy now pay later are ways and means of doing that. Our thesis is that we should offer them a working capital line which they can tap into as and when they use. But how do you make it efficient is the challenge, because unless you price it right and unless the size is right, you may not end up actually helping the SME. And I believe data, the way we use data, that plays a very important role in that, because typically one has to understand the SME's business in depth. Depending on location, on sector, there will be different lean and festive periods. There will be different business cycles. We need to we use data to essentially make sense of it. And at times the working capital requirement may be 10x of the usual, right? So if you do not increase your line at that need based on data, there would be challenges, right? And then having good view and access to the receivables, I think that's important, and it automatically then solves the problem of collections, etc. So I think we need to make these loans or lines more need based, rather than making it with looking at it with a traditional psyche of a term loan or a amount-based loan. Make it more nimble and flexible, and that's been our thesis, and it's worked pretty well across markets.
Understood. Anup, just bringing you into this discussion, SMEs play a big part in our export-import ecosystem and infrastructure. What are your thoughts on kind of the credit gap in that specific market, and how do we kind of enable credit on that front?
Thanks, Fiza. So I'm going to take a step back maybe. I think before even we look at credit, as a country, I think a lot of our SMEs are beginning to look at offshore markets to increase their profitability, look at bigger margins, right? Increase their distribution outside of the country. And one of the big gaping hole there is banking. And that's what we're stepping in to solve. While we're stepping in to solve it, we're also realizing that credit is a massive void in that space. We're also working with a lot of factoring partners where there is currency leverage for these SMEs. We're looking at giving them access to capital markets, which gives them a lot more in terms of working capital right there. But the base of banking itself is ripe for disruption from a transaction banking space. And that's where we're trying to solve. We're trying to internationalize these SMEs sitting out of India and get them or bridge the gap of getting them to a global market space where they don't at least have to worry about getting a bank account to trade internationally. So this is baby steps for us. But yes, we're pretty keen to work and set up a full swing business out of India for it.
Before I open it up for audience questions, would love to kind of have everybody on the panel, share maybe a 2-3 minute view on, what is the biggest challenge with adoption in the SME credit market, whether that's regulatory, whether it's from the debt market side, what do you think? Maybe we can start off with Sandeep right at the end.
Yeah, so two things. One is from an SME side, there are opportunities available. The SME has to actually go out, look out for opportunities and not kind of depend on one source of liability, okay? Second thing, from a bank side, as I said earlier, banks need to adopt the technology, okay, supply chain finance technology. And as part of VFin, we actually provide a complete end-to-end solution in terms of supply chain finance. For the simple reason is supply chain is not a single product. It requires multiple products like it's supplier finance or dealer finance and all that stuff. And last, most of the banks actually should move into alternate data and as a policy for most of the smaller ticket size, completely. They should actually move to alternate data, like look at to whom he is supplying, from whom he is buying. And that's the only way to actually broad base and provide finance to SMEs.
Got it. Akshay?
I think it's a mindset change. For the SME, traditionally they've, uh, the whole idea that all of this can be digitally made available to a lender is a little alien to them, right? Today, for example, if even a lender goes and says, "Yeah, I've completely digitally transformed myself. I have, the best processes, all of that," but just getting to ask them to give one OTP, which gives them access to the financial information, is a challenge, and that I think will, over a period of time, I think it started with Aadhaar, started with how that changed a lot of it. Uh, I think that will now change, and that's the mindset change that we need so that we can solve for this for all the SMEs.
Understood. Vipul?
Can you hear me? Yeah. So, interestingly, I think in the space that I'm in, which is sort of, sole proprietorships, sort of under 40 lakh turnover customers, shopkeepers, traders, and all these, textile shops, or chemists, and hardware stores, and restaurants, and so on and so forth. I'm actually quite happy that banks haven't gone there yet. So it's a big blue ocean for us to, sort of go after. And the other thing is that there's, even though there are sort of lenders who are, obviously doing stuff for this ecosystem, the gap is extremely large. Most of our customers have some of the exposure to a money lender today on the lending side. And they'll take those loans at 5% flat per month. 3 to 5% is the rate. So if you're taking a 1 lakh loan, you're paying 5,000 rupees every month, and at the end of the year, you're paying 1 lakh. So you paid 1,60,000 rupees back to the money lender. It's freakishly expensive, but the way they see it is, they'll go to Sadar Bazaar in Delhi, and they'll buy something over there for 200 rupees, and they'll sell in their market for 800 rupees or 700 rupees. And that's a great profit. And through that, he will pay off that 5,000 rupees. So the Indian, the dukandar or the shopkeeper or the trader or the distributor is a very smart guy, and they've been doing business for thousands of years. They know all that, but I think the opportunity really for companies like us is to be able to really capture the market. That's one thing. And in a space where right now most of the banks aren't coming in because they have their hands full with corporate, salaried, government business, all of that stuff. And I think the other one is, of course, getting the reach, going after them. And we don't believe in doing, sort of TV ads and stuff like that. Or most of my customers are not on, on Google or Facebook either, except for, good morning messages and all that. So I think that is not the ecosystem. So we have to be able to be creative enough. We do a lot of partnerships, ecosystems. So I think those are the things that really help us reach out to these customers. Most of them, if you ask me, and there was somebody, who runs a very big trade platform, and he asked his customers, about 1 million of them, do you want digitization or do you want access to finance, right? And 80% said they want finance, because digitization is like a very interesting word, but nobody really understands what that actually means. So I think if you can give him access to finance, which starts with building the ledger, having accounts, and all of that stuff, you get to a stage where the customer starts, and if he gets finance, and I think what Akshay was saying, that the customer doesn't need the money in his account immediately, but he needs to be able to be have that confidence that, yes, I'm approved, and I'll get the money in 1 or 2 days, it's okay. And I think that's a very big part of building the trust as well. So I think those are the interesting sort of bylines, right, about the space that we are in and the kind of ecosystem that we're going after. So definitely, very interesting times ahead in terms of how we go about it, and we actually want a lot more competition in this space.
But you do think digitizing is a necessary condition to lending, to accessing those financial products?
So
or no?
I think so. For example, we have something called Checkbook Khata on our app. right? Which is essentially a digital ledger of all the sales he does, which is could be cash and all that stuff. We don't look at that data because it's really user-generated content, doesn't really add a lot of value. But do I want him to digitize every single purchase and every single sale that he does? It's not that valuable. What is valuable is what are his financial transactions that are happening. Capture that in a sort of ledger, which is essentially an account, and that's what an account is. It's just a ledger of information. That is enough. Where is he getting the money from? Where is he paying? Is he taking money out? What is going into cash? What is going towards, what are the credits he's getting from his customers, which could be UPI, and so on and so forth. Having that data is enough, but digitizing his entire workflow in a shop where, and we've seen customers tell us, nahi, aap jo bhi, whatever system you bring to me in a shop, I know much better than the system what is my inventory, मेरा कितना माल चाहिए, मेरे को कितने मैगी पैकेट्स खरीदने, मेरे को कितने गुड डे के बिस्किट खरीदने. You don't have to tell me, I don't need a system. It's only going to increase my work. So yeah, I mean, then you can't really force him. And then there are a lot of companies who try to make them adopt a ERP system and this thing and that thing. Unless they get to a certain size where they are like 2-3 crores of turnover, then yes, they'll get an ERP system. But the bulk of them aren't, and they know exactly how much inventory they have. So I think we don't want to really focus on digitizing that aspect, but get him into sort of formal credit. Most of my customers actually have a cooperative bank account. 50% of our lending customers have a savings bank account, right? How do you kind of make that change so that he can leverage his current account really better? Because in his savings account, he'll also have all kinds of personal expenses. They just get mixed up, and he will not be able to access lending or other products and so on and so forth. How do you make his POS experience better? I think those are the things that really will help him.
Got it. Anup, adoption barriers to your mind?
Yeah, I think if you were to solve for capital distribution in the country, I think from a lender's perspective, the cost of capital has to get solved, and cost of compliance has to get solved so that they can make the process a lot more efficient. And from a borrower's perspective, I think cost of capital has to be looked at from an alternative perspective. As long as the money is not cheap, I don't think the SMEs is serviced well in terms of its own leverage, the book leverage. I mean, they can borrow at whatever rate that they're borrowing today. If it's not going to help them grow their business, that money is just adding more debt than is needed. So I think from an overall perspective, cost of compliance and cost of capital are two big solves that I think we need to focus on as a business.
Got it. But from an opportunity cost perspective for the SME, if they're taking like loan shark loans at 3%, 5% per month, isn't the alternative better?
I wouldn't go down that route to say that alternative is better, because the banks and the non-banks and today fintechs, because they were becoming participants to the capital market ourselves, I think need to solve for this, because that loan shark model has really no protection for the borrower. Right. With the frameworks that the country has today, I think it is building that framework of protection and trust. But we really need to solve in terms of the provider. We really need to solve for cost of compliance, and that'll only come with regulatory dialogues.
Sure.
Can I just add to what Anup says? See, I kind of agree with him. The cost of capital has to come down. The reason why the cost of capital is not coming down is because obviously there is a risk weightage which is to the SME. Okay, but if you look at globally, if you look at transactional based facility, that's the most least NPA level, and that's where the SME finance has to go. And automatically, if the credit cost comes down, the cost of capital will actually come down, because most banks are building that credit cost in their pricing. I thought I'll just add to Anup's.
Yeah, fair point.
Gurjot?
So, my view on this is that, adding to what all others have said, is that we need to reduce friction in businesses who are trying to become organized, either new to organized or from unorganized to organized. Today, if you have to, set up a new business, register with MCA, get a GST, etc., it's not a DIY thing. It's not as straightforward. Filing GST is not as straightforward as filing your personal taxes, right? So, there is a friction. SME needs to involve a professional there, pay a fee. So there is all sort of friction involved, and we need to solve for that. We, as an economy, are on the right path, but this has to be accelerated. And then platforms like us then should use that digital underlying infra, to build DIY products which will enable them to do these things on the go along with running their businesses. So I think doing this, removing this friction, which will essentially help them or bring value to them in running their businesses in a proper compliant way. The benefits that come with them, they would not have to depend on a loan shark. Today a loan shark loan is very convenient for him. It's just one phone call away. How do we reduce all that friction and help him bring all that business into the organized world, away from cash? I think that will enable a lot of SMEs to access formal credit.
Vishal?
Sure. So I guess all of us as fintechs are coming at it from different points, also different level of the pyramid structure of the whole supply chain ecosystem. So as Vipul said, at the bottom of the pyramid at MSME, so the entry point itself is more like get this guy digitized at the bank, at the current account level, and build the rest of the capabilities which make sense for the segment like that. The segment a level or two above, which someone like us look at, they are not new to technology. They have few technologies. Could be Tallies, could be Zohos, could be SAPs of the world. So key remains for us as fintechs to basically embed into their business deep inside, one way or the other. So entry point could be a bank account, a card, or a automation system, wherein we get plugged into their ERP systems on one side, and not really sell a new bank account or a new card, but get connected into their existing bank account and the card, whatever they have. And these are two different segments within the pyramid. This essentially addresses the alternate unstructured data, which Sandeep covered, almost everyone spoke about. So I guess that's possibly the barrier one, which we are all going after. That's what all the FIs are asking for too, and that's what we're working for. Second, which Sandeep briefly covered, even look at each of these segments, even down the pyramid, in a way the supply chain financing had been done. So look at them as a seller and a buyer in the ecosystem. Look at two nodes coming together rather than a standalone SME. We need to know more. I mean, as Vipul said, again, he knows what his retailer is getting from which customer, cash, check, there's an entry, there's money in the book. Is the same way somewhere in the middle of the pyramid, there's a wholesaler, there is a stockist, there is a local regional manufacturer. So you need to see his purchase side, his supply side, his DSOs, collections, cycles, and stuff like that. See them in an ecosystem as a supplier-buyer ecosystem, and that is where you have now a next level data information, another layer of unstructured data, wherein now you are able to establish how this ecosystem looks like. And the last piece, I guess, from the digitization perspective, India has definitely moved far ahead. Few new initiatives which are just starting to shape up, ONDC, B2B, BBPS, which are going live. These are addressing commerce and cash in a big way, and especially when it comes to the whole B2B ecosystem. And that's something which I guess as fintechs, all of us possibly would work together or should work together to get the commerce democratized, get the cash flows, their cash management democratized. And if that's the case, I guess then FIs have much deeper, better visibility into the whole lending piece.
Absolutely. We have 4 more minutes left. Would love to get questions from the audience for the panelists, if there are any. Anyone with any questions? No? Great. Sure.
Right. So I think one of the things that Gujot talked about is the friction which happens in terms of it is easy for him to, for example, call a money lender. So one of the things that we also sort of obsess at Checkbook is that we look at the friction in the journeys that we do, right? How fast can you onboard a customer? And I think we worked on a sort of the the neobank sort of current account proposition for almost like 2 years, to get it down to like a situation where we can onboard a customer in 3 minutes. And earlier when we initially started, it was taking like a month to onboard a customer on a current account. So that obsession is also very important because a lot of people confuse, the UPI adoption in the country to think that the customer or the trader in the country has become financially or digitally savvy. And the reality is that UPI is such a simple product to use that, while he's getting a lot of payments and so on and so forth, he doesn't really have to understand it. And it's a great example of a wonderful product. And I think if we can get to that kind of seamlessness in terms of simplifying the architecture of, the app and the products on the app so that the customer doesn't have to spend too much time understanding what is what, and reducing the friction in the journeys, that helps a lot in adoption as well. And I think the second thing is that, we actually want to get to a point where the customer doesn't even have to, even call a money lender. He can just come on the app, see that he's got a, overdraft line or a business loan which is pre-approved, click of a button, it's in his account. Which happens a lot, for example, for salaried customers today. They have a credit card, right? So they know they have, 3, 4, 10 lakhs, 15 lakhs of credit available. You can use it in an emergency. And they also have pre-approved auto loans, pre-approved limits, and so on and so forth. You can get them in emergencies. Sometimes the apps don't work. That is another point. But yes, the availability is there. I think we need to get to that ecosystem because opportunities for these traders come anyway. Festive season aaya, saste mein maal chahiye. Okay, if I had credit access, I can nicely make a good, handsome profit on it. There is a good deal somewhere. They are deal hunters at a next level, right? Can I get that deal? Okay, if I buy a little bit more in bulk, I will get another 10% discount. All that calculation is continuously happening, and all of it adds to his bottom line. So how do we kind of empower that is really, the next level challenge.
Absolutely. I think treating B2B customers as B2C customers in terms of, having that frictionless onboarding and, providing products to them which are easy to use is absolutely, I think, one of the things that will help solve this. Thank you so much, everyone. Thank you for being here and sharing your views. This was really lovely to moderate.
Once again, a reminder to everyone that we have a special session with the Deputy Chief Minister of Maharashtra, Shri Devendra Fadnavis, coming up at 6:30 in Jasmine 1 Hotel, Hall, not hotel. We hope to see you there. Check. PA. Check. PA. Check. May we request everyone to kindly be seated as we get ready to start our next panel discussion. Everybody, may we request you to please take your seats. And while we wait for the discussion to begin, we'd like to thank our partners, our theme partner, WhatsApp, co-powered by Amazon Pay, spend management partner Encash, in association with Perfios, payments partner Cash Free Payments, and CEO's dinner partner HSBC. A gentle reminder to everyone standing in the front to please continue with the networking in the pre-function area as we all please be seated for the next session to begin. पाच पाहिजेत ना 1 2 3 4 5 हा आणि 6वा ऑनलाईन आहे हो पण टोटल 6 आहे त्याच्यातला एक ऑनलाईन आहे मला 6 नाव आहे तिथे कोण किती आहेत Check. May we request everyone to kindly be seated. Thank you very much for your cooperation. And let's begin with the next panel discussion, which is on fintech investment opportunities, the global VC perspective. I would like to invite our panelists for this session. मुझे एक headset दो ना please. मुझे एक headset दो ना. Check. Check, 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 1, 2. Check, check, check. Check. Are you able to hear me? Yeah? Am I audible? Shubhanga, am I audible? Am I audible? Yes? Check. Yeah. Yeah. Check, check, 1, 2. Yeah? Check, can you hear me? Check, 1, 2. Okay. All right, we have our panel on the stage. Our moderator, Shubhanga Prasad, partner Beta Plus. Mr. Sagar Agarwal, the panelist, co-founder and managing partner at Beam's Fintech Fund. Mr. Sandeep Patil has joined us virtually, partner, head of Asia QED Investors. We also have with us Ms. Smita Agarwal, global investment advisor for Flourish Ventures. And Mr. Suraj Agarwala, vice president, growth, Sequoia Capital, India. And over to you, Mr. Prasad, to get started.
Wonderful. Can you hear me?
What are you saying? Something else?
Amazing. All right. Thank you. All right. Let's give it a minute, perhaps.
No, you can continue.
You good? Awesome. First of all, thank you for giving us your time and the panelists. It's been amazing getting to know all of you over the last few hours, and I look forward to an engaging discussion over the next 40 minutes. During the next 40 minutes, what we try to kind of talk about is all around how the investment opportunities in the fintech ecosystem is, and how is the kind of global perspectives. It's a privilege to be having Smita here, who has extensive experience from Southeast Asia perspective. We have Sagar here from Singapore, and he's able to kind of give us a lot more from what growth stage investment looks like. We also have Sandeep joining in from the US or the UK, one of the two for sure. And he will be able to kind of give us a more Western kind of perspective, and how do they look at Indian fintechs. What we will be covering is largely around the opportunity landscape, the regulatory outlooks, as well as the funding environment over the next few minutes. So to start off, Smita, perhaps from your side, help us understand how you look at fintech as a whole, especially given that India is not the only space that you look at, and what are the kind of opportunities that you are seeing?
Good afternoon, everyone. Thank you, Shubhanga. Ironically, actually, the pandemic gave a huge boost and a shot in the arm to the entire fintech industry. In 2021 was a watershed year, and there was over $500 billion of global fintech deals that happened. This I'm talking about it. This is a number that includes private financing, IPOs, and M&As. And that was absolutely phenomenal. Across all the sectors, fintech was grabbing the biggest share. So yes, that was actually, I think, the biggest silver lining of the pandemic that we saw. And the interesting thing is that of this $500 billion plus of deals that we are talking about, almost 50% or a little more than 50% actually happened outside of North America, which means a lot of the emerging markets and the developing countries are emerging as fintech hubs, which is really good news. Of the 50% that's happening outside of North America, Asia forms almost a third of it. And in the first half of 2022, India still grabbed almost 40% of the Asia share. So India is actually right on top there. It's number 3 as far as the fintech ecosystem is concerned, right after US and UK. So it's a really good time to be building and investing in fintech overall. I think there are a few trends that have happened over the last few years, and I'd like to just quickly touch upon that. So number one, the biggest trend that has happened because of the pandemic is the willingness and the willingness to try new technologies and to try new solutions from a consumer end user standpoint. That has completely changed. You don't need to spend money to get a behavior change done. That is already taken care of. Whether it's a consumer, whether it's MSME, it's anybody, people are actually already on that digital journey, and they're looking for solutions that can actually solve their problem. The second big change that has happened, I think, is the portability of technology and portability of ideas around the world. That timeline has crunched. Usually you would find that in markets like Asia, they would follow and lag behind the developed markets. 3 to 5 years later, you will find a similar solution coming up here. That's no longer the case. Almost at the same time that you find some new idea, new interesting model, you would find that very quickly getting picked up across geographies. So that timeline has crunched. Of course, the solution needs to be contextualized to the local market, but clearly a lot more people are learning from each other, and it's kind of becoming a borderless world as far as new ideas and technology innovation is concerned. And the third big trend is there are pools of capital that are now emerging outside of North America. Of course, US continues to be the biggest and the deepest pool of capital, but you now actually have funds in Asia that are funded with Asian money investing in Asia. So the dependability on the US market is to some extent mitigated, which is again a good news because you do see macroeconomic trends that are different from region to region and country to country.
Sandeep, I think what will be interesting to understand is, if you kind of start dissecting fintech, I think calling it as fintech was very relevant in 2012, but given in 2022, it has grown so much. What are those subsectors that you're actually seeing within the Indian ecosystem and sitting out, especially from London? What actually kind of interests you here? What is the opportunity that you're seeing?
Yeah. First of all, thank you for having me. It's fantastic to see the Global FinTech Festival blossom into this giant and animated forum. So very, very exciting for the ecosystem. Look, I think you can't talk about India without talking about the global context also. So I'd underline some of the discussions that has already happened. Like I think India holds a very special spot from a macroeconomic perspective, from how the financial services industry has evolved there, from a very forward-looking regulatory stance, and frankly, from a talent perspective, both from a technology perspective, but also India is one of the few countries that boasts of fantastic financial services talent. Right? If you walk into any bank here in London, in the US, in the Middle East, most of the middle and kind of senior management would be a good chunk of them would be of Indian origin, right? And that's augmented by the fantastic management teams that we have in banks, NBFCs, financial institutions in India. So just adding to what Smita was saying, I think there's a fantastic inflow of entrepreneurs that we are seeing, who are not just second generation entrepreneurs, who are not just coming from a technology perspective, but people who actually know financial services in India and are taking a plunge into financial services, into fintech more specifically. So very exciting ecosystem. It holds a special place even on the global spectrum, if you will. Number three is just the beginning. I think there is a lot more to be had beyond what numbers say in terms of the innovation that this ecosystem will spawn, and how it can really attain a leadership position in the years and decades to come. To your question more specifically, I think there's innovation, good amount of innovation to be had across the breadth of financial services, right? We heard a lot of chat yesterday about kind of new innovations coming in into consumer lending and retail banking, and those will certainly be at the forefront of driving financial inclusion, but also adoption of digital across the kind of middle and top of the socio-demographic pyramid, right? But there's a lot of innovation to be had in B2B lending, a lot of innovation to be had in SME lending. We really haven't seen really breakthrough companies come out on MSME lending. There is the elusive goal of 60 million, 70 million MSME still lingers on, and we haven't seen anything at big scale there. I think, again, expanding the horizon beyond banking into wealth management and insurance, I think there are big innovations coming up there. The regulatory stance is becoming more forward-looking, especially on insurance, and that should spawn some very interesting opportunities in the years and decades to come. Lastly, I would say, to round us off, India has had a very deep expertise in services meant for financial services companies, right? Tata, TCS, Infosys, etc. started what 3, 4, 5 decades ago and have become into global giants that they are now. And there is a lot of thinking, systemic thinking around how to build technology, bank-grade technology to serve financial services customers, but also to serve banks and fintechs to work better, right? And so we definitely see more innovation on that side, and that's certainly a classic kind of SaaS sort of business that we see building out in India, right? Again, not to take away from Web3, I think that's a very exciting technology. I'm sure there are separate discussions happening about that, and we can have a long chat about that as well.
Certainly, certainly. And Suraj, I mean, I think from your perspective, one of the challenges that India probably was talking about 3 years, 4 years ago was depth in VC market. And so given that there is actually a lot more activity happening in Series B, C plus, where are the opportunities that that you are seeing, and how should people who have actually raised Series A now be considering their growth perspectives?
Uh, if we look from opportunity perspective, opportunity in any sector is a function of two things. One, what are the consumer preferences? And second, what is the level of technology? Let's take an example of, let's say, credit cards. If you had a credit card 10 years back, you would be happy with the credit card which just offered good quality rewards and, let's say, enabled you to pay online. But if today you want a credit card, you just don't want that. You want an online expense management, you want an online reconciliation of a payment, and probably a BNPL along with that whenever you're making an online payments or in an e-commerce site. So the opportunity from that perspective would lie in every sector, because every sector will have to change to meet the requirements of current generation and also go ahead with the technology. Something which was not possible, let's say 5 years back, was not even the expectation of the customer. Like if you went to shop on a kirana, you would have been used to paying a cash, but today most of the time you're walking without a wallet, hoping that you will be able to pay by an UPI. So we have seen a lot of innovations of that happening on the payment side. We will see the same level of digital penetration going to other sectors within financial services. I think we talk a lot about consumer-specific lending because personal loans is a lot in the talk. But even outside of that, whether it is SME lending that Sandeep talked about, or even insurance, we have seen a couple of new companies come on the general insurance side and a few right now innovating on the health insurance side. But we have not seen any new company come up in life insurance in the last 1 decade. I'm sure people in the current generation expect a lot different from life insurance what my parents' generation expected from. So from that perspective, I would say every sector is open up for innovation. And even the sectors where we think a lot has been innovated, like payments, the expectation 5 years and 10 years down will be very different from what it is right now. Right now, we are very happy with the seamless UPI payment. Probably 5-7 years down the later, and which has already started, we might want credit also on UPI when we are making a payment. So from that perspective, I would feel that every sector is open for innovation, and especially in fintech, the innovation will keep on happening even in the same sector over the years. And I don't think there's a saturation for that at any level.
Sagar, your views on this topic. What are the opportunities that you are seeing, given that you actually have a group which looks at early stage, mid stage, late stage? How do you see this?
No, I think just to add a little bit first on the trend side, right? I think two important trends that we are really watching close. Can you hear me? Yeah.
Yes,
yeah.
So two important trends that we are really watching that's happening in the market like India, right? The depth has gone much, much better now. I think if you look at 16 to 2022, 6-year journey in India, I think more than 3,000, 3,500 companies have been created in the fintech space. However, at least 30 to 40 of them have become unicorns. That's given an opportunity for a lot of founders to build second level companies, right? So we see a lot of Series A, Series B companies out there in India. So I would say roughly 200, 250 odd companies are in that bucket. So the depth of the market has gone stronger from a growth stage perspective. Largely India was an early stage ecosystem for the last 6 years, which is fundamentally changing now, giving a lot of opportunities for not just Indian funds, but global funds also to start investing in India. So the depth of market is changing, the quality of founders have improved, the quality of businesses have improved. That's one thing we are watching. I think second that's happened in India, which I think everybody should appreciate, is also that the kind of M&As we have seen in India, especially in the fintech space, right? Second largest M&A in tech space all over across all the sectors in India, right, is in the fintech space. I think the largest acquisition in India was Flipkart in 2016-17. After that, Naspers is acquiring BillDesk was the largest acquisition, $5 billion. It's not common to happen like this, right? So that's one thing, the markets are evolving. We are having a very mature market in India now, and the opportunity for founders and a clear exit proposition, both from the investor perspective as well as in founder perspective, is there. So the investment market is improving significantly. We can clearly create a company from 100 to $1 billion or $2 billion and look at a healthy exit for ourselves, not necessarily depend upon just looking for an IPO as a market. And in terms of opportunities, I think we're very bullish on embedded finance. I think there's a bit of changes in regulations around embedded finance, but I still think there's a lot of opportunities in agri, health, education, consumer, logistics, B2B commerce, right? All of these segments, there's a lot of disruption needed, a lot of improvisation needed. We're still going the archaic ways of doing payment, lending, insurance, these categories. I think that sector we are very bullish about as Beams, as a group, and we are looking at a lot of companies in that space. I think beyond what trends Smita, Suraj and Sandeep has covered, I think these are some of the sectors that even we are evaluating.
And coming to what is next set of innovations that is going to happen, and Smita, you're very close to early stage investments, and you're also looking at opportunities not just in India. So how would you kind of categorize what are the white spaces that new entrepreneurs who understand technology, who understand finance should be looking at, and how do you kind of look at those white spaces?
So I'll answer that in two parts. So first of all, yes, if I look at Asia more broadly, so there are many emerging markets that are actually very, very interesting. India, of course, continues to be very exciting, but then there are markets like Bangladesh, Indonesia, Vietnam, that have a lot of things that are kind of common being an emerging market or developing market. What that means is there's a huge amount of informality that exists. MSMEs contribute a very, very large section of these markets. And the need for MSME digitization and the opportunity to actually make a difference there and to contribute to the increase of their income and growth is actually very, very significant. I think the big step change that happened was because of the pandemic, the willingness to digitize and use digital tools has changed dramatically, and therefore that actually offers an opportunity to innovate specifically for MSMEs. And that's a trend that we are seeing across all of these markets. India alone has about 12 million plus Kirana stores, and they are not going anywhere. The whole narrative around modern trade and e-commerce are going to gobble up the Kirana is not true. They are very much here to stay, and what is really needed is to kind of bring in a lot more efficiency for them through the use of digital tools, be it on the sourcing side, be it on managing their store, or be it on the working capital side, which is actually the biggest need that they have. The second, we talked about payments, Suraj touched upon it. So I think a lot of work has happened on the B2C payments, but there's still a long way to go on the B2B payments. And that's a much bigger revenue pool, that's a much bigger pie. And the approach and the innovation that you need on the B2B payments is slightly different from the B2C. The B2B payments, they need much more embedding along with reconciliation, order management, and all of that. And there's a huge opportunity to make the B2B payments much more seamless and digitized. And embedded finance, that continues to be a really big opportunity. I think India is at an advantage because some of the foundational blocks are already in place to make embedded finance happen. So we've got the digital identity, you've got the payments layer sorted out, you've got the account aggregator layer sorted out, which allows you consent-based data exchange. And so what is needed is to kind of build the application layer on top of that targets some of the underserved customer segments. So for example, in many markets we are seeing a combination. For example, if you're targeting the blue collar workers or the gig workers, you see a combination of a jobs marketplace plus payroll processing plus financial services which offer remittances and earn wage access all together embedded as a single platform targeted at a very specific customer segment. BNPL for merchants, I think that's a big opportunity when they're sourcing. How can you make that entire process flow? So it's kind of a working capital solution, which is giving them in the moment ability to pay later for some of the supplies that they are ordering. So I think the entire embedded finance story is just about getting started. There's a huge opportunity for doing it. In many other markets outside of India, the big opportunity is actually the B2B financial infrastructure. In India, we have NPCI and the other agencies taking care of that. But in many other markets, it's the private sector and private funding that's actually even funding the financial infrastructure of API exchange or interoperability of payments and all.
And from Suraj, your perspective, one of the things that is less talked about is the corporate, banking side of things. When you talk about trade finance, for example, even today, an importer or an exporter needs to kind of cut, their receipts in 4 copies, one for the port, one for the banker here, one for the banker there, and then the exporter. What are the kind of opportunities that you're seeing, especially in the realm of corporate banking? And do you think 2020s is the decade where fintech is going to break the barriers of corporate banking?
Yes, I think it's the same way because finally, what we do in our B2C experience, right? Over a period of time, we want the same experience in B2B because if you're used to paying digitally when you're going out shopping, you would want to pay it even when you are on an enterprise, probably a mid-sized enterprise or let's say large enterprise, because you're the same person at the end of the day, right? So you want the same experience on the B2B side. I think, but with B2B, it becomes a bit more complicated because there is a lot more regulations involved. So you have to have a platform which is able to meet the requirements of your one in-house ERP accounting because that's a very important component of any business. Second, being able to make those payments digitally so that you're able to track those payments and reconcile with your accounts. And third is being able to manage the regulatory payments right along with it. Since you take the example of an import-export side, right? If you're making an export today, you need to have that entry in your ERP. Second, you need to ensure that you're complying with all the import-export regulations. So whether it's custom duty, excise duty, all that regulations you need to comply with. And third, you need to ensure that you are complying with Forex regulations so that you receive money in Forex, which is converted to your INR account when you receive the payment. So what we need today is a platform which is solving across all of these three things. And we have seen few companies come up in this space, whether it is related to financing of it or whether it is related to accounting of it. Like there's one company that we can take example from our portfolio, like let's say Drip Capital. It's solving for those people who are exporting from India to globally. To how do you ensure that you collect payments for them and is also able to supply financing to it? So I think whatever we are seeing on the B2C side as an innovation, some of these will start to flow to B2B, but it's just that with B2B it becomes a lot more complicated because it's not only a user experience that you need to solve for, you need to solve for accounting of it, you need to solve for regulation of it and things that come along with it.
That kind of paves good, way into our next broad topic around regulations, right? How do you guys view regulations in India? And I'm keeping it extremely open. And Sandeep, maybe if you want to kind of start coming in, the question really is it favorable from global perspective? Are there things that can be improved? Are there things that you as an investor would like to see in the Indian ecosystem? Provocative, but I want to kind of try and get an honest feedback from the panelists here. Sandeep, if you want to go with your views on how you look at Indian regulator.
Happy to take that up one. See, look, I think QED has a bit of distinction in the VC community in the sense that we are a bunch of operators who have become investors. Right? I myself have worked in various aspects of financial services and consumer technology for more than 2 decades before we became investors, going all the way back to Nigel, right, who founded Capital One, which is now among the top 10 retail banks in the US. So as operators who are masquerading as investors, we have a nuanced perspective on regulations. We honestly think that India is blessed to have a very forward-looking regulator, as we have. We all talk about UPI and how amazing, all the amazing thing that's doing today. But those of us who have been in the ecosystem for a while will recognize that the first kind of discussions on UPI and the initial coding on UPI started almost a decade ago. Right, it was introduced, I think, in 2016 was when UPI went live. So this is not something that happened at a flick of a switch, right? The Jan Dhanman, the Jam Trinity, what we are seeing now in terms of account aggregator, Oken, all of these things take a lot of time to build, especially in a intricate economy such as India, right, where there are a number of banks and financial institutions operating, the consumer and the user group are so diverse and so on and so forth. And then Indian regulator has certainly the distinction of not having any big blow-ups in the economy in past several decades. That is quite unique, right? If you look at from a global perspective, it's very unique for a regulator to achieve that distinction. So they have certainly earned their stripes, they have earned their respect, and they have done it rather well, right? So kudos to them for that. I think talking specifically about what has been happening over the last few months and sort of the clarifications that have come out on various circulars. See, I think longer term, right? Think about the story not for the year, but for next 3 years, next 5 years. I think clarity is extremely helpful because it helps you drive your business strategy forward. It helps you drive your product strategy forward, and ultimately, it helps you think about your customers in a different way, right? So having more clarity is actually much more helpful. I think second aspect of it is there is a cost of regulation, but there's also benefit of regulation. If you are regulatory compliant, that actually signals to your users and customers that there is a certain blessing that you have, a certain threshold that you have crossed in terms of your processes, technologies, how you operate, in kind of backing that you have from the wider ecosystem. That actually would eventually drive far better customer adoption than, frankly, what we have seen so far. Right? I'm talking about things beyond payments here. Also helps from a user trust perspective, definitely. And I think the third part of it is if you think very strategically about the kind of founders that are starting up now, but also the founders who will think of building fintech companies 2 years, 3 years, 4 years down the road, right? Having clarity on what is allowed, what is not allowed, how to operate in the ecosystem will definitely help them think of new innovations that, frankly, you, me, and the rest of the panel haven't even thought of today, right? So we are a big supporter of bringing more clarity in on the regulatory front, and we certainly see India as having being blessed with a forward-looking regulator.
Totally. And Sagar, sorry. Totally. And Sagar, sorry, I keep getting your name wrong. Apologies,
fine,
man.
yeah.
I think one of the views that I would like to kind of bring you in on are there any sub-segments within the fintech? And I think we all speak about the kind of great work that we've seen, especially in the payment side and now in the recent past on the lending side. So are there any subspaces within the fintech ecosystem that you as an investor would like to see better clarity on? And how do you kind of, end up having those conversations both with a regulator as well as with startups alike?
So I think one specific segment within the fintech space that we are closely associated with now, right, is a digital banking space, right? We invested in Neo recently. Company's done phenomenally well, but every time I keep hearing that RBI still has no thought process around, or they're thinking about it, or there's a thought process, or there's a guideline, there's a framework that's happening, and there's a think tank of the government called Niti Aayog, right, which is coming up with policy framework at the same time. So there is a bit of a conversation going on, but I think if there is a thought process for the government or the central bank to actually think about a digital banking license, they should be a little bit more proactive in their approach, is what we feel. If there's a little bit more clarity, our founders can actually think about building a bank than thinking about building a neo-banking platform, right? That's where I feel that there's clarity required. I think second important segment, which is I think India has always been alluding, is the crypto and the Web3 world, right? The whole NFT space. I think founders are confused, except the taxation bit of it, right, which we have solved for it. But beyond that, the whole ecosystem, the regulation, the way it will function, who can operate, who can play, who cannot play, still a lot of lack of clarity. And it's not just in India, it's globally. But I feel that we've been progressive in multiple segments. Why not be progressive over here as well? So those are two segments that we are challenged in a way. We've been having proactive conversation with multiple associations, right? So Fintech Convergence Council is one of them. Obviously, Beams as a fund has a strategy of bringing banks and financial institutions as investors in the fund, right? So for example, we have Yes Bank as investor in the fund. So we also have channel communication through banking partners saying that why don't you also represent to the central bank or the ministry when you're talking to them about these are the concerns that fund managers like us or the industry like us has it all the time. So that's one way of passing on our communication with them and trying to explain the thought process behind it. I think in regulation, one more thing that Sandeep alluded to was that if there is a change in regulation that's happening, then there should be a framework issued before it and a little bit more guidelines and thought process around it, right? Something like what happened with the BNPL category or the prepaid card category, right? It was a little bit more unplanned, I would say, which could affect a lot of investor money at the same time. So I think a little bit more planning would help. I'm sure there's a thought process behind why the government or why the central bank wanted to come in much more quicker. But I think a little bit more framework and policy around that, like a little bit more proactiveness would help for us to decide better on how we want to think about it. And even the founders at how they want to think about their own company, own products, and own services.
So quickly, I think we have about 8 minutes. The question that all of us want to know is the funding winter over, or are we still in it? Smita, do you want to start, especially from an early stage standpoint?
So before I talk about the funding winter, just one point that I want to add on the regulatory piece. So we are an investor that focuses on fintech only. So we believe that if you're doing anything with financial services, regulation is a reality, it's a requirement, it's a necessity. So, our advice to all our founders is always that embrace regulation rather than shirk away from regulation. Plan proactively around regulation rather than try to work without it, because there are guardrails that come in with regulation. It helps. I think having regulation is better than having regulatory ambiguity, and it takes time. Regulators are not as swift and fast as the innovators and founders are, so things do kind of overlap differently, but in the long run it's actually always good to work alongside the regulators and try to kind of also educate them. I think as the investor community as well as the founder community, we have a responsibility to also educate the regulators on some of the new models and new changes and new technologies that are possible. With that, coming back to where we are on the funding side, so clearly we've all seen the meltdown in different forms, from the stock market collapse to the macroeconomic situation. There is definitely a correction that the world is experiencing, but I think the answer to is funding available or not is a little bit more nuanced, depending upon two things, depending upon geography and most importantly depending upon the stage of the company. I still see a lot of interest and a lot of momentum in the early stage, and that I think is going to continue. There is a different approach to, from a different stage of the company we are seeing different responses and reactions, and I think this is all kind of a transitionary phase that we are in. But one thing is clear, that as founders we should understand that investors have a different ask depending upon what stage you are. So if you are pitching for a seed round, then what the investors are looking from you is very different when you are pitching for a Series B round or a later round. So as a seed, there's not much that you have to show by way of past and by way of traction. There, it's really about your ability to convince the investor about the potential of the idea that you're building and how big it is and how relevant it is now and why you're the best placed person to make it happen. Whereas when you're pitching, for a growth stage funding, it's a different ask, and there is a lot more focus around monetization path to profitability. There is clearly moderation that we are seeing in terms of valuations and pricing. I think all of this is kind of giving us an opportunity to reset expectations, reset priorities. But it's definitely not the end of the road. I think it's a great time to continue to build and to continue to find like-minded investors. I think the clarity that is needed as to what you're building and how you're communicating what you're building is most important.
Just on a lighter note, we've got a couple of $1 billion over here between Suraj and Sandeep, so there's no funding winter, guys, right? So now just coming to our thought process around it, just to add a little bit more flavor to what Smita said, I think we have to divide funding into 3 stages, right? The early, the mid-growth, or the mid-market, we call it, and the late stage, right? I think it's a question of how fast have you moved from buckets. Have you fundamentally built a company across the buckets and then gone from one journey to the other journey? Then you will continue to get capital. See, in India and globally, good companies will always get good capital from good investors. That goes without saying, right? The challenge is that if you've jumped buckets much faster because there was irrational exuberance in the market, you have not proved your fundamentals. Whether you're in early bucket, whether you're in mid bucket or late bucket, you will struggle to raise capital, which is exactly what's happening, right? So we are seeing the late stage companies going through a slightly down cycle in terms of valuations, but they're getting capital, right? If they are willing to relook at their prices. Same in the mid stage, right? The premiumization has gone down. Earlier in India, Series A to Series C was like 3x and 4x jump in valuation, and Series B to Series C was like 3x jump again, right? Which has gone down to 1.5x, which is what was needed in the market. You have grown 100%, let's not jump the valuation 300%. So that is changing, which is why the capital is available. Capital is available at the right price for the right company, right founders. You build it correctly, ask the right price, you will get it. I personally feel. And same is the stage with the early stage companies also in the India.
Sandeep, your views first.
Sure. So this is an exciting one. I think this is the money question, if you will, across everyone. Look, I think it's helpful to have a bit of context on where all of this is coming from, right? Most of us in the room have lived through a decade of low interest rates, right? And that got the world used to having plenty of capital, plenty of liquidity being sloshed around, right? And if you think of it from that perspective, and then capital getting allocated to emerging markets, to alternate asset classes, down to venture capital, growth equity, private equity, that becomes a percentage of an allocation. So we have been flushed with cash for a long time. Last year certainly was the crescendo of it, when we saw record amounts of venture capital, not just in India, globally, everywhere across. Right. Then what you see in last 7 to 8 months is basically interest rates correcting, because Fed was very worried about inflation, and there are a bunch of reasons for inflation. We can get into that, right? But what has essentially happened because interest rates went up is cost of capital has gone up. So all the correction that you're seeing in US equity markets principally is because of cost of capital going up. If you double click and actually look at company performance in tech and in fintech, the company operating performance has not changed that much. They're actually delivering on expectations. But it's just how you value those cash flows in today's money, right? Going back to Finance 101, that's literally what has happened. And that's the massive amount of correction that you're seeing in the market. Now, when do you expect cost of capital to correct? It will correct when when economy and analysts, more importantly, have a stable outlook on inflation and global interest rates. I think inflation is probably going to stabilize by summer 2024, not next summer, but the following summer. But markets typically have 1 year forward view, right? So we expect summer next year is probably when there'll be a lot more stability in equity markets, and that's when investor outlook would stabilize. That said, there are two big exceptions. One, India is an exception. I said that at the beginning of the discussion as well. I think it's a macroeconomic hotspot, economy that has done really well, that is expected to do well despite the larger macroeconomic circle. And then the second part of it is, quite frankly, game theory. As there are as many nervous founders around this panel, there are a lot of nervous investors with a lot of dry powder also sitting around this table. So I'm sure there is happy marriages to be had in that ecosystem. I hope rationality prevails, that we make good decisions, because we want to set up the ecosystem not just for another funding crescendo, but we want to set this up for a long-term success, right? So with that hope and aspiration, I hope we make the right rational decisions.
Suraj, you have the last word.
No, I'll keep it very short. I think if you look at from a founder's perspective, what matters in the long term? One, we need to build a very high quality product experience. Second, we need to ensure that customer experience is very good. And third, we need to ensure that the economic engine is running. So if we forgot the larger macro of things for companies which are very early in the journey or Series A, Series B stage, I don't think they need to worry that much about how the macro is going on. I think for them, these three things matter. And if you are building a high quality company, there's a lot of capital available. As Sandeep just pointed out, India funds have raised record amount of capital last year. So there is adequate capital, especially from India perspective, available from investment perspective. What you need is high quality companies. And the only thing that might have corrected between 2021 and 2022 is one, the pace of investments, and second is the valuation. But from a capital availability perspective and high quality company being available perspective, I think both are still there in the fintech market.
I think just one last point that we should not forget that last 2 years have been record exits globally, right? So LPs are flushed with money also. It's the interest rate cycle which has made them a little bit more cautious about the future. But they have got record exits last year, right? And when there's a record exit year, people are generally sitting on capital which gets deployed the year after that, right? So 2022, a lot of fund managers would end up raising capital, and you will see capital coming in next year a lot more, I personally
So
feel.
essentially, if you're a Series B, C company, it's better to start brushing up DCF analysis. Yeah. So that's with that note, I think I'm going to.
Shubhanga, in one,
Sorry,
can I
go
have the
ahead.
one last of the last words? I think it's worth from this panel. I think it's worth echoing the positive sentiment that for the right companies and for the right founders, there's plenty of capital sitting around. Right. I echo the sentiment of all the panelists here that founders should not worry about funding winter or not. All of that stuff is important. But I think what's far more relevant is how you're building your firm, how you're building your company, and how you're thinking about ongoing growth and profitability. Right. So if you're building the right set of companies, I think there's plenty of capital around. Just reach out to folks. There are good discussions to be had.
Perfect. I couldn't have summarized it better. Thank you so much, everyone. It's been an absolute pleasure to be alongside with you. I look forward to kind of engaging more beyond the stage as well. Thank you.
Thank you, Shubhanga.
Do we have our photographer here? Thank you for the panel. Thank you so much. All right, once again, a reminder to everybody that we'll have a session with the Deputy Chief Minister of Maharashtra, Honorable Shri Devendra Fadnavis. He will be joining us at 6:30 in Jasmine 1. So we hope to see you there after that. Is on it's a presentation and panel discussion by Mars Growth Capital, venture debt as a non-dilutive funding source. And may I invite Kosuke Nikoshima, investment manager at Mars Growth Capital, to please take over. He'll give you a new one. Are you going to speak from here or are you going to sit too?
I'll be here.
You'll be here? Or एक chair नीचे. He'll be standing here. Even after you're done with the presentation, you'll be here? Yeah. For the panel? Okay, perfect. You have to speak in this to listen to. Okay. Everyone on the stage audible? Everyone clear? Yeah? Okay.
What happens at the panel so they can speak there?
Yeah. So they'll speak in the mic. You'll speak from here. If you want to sit there, then
No,
we
I'm
do.
here.
Okay.
I'll be here, but they have their own mic.
Yeah, they have. Everybody has their English mics. You'll have to wear that. You'll be able to hear yourself only on that. Yeah. You'll have to speak in this to be able to hear what this.
Okay. Okay, so I think we're ready to go. Yes, so let's start. Hello everyone and welcome to the Mars Growth Capital presentation. My name is Klaus Nekashima and I'm an investment manager here at Mars. And today I have with me our CEOs Ron Daniel and Ryu Hiroshima, as well as Nav Asabin, our Managing Director for the APAC region, to present you with an introduction of ourselves. And also we're delighted to have Suvik, the co-founder of Inframarket, with us also to share some of his experiences with us in the latter half of the session. But before that, I'll hand over to Ron to start with our presentation. So over to you, Ron.
Hi, good afternoon. My name is Ron Daniel. I'm the founder and CEO of Liquidity Group and also the co-CEO of Mars Growth Capital together with Hiroshima-san from MUFG. A few words about who we are, what we do, why we do what we do. So first of all, Mars is a partnership, equal partnership between MUFG, which you're probably all familiar with, and Liquidity. Liquidity is Israeli-American fintech company. We are lending at scale in the United States and Europe based off our machine learning technology, which is today by far the most advanced real-time technology for mid-market due diligence. We usually deploy anywhere between $5 million to $100 million in a deal that we decide to do. Our main capital partners are, of course, MUFG, Apollo Global Management, and other. We're working with the most strategic capital partners in the world to be able to provide fast, scaled, sustainable capital to the best companies in the world. We're working with the most known unicorn on the planet, providing them hundreds of millions of dollars a year to scale their business. And Mars is basically the result of the decision of MUFG to work with us on bringing this revolution into the APAC region with a lot of focus on the Indian market. We do a lot of work here. Our board consists of Nakahama-san, who is the CEO of the global CIB of MUFG, Ilan Raviv, the CEO of Meitav Dash. Meitav is the largest institutional investment house in Israel, running approximately $60 billion in assets. Myself and Hiroshima-san, who will be speaking after me. So when it comes to Mars Growth, we established the joint venture only about 18 months ago, and we already deployed close to $900 million in non-dilutive capital in the region. About 50% of this deployment happened in India, in India-related companies. We love this market, and we're definitely targeting to increase our activity here. The goal is to deploy in this market over $1 billion next year. As you can see here, this is how we scale our operation since we launched this joint venture. I can assume that what we're going to see in the next 2 to 3 years is that Mars will be the largest debt provider for tech industry in India. And on the other side, you can see some of the companies we invested in. Of course, Inframarket, so Vic is with us, will speak soon. eToro, Zetwork, also a very well-known company from India. And all in all, when Indian companies would like to step out of India to the international market, we tend to be the best address to do so. With that, I will let Hiroshima-san to present shortly on MUFG, and then we start the discussion. Thank you.
So, hello everyone. My name is Ryu Hiroshima, and I am the co-CEO of the Mars Growth Capital. I was secondly from the MUFG, one of the shareholder back in December 2020. and have been managing the business in Singapore since our establishment. It's a great pleasure to be here in front of all of you, and from my side, I would like to introduce ourselves from the MUFG point of view. One of the unique aspects of the Mars Growth Capital is that, unlike any other players in the venture market, Mars is fully backed by one of the largest financial institutions in the world, MUFG. In fact, Mars is also mentioned as one of the key initiatives in MUFG midstream business plan. They are currently sole limited partners, providing the 500 million capital commitment to our fund and expected upsides sometimes very soon. Mars not just leading pioneer of the business, but yet very stable, reliable venture debt fund as supportive at the backbone for the startup growth. So how can startup benefit from the Mars? What value can we offer? As you now already know, Mars supports start by providing debt to those who are projecting to grow with dream and aspiration of one day becoming a unicorn and listed companies. Leading and challenging how the world works. This means that various financial support will be required on the way, such as IPO and M&A support, matching and connecting with various companies to expand business further. MUFG has all these capability within the group. Morgan Stanley is the affiliate of the MUFG, and it goes without saying that they have one of the most strong capability globally in terms of supporting companies to succeed their IPO and M&A space. MUFG Bank has one of the largest global branch network for any financial institution with a strong capability to provide financial service to corporate all over the world. And with a strong customer base to potentially match business need to connect each other to support the customer's business expansion. Mars is a very new initiative, having only started less than 2 years ago, which means this kind of the flow and handover grow the company to the MUFG is still ongoing challenge. We are looking to build on the near future. However, the fact that Mars is supporting the startup from the very early stage in the life cycle with establishment view and the strategies handing over to the MUFG make it easier to efficient for all the parties, including these companies. Knowing there's a global financial institution capable supporting the company from the further growth to whom they can turn to when the timings come. So that's kind of our strategy we have for the Mars as MUFG. Thank you. So I pass over to the coach.
Okay, so I guess some of you may now be wondering what exactly does Mars offer? Let me give you a brief overview of some of our typical conditions. We offer very flexible financing facilities, all with the same characteristics in the sense that they are pure debt, meaning they are non-dilutive, and ideal for startups, obviously, who want to avoid or defer equity raising at certain points in time for various reasons. Our ticket size is large and can vary from a few million to around 50 million or even more US dollars, and up to 150% of a company's annual recurring revenue, which we consider as a really large amount compared to products offered by other players. In terms of maturity of the loans, we typically provide facilities with a drawdown period of 2 years, followed by 2 years for repayment of the outstanding amounts. We are proud that we can get back to the clients interested in our products within only a few days once we have all the relevant data for our credit model and our investment managers to analyze. And on this point, I'll elaborate a little further on the following slide. So how can startups get funded by us? The steps are simple. We have an online website for anyone interested to apply, and the application process only takes 5 minutes on the internet. After that, we will connect the company's billing and bank systems to our credit platform where this is possible, or communicate individually to obtain the required data for our analysis. Once this is complete, we will conclude our analysis and get back to the client with a term sheet or at least an answer within a matter of days, usually within 24 to 72 hours. So our process is really quick and efficient, and this is largely due to the hybrid and synergies we have between liquidity and MUFG, just as presented now by Ron and Ryu. Just to quickly touch upon what kind of data we would require, apart from the usual items such as investor deck or historic and projected financials, one of the most important for us is the invoice or sales data, as this becomes the base of our various analysis items. Hopefully now you'll have a little clearer understanding about some of the details on what and how we offer our services. And here I'll pass over to Navas, who will take us through a little more India-focused part of our presentation. So over to you, Navas.
Thanks, Kos. So, as you know, I'm not sure how many of you who are listening in on us today offline here at the venue, or how many of you who are listening on us online are considering our funding. But then if you are an Indian-based company that is considering receiving, or at least looking at receiving funding from Mars Growth Capital, then I'd like to say what we look for in companies and why our capital is probably the best solution for you if you are looking to expand globally, right? If you want to be a part of the Make in India dream, if you want to be a global brand, right? That's where a player like Mars Growth Capital comes in. And that's one of the agendas that we have, right? Create global companies, pivoting them, helping them pivot from being an India-heavy business to being a global business. So we've essentially, over the last 18 months, we've become the lender of choice for international debt, right? For growth stage and late stage Indian technology companies. And we provide completely non-dilutive capital to growth stage or late stage technology companies in India, right? And one of the key features is that we have highly flexible debt, and we provide it in very quick time, so we can turn around very quickly, and our ticket sizes are significant. We're talking about anywhere between $5 million all the way up to $100 million. We already have Sovik here, who has already received $50 million from us, upsizing it very soon. So we'll have this, open it up to a panel discussion, we can talk about it. So the idea is that, essentially, we are trying to help successful India companies to make that leap, to become successful global companies. And, we've just started out, right? We've been around for the last 15 to 18 months in Indian ecosystem. We've done a few transactions. These are some of the transactions that we've completed, some of the companies in our portfolio: Infomarket, Zetwork, Bizongo, very well-known names. We have some smaller companies, Infoprime, Playshifu, Hiva. We've closed term sheets and in the process of closing around $130 million of deal here in India. So we're talking about, all in all, around $400 million in commitment and being deployed in India over the last 15 to 18 months. And over the next 12 months, we are anticipating, as Ron mentioned, deployment of over $1 billion in the Indian ecosystem. So if you are somebody who is looking for dollar debt, or you are a founder, or you are an advisor, or you are a VC fund who wants to actually support his or her company or company in their portfolio, then you should talk to us. We can actually explain how we can actually help you transition from being, let's say, an India-heavy business to a global business. And we'll open it up to a discussion right now. Kos, you want to just begin the discussions? Thank you very much.
Okay, so thank you all for listening to our presentation. From here, I'd like also to invite Suvik to join us for the Second part of the session where we'd like to hold a panel discussion around a few topics we've prepared. So Civic, welcome and thanks for joining us. Our first topic is what is the greatest value Mars brings to the market? So maybe from here, I'll pass it to Navas, who can just kick us off on the panel discussion.
We can't hear you.
Thanks. So, Vic, so we've now discussed about what Mars brings to the market. What we'd like to understand, and I think what everybody here sitting here is keen to hear from you, is your story, right? You've built in from market, and now, as I mentioned, one of the things that we have actually helped you with is to transition your business and build your global presence. Please share your story there, and we can take it from there.
Yeah, so I think one of the key aspects of our business when we started out was that we are a very India-specific business when we started. And one of the things that we realized during COVID and post-COVID is that obviously the supply chains, global supply chains, the way they operated changed. People started importing a lot from India. India started becoming a manufacturing location of choice. And there was this strategy for people to also diversify their manufacturing supply chains to our country. Now, obviously, as a equity-funded startup or a young startup, it's always difficult to access alternative sources of capital, including debt capital. And I think a lot of the debt capital today, the way it operates, at least in India, is not ideal for startups in the way, because the kind of vintage we have or the kind of the way assessments are done is not ideal for startups. And I think that is where our experience with Mars has obviously been great, in the sense that it opens up pools of capital that were earlier not available to us. Like if we had to, the only source of capital for us was equity funding, and that's obviously very dilutive, and it's also highly volatile depending on how the markets are behaving. And we realized that debt as a source of capital can be very stable, and it can also be, it can also help you sort of grow out, especially if your needs are most revenue-based financing. You have good unit economics, debt as a source of capital can help you. And I think these are the things that sort of Mars opened up for us. It opened up new markets for us when we wanted to expand into new countries. We did not need to go and raise equity every time we wanted to go out. Second thing, I've always believed that debt is very important for a company also, as a startup. It brings in a certain sense of discipline, which equity doesn't bring in. The kind of, you have to ensure that you meet unit economic requirements. I think all that sort of helps you as a company when you raise debt, is that it brings you a discipline which as a startup equity funding cannot get you. But it also opens up pools of capital. It has opened up pools of capital for us, especially you guys have opened up pools of capital which were not available to Indian startups, especially the kind of scale at which we intend to grow and we intend to capture global markets.
Ron?
Hey. Yes, so first of all, thank you, Sofik. It's a wonderful experience to work with you the last year. When we look at the Indian market in the last couple of years, and we look at it from the outside, not from the inside, so we see things a bit different than you guys. And what we see is a market that's really, really quickly and rapidly getting mature and catching up market like the United States and Israel, and markets which are already mature in their startup environment. And what we see in this market is that beyond the fact that equity has its own life cycle, so for example, now it's not a good time for equity, but probably it will recover in a year or two, that is very constant. As companies getting mature, in mature market, they are becoming more and more relying their business on debt rather than equity, because equity traditionally become more and more expensive. And in a mature environment, the only reason a company prefers to go in an equity round rather than taking debt is because it's a junction that builds the story of the company toward a certain purpose, like an IPO or something. Because no company ever go IPO from zero valuation to few billion dollar valuation. So this is where equity rounds are very important, because it's build up the company valuation and give it the cap table needed for a proper IPO story. what we see today in India, that the market is catching up. More and more companies understand that funding ongoing growth through equity is too expensive and eventually it generates a conflict of interest between the founders and the company investors. Because you cannot divide cake too many times before everyone ends with nothing. And this is where they approach to debt. And also in debt is getting mature as well. When venture debt started about 20, 25 years ago in the Silicon Valley, there were not a lot of players, and it basically was based about cooking the company with its own oil. And this is something you guys should know this here in India right now. Because what happened is that many of the banks, when they want the banking activity of these startups, they will usually offer small-scale debt facilities that rely on securities on the company banking activity. Meaning they're going to lend the company its own money with interest. And when you think about it, it's a bit funny, right? The company went through a round, raised like 10 or $20 million, and then they get an offer from a bank to take additional 10 or $20 million of venture lending. That's not really a loan. They just lending you your own money back, right? So this is how venture lending started, and basically ruined the reputation of venture lending, right? Because people are smart, people got it. But today venture lending is something completely different. Is how do you take a company with, let's say, $10 million of revenue and $10 million in the bank and inject $50 million to take the company to the next level, right? So it's not anymore heavily rely only on securities, but it's more about what is the company is about, what is under the hood of the company. Can you hear me? I think Mars and liquidity and what we are doing these days with MUFG is the most cutting edge proposals in this segment, because today we are offering companies over 1.5x on their annual run rate, not even actual revenues. And it's all based on our assumption of what the company will be able to perform in the future. So this is lending against future asset, not against back asset. And this is like a very disruptive thing in nature, because traditionally debt is about lending against asset, or against what you already achieved, not against what you're going to achieve. And the ability to make this leap, and instead of base the amount of capital you can consume to grow on what you already have, that's a change. And we see more and more companies going this direction. And of course, I don't know who are you guys in the audience, but assuming some of you are entrepreneurs, we will be happy to engage, get to know your companies, and see how we can help you scale. Thank you.
So Vic, I'd also like to understand, maybe you can share your perspective on how your experience was with us, right? How quick the process was, how quick we could turn around. Maybe that will be helpful for the audience.
No, of course. I think it took us 3 to 4 days to sort of have once we had sent all the data across, to get the initial sense of what you guys could do, and around about 30 days for the money to hit the bank sort of structure, where you could actually, you didn't need to, it was not a painful process at all for us. So long as we had our data sent, it was a very quick process, very seamless, where we could actually quickly sort of accelerate revenues, accelerate growth, plan for the next 6 months. I think that is obviously a great way to sort of operate. And I think it was a very seamless process for us, at least so long as we've worked with your team. What also helps is that I think majority of your analysis is very quant-based, right? You guys are doing a lot of data analysis on the go, so it's not a very lengthy process also for us, where it's where we have to send data, and you already have your data packs well defined, so we can keep working on the data on a month-on-month basis, share it with you guys, so that it's not a regular process of iteration on what we need to actually share. I think that also helps, but the templates are pretty standardized for us to share. That also helps on a regular monitoring basis for us. So I think the overall experience has been seamless for us compared to other lenders, venture debt lenders we've worked with. It's a stark difference in how we work with Mars. Yeah?
And how important is dollar debt for Indian startup ecosystem?
I think it's very important if you have a global business. I think if you want to remain a company which is going to only operate in India, then maybe it is only important in terms of scale. Because dollar debt obviously brings a lot of scale, which rupee debt, at least in India, the way the banks are lending, they don't, or the ecosystem they lend. But if you want to say, operate globally, and you don't want to then borrow in domestic currency, start doing global exports, expose yourself to currency hedging risks. So if you have a very large global business, it makes absolute sense to actually borrow in dollars and make it currency, at least currency risk neutral. And I think that sort of avenues today, apart from Mars or apart from I don't know anyone else at this moment who's doing this, or apart from maybe a very mature company can go and borrow from global banks. Apart from that, that opportunity is not available in India today, at least for Indian startups. And I think even the India, the way it is positioning itself to be the manufacturing hub for the world, if you really want to do that, then not trying to do that without the avenue for such for a dollar debt is impossible for small, at least for startups to do. I mean, you have to be a very mature company to be able to go out and tap global markets for global banks. I don't think there are any venture debt solutions for Indian startups to actually access dollar debt apart from at this moment with Mars, obviously we worked. Apart from that, I don't think there's any option.
I'd like to bring in Hiroshima-san in this discussion. Hiroshima-san, you have come from a traditional bank, MUFG, one of the largest banking institutions in the world, right? How was your experience setting up Mars Growth Capital along with Ron?
Yeah, so working with Liquidity Capital is just amazing. So MUFG has like a 350 years history and one of the biggest financial institution in the Asia. However, we have no experience to give the provider debt finance to the startup company. Zero experience. But after working with the liquidity team and using their digital platform, we met more than 1,000 clients, and that we achieved just for the 2 years. And we understand the ecosystem thanks to their technology, and we can provide light startup company with the debt, give the decent debt with speedy money. That's what we experienced as the Mars Growth Capital. Thank you.
Great. Ron, if you could explain a little bit about what Mars is doing globally, plans for India, and how it ties into the entire picture, and what you're building at Liquidity. And then, we can talk about the second part of this topic, which is about the venture debt and its relevance globally and in India.
Sure. So important, first of all, to understand that credit market in the world hasn't been changed for over 5,000 years in macro trend. Always credit was about asset. And so it was not designed to support fast-growing vehicles that need to consume a lot of working capital in order to generate growth, right? Because when you want to grow fast, like tech companies, you need to spend more money than you have at any given moment. Doesn't matter how much revenue you generate, you want to be a negative EBITDA company because you want to capture more and more market share, more and more fields. And credit provider today they have no clue how to deal with it, because for 5,000 years they were used to, hey, this is my asset, it's a real estate asset or an inventory asset or whatever, lend me against this asset. And suddenly, credit environment in the world completely changed, and people come and say, hey, why won't you lend me $100 million because I'm going to achieve with it $200 million, but I don't know how to evaluate my assets right now. It has no value whatsoever, which is tangible. And the tangibility of the asset, in essence, is unclear today, unless it's real estate. And even in real estate, it's not clear anymore. So the leading credit providers of the world, like MUFG, for example, I think MUFG today is the largest loan book on the planet, right? $1.4 trillion of loans. How can they turn it into $5 trillion of loans? They have to move away from asset-based lending, right? But the only way to move from asset-based lending is to forecast the future in such accuracy that you don't need the asset anymore, right? Because you always know what's going to happen. This is liquidity in a nutshell. Liquidity today generate a real-time forecast on private companies at over 94% accuracy on their revenue stream and cash position 2 years ahead. So basically, it's turned the future into an asset. And against the future, you can always lend more than what you lended against the past. We started with technology companies because they are the fastest to grow, but what we see is a lot of demand, both in India and other markets, for general mid-market lending. So where we're going to see Mars in the future, we're going to see Mars doing 3 different things, which are relevant for the Indian market. First of all, we're going to enlarge and scale our activity in the tech venture lending. As Navas mentioned before, we're going to lend about $1 billion next year for Indian companies. We are launching a new equity fund that will basically be a comprehensive product for the lending. We're going to do late-stage growth investment in same companies, up to $100 million per company. And we're expanding slowly but surely and unfolding additional verticals beyond tech of mid-market lending. We expect our global business to reach about $10 billion of lending by 2024, and about 15 to 20% out of it going to be India, so quite significant.
And before going to Souvik, Hirshima-san, how do you see Mars? I mean, obviously, Ron just explained how Mars fits into the larger picture. So how do you see Mars actually fitting into the whole MUFG ecosystem? You know, Mars acting as a driver or the entry point or the gateway for promising growth stage, late stage Indian technology companies to get into the MUFG ecosystem. If you can explain a little bit about that, then, and that'd be great.
So, MUFG challenge for the startup space. So, MUFG challenge for the startup space is significantly moved from the maybe 2018-19. So, we have the CBC, MAIP, we have the Ganesha Fund, which is support Indian startups, and we have the Mars and Mars Equities. So these 4, our institution try to support the Indian startup market space as much as possible. And as you may know, as I explained to the presentation, MUFG can provide a financial service, someone who start from these 4 entities, first of all. And one of our strategic partner, Morgan Stanley, is provide the IPO and M&A service. So what we try to do in this space is provide a fast money to the end banking system, banking lending service, then investment banking service. That's what we like to achieve in this Indian startup market space. That's our kind of the goal as the MAFG point of view. Thank you.
Thank you very much. Souvik, are you a happy customer of, are you happy taking the money from Mars Growth Capital?
Till now? Yeah, till now, of course. I mean, see, at the end of the day, it's non-dilutive. It allows the promoter, it allows the founder to retain control on what he's building, ownership on what he's building, and it's substantial scale that allows you to take your company to the next level. I mean, as a founder, it ticks off a lot of the right boxes, right, for us. So I think, yeah, of course, at this moment, and the way we've sort of had experience with Mars and the way we've sort of worked, I think our experience has been fantastic.
And how important was our capital, or let's say is our capital, in your journey towards the IPO?
I think for us, see, like Ron said, you can't keep raising equity at every stage, especially when markets are depressed, when markets are not great, and equity should only be a way to benchmark your path to IPO. So if you want to go IPO at a particular valuation, you need to have a step-by-step valuation uptake, build the right cap tables as you go public. But we see a lot of young startups which have either gone public or about to go public in India, where founders hold all founders put together hold single-digit ownership. It's not a great way to build businesses, because you've worked a lot, you've built something, and at the end of the day, you're sitting out there holding 6-7%, 10% of your company. I think that's not how, and that is primarily because these founders, when they've raised money early on in their in their careers, in their lives, of their companies they've built, they've not had the substantial pools of capital which they could tap, and hence they have raised at terms where, even though they have done very well later on in their life, most of the dilution comes early on. So I think getting the right sources of capital, pools of capital as debt, today allows you that when you actually go public, you have a substantial stake of what you have built, and you control your own destiny eventually, what you build. So I think in that sense, it's very, very important.
I have to add to that also. Can you hear me?
To change.
It's not just about controlling the company. It's not about how much you gain in an IPO or M&A. It's also about controlling. It's about controlling your board and your decisions. And every round that you pile up more and more investors, you have less and less.
Exactly. Yeah, it's controlling the way you build the company. Controlling the dream you have for what you're building. I think that's very critical. And I think debt plays a very critical role in that. If you have a business that has good cash flows, you can actually predictably pay a cost of debt. Debt is much cheaper than equity and is actually a very good source of capital. Yes, equity is critical, but equity is critical only to keep benchmarking what you've built.
So Vic, can I add to that something? We always say debt is much cheaper than equity, but I think most of people doesn't understand what it means. How can debt that you pay interest is cheaper than equity, that you get money and you do stuff with it and you don't have to pay it back? So I'll give a quick example. Let's assume that you have a startup and you're raising, let's say, $10 million for $100 million valuation, and you take this $10 million and you turn the company into a $300 million company in a year or a year and a half. In this case, the shares that you gave for $10 million now worth $30 million, not to mention in most cases that also include liquidation preferences and double dip, etc. So the investor going to see $40-50 million before you're going to see $1 in case of an M&A or something. That means that you actually pay 500% interest on this $10 million, right? While if you took debt instead, you would see like 10, 12% interest, maybe 15 if you have a very risky company, or 16, whatever. But how can you put 15, 16% interest next to 500%, right? So equity hide its cost in the name of the shares, but it's actually way, way more expensive than any type of debt out there. So just want to put an example to that.
Yeah, of course. I think equity, also I think, like I said, you should only raise equity when you want to benchmark your company, and not just because you need the money. I think raising equity when you need the money in depressed markets is the worst way you can actually raise capital. It's a
also raising debt. Raising money in general, never raise money when you need it. Always raise money when you're strong and when you don't need it, because people like me, they rather give you money when you don't need it. That's just the reality of life, okay? Because when you're strong, it's easier to lend you the money. And when you're weak, it's going to be tough. So don't wait until you're with the back to your wall to raise it.
That's a very good point. Souvik, to wrap up this discussion, right, what is your advice to this community, the startup community, the Indian ecosystem as a whole? Obviously, we are coming in as Mars. I mean, let's keep Mars out. What is your advice to this ecosystem as a founder who has explored this asset class?
No, I think my experience, what I'd like to impart to every young founder is that, irrespective of whether you eventually end up raising debt or not, you must explore it. I think one of the reasons is that once you start exploring debt and you start looking at how they look at your business, it actually increases your ability to understand the predictability of your cash flows. Because you need to be paying a coupon every month, every quarter, every half yearly. You need to know when your money will come in, when your customers will pay, how you will pay your interest. That sort of discipline doesn't come in a young startup founder when he's just going, even when you're going for growth, when you only have equity, you don't realize that inherent discipline that doesn't come in. But when you start raising debt, that discipline is brought in by your debt partners inherently. And I think that plays a very important role. And as you scale up, it's very critical. That part of the business is very critical for you, because if you are not growing sustainably or not growing in a manner which is financially disciplined, then if in not today, then couple of years down the line, you're going to feel that pain, right? So I think debt is the easiest way to bring in financial discipline also in the organization. Apart from that, all of the advantages of it being non-dilutive, it being scalable, it obviously, help being more founder friendly and opening up different pools of capital notwithstanding. The biggest thing that does for you is for you to, have the ability to predict when your money is going to come in. If someone is not able to take debt because they don't have predictability of cash flows, they need to seriously look at their business and then rethink on how they are doing. If they are really scared of taking debt because they don't have the predictability of the cash flows they currently have.
Great. With that insight, we come to the end of this panel discussion. But now we would like to actually listen in on take any questions from the audience, please, sir. Is a mic going around? Yes. Right. Please introduce yourself, and then you can basically aim your question.
Hi, thank you for this session, all of you. Very interesting proposition that you've brought forth, a case example with Inframarket, where it's been validated. My question was essentially that as a lender, right, venture lending, while your asset is, like you predicted, the future that is well predicted, what's your fallback? Right? Because quite often the future does not always emerge as predicted. And therefore, what is the cost which the company needs to pay at that point in time when it doesn't, if it doesn't?
Very good question. First of all, the fact that we predict the future doesn't mean we are not willing to work across all different positions of the capital structure. So eventually, pricing is a matter of risk, right? It's a risk-reward business. So the riskier the company, probably the price will be higher on the interest rate and conditions. So there's a lot of variety between these different positions. On the same company, we can do different type of deals. But in an average deal, let's assume that we have regular securities which are not so strong, especially on these companies, partial securities, probably pari passu with another lender, etc. But we think the company is strong, prediction seems strong, and we start the deal. What's unique about the way we lend is the fact that we are due diligence the company basically 24/7. The system remain integrated to the core systems of the company, billing system, CRM system, and bank accounts. So our system refresh its prediction all the time, in average once a month, okay? So if we see a marginal change in the company trends, first of all, we see it before it's actually impact the business, okay? We had few cases of it in the past in the general liquidity environment. In Mars, we didn't, but in the general liquidity portfolio. And what happened that if I look 3 years back, in 5 out of 6 situations we had, in 5 situations, the fact we were able to detect that before the company detected it, and engage in in real conversation with the company, showing the company what we see, in 5 out of 6 times we actually saved the companies, right? Because first of all, we made the company aware of the long-term trends that we see, so the company could change activity accordingly. We could restructure the deal, refinance it. We could do a lot of things. When you see the problem before it actually happens, you have a completely different way to solve it, right? And in one case, we just had to, take our security, put our hands on the money. But that's just because the company didn't want to cooperate with us on what we saw, which end up with the default event of the company, not the default to Mars. So as lenders, it's always a gentle balance between our reputation and our wish to help the company. We always prefer to help the company survive what we see, okay? But it's also up to the company to generate a responsible open discussion back with the lender, right? In the last 3 years, we had 6 cases like that. 5 ended very well for the companies, and 1, unfortunately, the company liquidated, and we had to recover our investment. And that's part of business, you know. If you're not willing to lose some money, don't be in this business.
Thank you, Ron. I missed on introducing myself. I am Sachin Bavri. I head the risk with Khata Book. We are a digital lending app, one of the largest in the country. Yeah.
Okay.
So I'm sure you agree to the description I just gave. Right?
Absolutely, absolutely. And if you permit, I have one more question, if that's fine with you.
Sure. I see it's time's up, but I guess we can take a couple of questions. Yeah, yes, please, go ahead.
Thank you. Right. And therefore, another lingering point which was there in my mind was whether the form of debt which you lend is only coupon and therefore the structured in case there's high volatility with a security, or is there also convertibility into ownership and therefore control as well?
So today we don't do any type of CLAs or SAFE, if that's what you ask. I tell you why. Downside protection and upside opportunity is completely different business. Okay, mainly policy-wise, because sometimes companies are very well eligible for debt, but not the best companies for equity, and sometimes vice versa. You know, because if you're equity players, you don't want to place a bet, but you want to make like 10x on your money. But if you are a lender, you just want to make sure that the company will service the debt. Okay, completely different stories. So we tend not to mix between the two. I don't know if it's answered your question.
Yes, fairly well. Thank you.
Great, thanks.
You're welcome.
We just been informed that we are running out of time, so can we take the rest of the questions offline? We are here, so it'll be wonderful. Can we take one more question? Is that okay? All right, cool. We can take the question offline with you.
Okay. Thank you, guys. Thank you very much for listening.
PA sound. Check. All right, thank you very much. With that, we come to the end of day 2 of the Global Fintech Fest here in Jasmine 3 Hall. Once again, a reminder to everybody, the session with the Honorable Deputy Chief Minister of Maharashtra, Devendra Fadnavis, is starting immediately in Jasmine 1, if you'd like to join us there. And thank you very much for being a part of this, the world's largest Fintech Fest. We'll see you again tomorrow for the finale day of the Global Fintech Fest. I'm your host, Chaitanya Rathi, signing off. Thank you so much and have a safe drive home.